Okay, I think we're live. We're about to find out.
I think we are. Are we live?
I think we are live. Well, we'll see how this goes. Okay, so this is the first installment of the Tax Files. That's it. We're going to read DAC Investments.
DAC Investment Holdings.
And we're going to start at the tax court, just as we do. Go ahead. Let's start reading.
Let's start. So, between DAC Investment Holdings, the appellant, and His Majesty the King, the respondent.
Yeah.
Reasons for Judgment by Justice Darcy. Introduction. Prior to April 29, 2015, the appellant was taxed on its worldwide income under the taxing regime for Canadian-controlled private corporation, CCPCs. On April 29, 2015, it continued in a foreign jurisdiction such that it was deemed to be incorporated outside of Canada. However, it remained a resident of Canada, taxed on its worldwide income. Since the appellant was not considered to be incorporated in Canada, it was no longer taxed on its worldwide income under the taxing regime for CCPCs, but rather was taxed under the regime for private corporations that were not CCPCs and that were not Canadian corporations. As a result,
I think you have to say Canadian corporations. But where's the emphasis here? And that we're not Canadian corporations, meaning a defined term?
Yeah, it's a defined term.
Yeah, that's what they mean there.
Yeah, not that it was not resident in Canada, because
Right.
it was.
It
But
was
it's not a
resident. It
Canadian corporation
Exactly.
for the purpose of the Act.
Exactly. Okay, good.
As a result, a host of provisions in the Act ceased to apply to the appellant. Provisions that were not previously applied began to apply to the appellant, and other provisions apply to the appellant in a different manner. Interesting.
There's a lot packed into this first paragraph. So a host of provisions ceased to apply. Provisions that were not previously applied began to apply, and other provisions applied in a different manner. Okay,
Yeah.
we got a lot going on.
So basically,
Okay.
you can be a CCPC or not a CCPC, and some provisions apply to CCPC, some provisions apply when you're not a CCPC, and sometimes the same provisions apply, but in a different manner.
Okay.
We're going to figure out what are those provisions. One provision that ceased to apply was Section 123.3 of the Income Tax Act, the Act,
Yeah.
which levies a 10 2/3% refundable tax on a CCPC's investment income. That's the temporary tax on investment income in a CCPC. 10 2/3%. Another provision that ceased to apply was paragraph B of the definition of full rate taxable income in subsection 123.41. This meant that the appellant's entitlement to the 13% general rate reduction provided for in subsection 123.42 was now determined under paragraph A of the definition of full rate taxable income. As a result, the appellant was now entitled to claim the 13% general rate reduction in respect of its investment income. The minister applied the General Anti-Avoidance Rule, the GAR, and assessed the appellant on the basis that its investment income was subject to the Section 123.3 refundable tax and that it was not entitled to claim the Section 123.4 general rate reduction in respect of its investment income.
Okay, so just to remind ourselves, the full rate taxable income is the general. We have like a series of rates. Okay, so when they say general rate reduction, it means we start at
38, I think.
38.
Yeah.
Then minus 13 for the general rate reduction, which you get if you're a CCPC, and then another rate reduction if you're a small business. You're a CCPC with a small business deduction. Are they that, or are they just?
You're getting in and out of the mic, I think.
Oh, sorry. Okay, I'll try to stay closer. Thanks for checking.
You cannot move. You have to stay in front of the mic.
Yeah, I gotta not forget that we're actually on screen and not just having a conversation. Okay, good. We'll fix it right here. Okay.
So the rate is different. So if you earn investment income in a CCPC, you will pay a higher rate and you pay refundable tax. But if you earn investment income in a non-CCPC, you pay just the lower rate, which is for investment income lower if you're not a CCPC.
Lower if you're not a CCPC, right? Okay.
While the rate if you're earning business income on the first $500,000 is lower if you're a CCPC. So basically, CCPC is good for you if you have business income, but if you earn investment income, then it's
right. So if you have your way, you would be a CCPC when they come calling for your business income tax, and you don't want to be a CCPC when they come calling for your investment income.
Yeah, that would be great. I mean, if we could come up with a plan that you're a CCPC as long as you earn business income, and the minute you're no longer earning business, but just investment, you're no longer a CCPC.
Yeah, that would be a great plan.
It would be a great plan.
I think maybe that's the plan.
But I wonder if the GAR would apply to that plan.
I guess we're about to find out. Okay.
Well, maybe not in this one, because we have the FCA decision.
That's right.
So we're going to figure out what the TCC thought about this plan.
Okay.
My plan. Now it's
your
my
plan. That's your plan now. Yeah, that's your plan now.
I don't know how to achieve it, though. Can I just stick out of the CCPC box?
Yeah, it should be a check the box regime, just like the U.S.
Should be like, I choose to be CCPC.
Choose in and choose back out again. Yeah.
Because you can
Don't give people ideas. Don't give people these ideas.
You can get in and out of the regime. It would be so easy.
Yeah, it would be very nice. Yeah.
Okay, so the appellant challenges the application of the GAR. The parties file an agreed statement of facts and a supplemental agreed statement of facts, jointly referred to as the agreed statement of facts, without caps. There were no witnesses called at the hearing. Wow, no witnesses.
No witnesses, okay.
The parties attach a number of exhibits to the agreed statement of facts. The agreed statement of facts, without the appendices, is attached as Appendix A to these reasons for judgment. Do you want to read the agreed statement, or I just read the relevant facts?
Let's just keep going. Yeah, let's just read it.
The appellant was incorporated under the Business Corporations Act, Ontario, on September 11, 2001.
Whoa.
What are the chances that you were incorporated on 9/11?
Yeah.
Like, not just September 11, but 2001.
Yeah. Yeah. I'm always surprised when I see this case that could have happened. So strange. Yeah.
Since the inception of the appellant, Mr. David Siviero has been its sole director and has held directly or indirectly at least 50% of its common shares, so he has control.
Okay.
From 2015 through 2019, Mr. Siviero was the sole common shareholder of the appellant. At all material times, Mr. Siviero resided in Ontario. He's Canadian.
Yeah.
He owns a corporation incorporated in Canada.
Yeah.
Can it be more Canadian than that?
It's very Canadian.
It's very CCPC.
Yes.
On or around October 22nd, 2011, Mr. Siviero acquired common shares of SoberLink Incorporated. He purchased additional shares of SoberLink Inc. on or around June 26, 2013. On or around December 31st, 2013, Mr. Siviero transferred all of his common shares of SoberLink, the SoberLink shares, to Jackal Holdings Limited, Jackal. Since December 11, 1996, Mr. Siviero has been the sole director and has held all of the shares of Jackal. The following occurred after Mr. Siviero transferred the SoberLink shares to Jackal. On October 3rd, 2014, SoberLink Inc. received a non-binding indication of interest from a potential buyer. On April 14, 2015, the appellant acquired the SoberLink shares from Jackal pursuant to a Section 85 rollover transaction. On this date, the appellant's only assets were the SoberLink shares. On April 15, 2015, SoberLink CEO informed Mr. Siviero that the sale of the division of SoberLink was close to completion. In order to effect the sale, the SoberLink shares would be sold to a third party. On April 29, 2015, the appellant was continued into the British Virgin Islands. As a result of the continuance, the appellant's 2015 taxation year ended on April 28, 2015.
Okay, so see, this is how we get out of being a CCPC. Yeah.
So you continue the existence into another jurisdiction.
Right. So you're still Canadian.
You're still a resident.
You're still resident of Canada, but you're not defined as a Canadian corporation.
And I assume we don't have a treaty with BVI.
That seems right. Yeah, I don't think we have a treaty with BVI. We probably might have a TIA.
We probably have a TIA,
yeah,
but no comprehensive tax treaty.
Right, agreed.
So I guess the corporation would be a resident of both Canada and the BVI.
Yes, right. It's dual-headed. Yeah, dual
Probably.
corporation. Yeah.
As a result of the continuance, the appellant's 2015 taxation year ended on April 28th. So there is a taxation year end because you continue in another jurisdiction. At all relevant times following the appellant's continuance, the appellant's central management and control remained in Ontario, Canada. So now we are referring to the beers.
Oh, right.
Yeah.
Of course.
We need central management
Central
in
management
Canada to...
Means it's still
Because we want to be a resident in Canada.
still a resident of Canada, so it's not a foreign company.
Yeah. Because that would trigger FAPI.
Right.
So you don't want to trigger FAPI.
Clever.
You want to
It's
be
pretty
taxed
clever.
in Canada, just you want to be taxed at a lower rate.
Yeah. I won't say they're not clever.
It's clever.
Yeah, it's clever.
On May 14, 2015, the appellant sold the Soberlink shares to an arm's length party and realized a capital gain in the amount of $2.35 million.
Nice.
The appellant reported a taxable capital gain of $1.17 million on its tax return for its taxation year ending on April 30th, 2016 taxation year. The appellant reported no other income on its tax return other than the foreign exchange gain. And the appellant filed this tax return on the basis that during the 2016 taxation year, the appellant was a corporation resident in Canada, subject to tax on its worldwide income under the Act, was a private corporation, as that term is defined in subsection 89(1) of the Act, and was not a CCPC under the Act. The minister applied the GAR.
Oh.
Oh.
You have to play some horror music when that happens.
For some people, it would be the minister apply the GAR. For some people, it would be the minister apply the GAR.
Yeah.
So the minister applied the GAR when reassessing the appellant's 2016 taxation year. Specifically, the minister, when reassessing the appellant, assessed refundable tax of $91,003
Okay.
under subsection 123.3 of the Act on the basis that the appellant was a CCPC, and denied the general reduction of $148,000 and $216 claimed by the appellant under section 123.4 of the Act.
Okay, so the general rate reduction is denied,
Yeah.
and the
And you pay
refundable
refundable
tax is
tax.
applied, saying you were a CCPC.
But I think the question
Well, yeah, okay.
about the refundable tax is the minister applies the GAR, so the corporation doesn't become a CCPC
Right.
because of the GAR.
Right.
So can you get the refund if the corporation pays a dividend in a few years?
Right. So the GAR does not change what you did. It only changes the tax benefit.
Yeah.
I would say. Yeah.
It denies the tax
Denies the tax
benefit,
benefit. Yeah.
but you don't become a CCPC.
Yeah, which is going to be interesting later.
Yeah.
Right. Okay. Okay.
Okay, the law.
So those were the facts. So just to recap the facts. To recap the facts, we have a a Canadian person that fully controls a Canadian corporation. They're organized in Ontario. They're running along. Somebody comes along and says, "Hey, I'd like to buy your corporation," and the Canadian says, "Oh, but if I sell." I'm just trying to understand how we're getting to investment income. It must be that they're going to sell a division or a part of the company, right?
Yeah, they sell because what are they selling exactly? Because they sold a share. So the appellant, DAC Investment, sold the shares of Soberlink.
So a subsidiary.
Yeah.
Okay.
Yeah.
So the corporation that we're talking about that is in court is going to sell some shares.
Mm-hmm.
And when you sell shares in a company, that's investment gain. That's not business income, unless you're in the business of buying and selling companies, which they're not. They're in some other business. So they're in some sort of what is it? Fracking pipeline, digging. Is this the one with the what were DAC Investments?
What are they? What is Soberlink?
I don't even know.
I don't.
Is this the one that had the?
No, I don't think it's this one.
Okay. Okay, well, so so they're doing investments in things, and Soberlink it sounds to me like a media internet. It just feels like an internet company.
Probably a sober link.
Is there anything in the...
It doesn't say.
Okay. So we don't know what DAC Investments is.
But it's a real...
A real estate, maybe? Is it real estate?
I don't think it is. I mean, it's a real business.
Here, okay. Well, we could look it up online, but we're not going to do that because... Under the business, yeah, okay. Link Line Group of Companies. I mean, it really sounds like an internet company.
I think it's an internet company.
It just feels like it, like all this link stuff.
Yeah, maybe they're selling, cables?
Yeah, undersea cables.
Heavy mooring subsea chains?
Yeah, that's what I was thinking about. Exactly, the chains.
No, it's
the
not this one.
Oh, that's a different case.
Yeah, this is C&W Holdings.
Oh, yeah,
The new case on beneficial ownership.
Right. Okay.
But it's
we'll
also about links.
We'll do that one another day. Okay, so just to recap. Okay, so we have the Canadian owns the DAC Investments. DAC Investments is rolling along as a CCPC. A CCPC is entitled to a nice lower rate of tax, but the trade-off is that Canada doesn't want you parking investments in your CCPC. So they hit CCPCs with an extra refundable tax when they produce investment income, which the CCPC recovers when they pay that income out to the shareholders as a dividend. Okay. Yep. So this guy did not want to do that. Apparently, he did not want to pay the proceeds out to the shareholder. Of course, that would mean the shareholder would have tax, presumably, so maybe that's why. But in any case, they didn't want the refundable tax. And so in the facts you just read, it sounds like the shareholder caused DAC Investments to continue into the BVI, which makes them not a CCPC anymore, but still, even though they're still resident in Canada, so nothing is shared. They're still paying taxes. They're still Canadian. They're Canadian resident. They're just not a CCPC at this one moment, the moment when they're about to get a big investment gain.
Yeah, it only makes sense also if you want to earn investment income in the corporation, because if you send the money back to the shareholder, it doesn't really matter that much because the dividend credit would be different and you would probably pay around the same in the end because of integration.
But you're going to lose your deferral here.
Yeah.
Right, with this refundable tax. Okay, and so just to be clear, do you think that the idea was then to discontinue the continuance and then go back to being a business, a CCPC afterwards?
No, I think what I would do is just invest this $2 million of capital gains, because if you're no longer a CCPC, if you still earn business income, you would just pay more tax. So it makes more sense if you just continue this corporation having investment income. And if you want to earn business income, just
do it somewhere else.
Do it in Canada.
Yeah.
Do it through a CCPC.
Okay.
Or maybe you want to earn business income in BVI. Maybe you want to start a hotel with the $2 million.
Sure. That sounds like a fun idea.
Because... But then you would pay Canadian tax on this.
Yes, and it would be fappy. But also, if you start investing in it, it's a business in a BVI, you're in business anyway.
Yeah. But you would pay like tax in the BVI plus tax in Canada.
Right.
That doesn't make sense.
Doesn't make sense.
The only reason why you would do this is earning investment income.
Yeah,
in
Canada. Yeah. Okay. All right. So that's the law, the facts.
Yeah, the facts.
Now we switch to the law.
It's very short.
Yeah, the facts are mercifully, because we've seen some where they're like hundreds of paragraphs reciting testimony, but there's no witnesses. Okay.
So all this was just on the agreed statement
of facts. In the appendix. Okay.
This is efficient.
Okay, yeah, pretty efficient.
I think I need to make your mic.
Yeah, I know. I need to fix my. Okay, for future podcasts, live streaming, I'm going to fix this mic like that one. I'm going to get another one like the steady one, because this one doesn't want to stay put. Hello, world. Sometimes tech doesn't do what you want it to do. It's too heavy, I think.
That's good.
That's what matters. But it's definitely like it's too heavy for the stand, and so it just wants to.
I think you need to put like a sandbag on
the other end.
So it will not.
You're right.
But we don't have
I don't have a
sandbags.
sandbag. I have a triangle. You want me to try that?
But we do have income tax act,
We do.
which would work the same, I think.
I think it's slightly better now.
Oh yeah, that's
Is
better.
it falling? At a slower rate. It's- we are not polished, but that's the point. That's why we're live streaming and not creating a video that is like, polished. Okay. So we are at the law. All right.
The law.
The law. You have
law.
to say that with gravity, like the law.
The law.
Bum, bum, bum. We need a...
Bom, bom, yeah.
We're going to change the... Okay.
I really like this Latin phrase, which is dura lex, sed lex.
Oh.
The law is hard, but it's the law.
Yeah.
But when you say it in Latin, it sounds so much harder.
Yeah, it does. Yeah.
It's like, you talk to
say it
someone, it's
again.
like, dura lex, sed
Yeah.
lex. And you
Duralex
have to
sounds
look
like
at the person.
Like some sort of... that could be a good name for a podcast, Duralex.
Yeah, dura lex.
Yeah, not bad. Okay, another project. Future project. All right, the law.
The law. The leading cases on how the GAR is to be applied are the Supreme Court of Canada, SCC decisions in Canada Trustco Mortgage Company versus Canada, Canada Trustco, Lipson versus Canada,
Yep.
Lipson, Copthorne Holding Limited
Ooh,
versus
one of our
Canada,
favorites.
Copthorne,
Yep.
Canada versus Alta Energy Luxembourg, SARL, Alta Energy, and Dean's Knight Corporation versus Canada, Dean's Knight.
It's like the greatest hits.
Yeah.
Yeah.
You know there's a mistake in the name of Alta Energy Luxembourg?
There is?
Because
SARL.
SARL means Société à responsabilité limitée.
Yeah.
You don't put a period
After
when
the-
it's just one letter.
yeah.
So it should be S-A, S period,
A, no period.
space, R period, L period.
Yeah. Oops.
Oops.
Okay.
In Copthorne
Copthorne.
and Dean's Knight, two good cases.
Greatest hits, I'm telling you.
The SEC set out the provisions of Section 245 that impose the GAR are to be applied to the transaction or a series of transactions. The court's reasoning in Copthorne and Dean's Knight is consistent with its reasoning in its decision in Canada Trustco, Lipson, and Alta Energy.
Okay.
In its decision, the SEC has made a number of observations with respect to the application of the GAR, including the following. The GAR is different from the other provisions of the Act.
Oh my goodness. Come on. You don't want one.
I mean, who would have thought that the GAR is different
Wow.
from the non-GAR?
I mean, I thought all the provisions were the same, so I don't know why we need more than one,
I
because
think
they're different.
I thought there was just one provision in the Act, which is you have to pay tax.
Yeah. Like, Section 2 is no different than Section 1.
all
And
the
Section
same.
3 is no different than 2. Anyway.
85 is the same
It's
as
exactly
84.
the same as 84. Exactly. Yeah, it's the same. But not the GAR.
Not the GAR. The GAR is different.
I'm going to put more sounds on this. Also, I think there's like a little card you can put on this.
Yeah.
And then you can say what the sounds are. Like you could give yourself a hint.
Because if
And
I-
also you can record whatever you want onto that thing. Yeah.
Because if I hit the wrong line, it's going to sound weird. Like, the GAR is different from the other provisions of the Act.
What does it sound like? What do you...
Okay. While the Act is dominated by explicit provisions dictating specific consequences that invite a largely textual interpretation, the GAR is quite a different sort of provision.
Yeah, okay.
It is a broadly drafted provision intended to negate arrangements that would be permissible under a literal interpretation of other provisions of the Income Tax Act on the basis that they amount to abusive tax avoidance. This is from Canada Trustco.
Okay.
The GAR was enacted as a provision of last resort. Also Canada
yeah,
Trustco.
Yeah. All right.
Oh, the SEC has affirmed on numerous occasions the Duke of Westminster
man,
principle.
Here we go. we definitely, yeah. Since there are these greatest hits, there should be a sound effect for each of the greatest hits. The Duke Westminster should be like when the villain comes on screen, like the Darth Vader or something.
Oh, this would be good.
Yeah. Okay. We'll work on it. We'll work on it.
So the greatest hit in Canadian tax law
Yeah. This has to be the
jurisprudence
most played.
is a British case.
Yeah. It's the most played song
Yeah.
in the Canadian tax landscape.
Not
yeah.
even Canadian.
Yeah. Exactly. I know, and they don't even follow it in the UK. But here we are. Yeah.
Well, it's interesting how the first cases of the Supreme Court after the Duke of Westminster did not follow the Duke of Westminster.
Our own Supreme
Our
Court,
own Supreme
we did not
Court.
follow it.
Yeah.
And then somebody decided we should follow it?
After, so the first decisions were like, no, it's not relevant here. And after a while, they decided to apply it. But it's really after the charter that the Supreme Court really applied the Duke of Westminster.
Okay, maybe we should look into that and have a little conversation about that. That's interesting. Actually, you know what? We should go back and read the Duke of Westminster. That should be on our list.
Yes.
Yeah. Because it drives me crazy, that case. Really, it does. Okay, good. All right. Anyway, greatest hit. Well, is this the button for the greatest hit?
No, that's...
What is that? Is that applause? Okay. So, okay. Yeah.
Principle. Duke of Westminster principle. It's no longer the case that you cite. It's like it's the Duke of
I
Westminster
forgot to
principle.
scroll. Are we at the same place? Okay, yeah, sorry, yep. Okay, yep.
The taxpayers can order the affairs to minimize the amount of tax payable. Mm-hmm. However, this principle has never been absolute. Where a transaction or series of transactions is shown to be abusive, the Duke of Westminster principle is attenuated by the GAR.
Attenuated, okay.
Okay, cool. Mm-hmm. A general rule, such as the GAR, introduces a degree of uncertainty in tax planning. A proper application of the GAR methodology limits the amount of uncertainty. Further, this uncertainty underlines the obligation of the minister who wishes to overcome the countervailing obligations of consistency and predictability to demonstrate clearly the abuse he alleges.
Wow.
This is Copthorne.
Okay.
So it's predictability, certainty, and fairness.
Yeah.
The SEC...
I mean, we really should do a whole live stream on debate on whether those words have any meaning. Okay. Well, we'll see. If anybody's interested in our live stream ever, then we'll get into these things. It could just be us. You never know. It could just be us that's interested in this.
Maybe we're just doing this conversation.
We are, yeah.
Just ourselves.
We are just having our conversation, this conversation by ourselves.
Yeah.
But the question is, like, whether anybody will click on the link and listen to the video, because, like, afterwards, you know?
Yeah.
That's the
maybe.
question. We'll see.
The
Hey,
SEC
if not, has that ever stopped us?
No, it's fun. We're thinking about this. We're debating.
We're debating. All right, so...
The SEC has set out 3 steps to be followed in determining the applicability of the GAR. Those steps consist in ascertaining, 1, whether there is a tax benefit arising from a transaction under subsections 245.1 and 2, whether the transaction is an avoidance transaction under subsection 245.3 in the sense of not being arranged primarily for bona fide.
So I say bona fide.
Bona fide.
But that's not very Canadian of me. I'm pretty sure here people say bona fide. Bona fide.
It's like the question, is it the jure control or the jure?
Yeah, I would say de jure.
I would say the jure.
Exactly.
It's Latin.
I understand, yes. I learned Latin in a classroom that didn't use that pronunciation. Okay.
Okay, so it's going to be bona fide.
Yeah, but I think you should say it the way that you would normally say it. Like, you would say it kind of in a French accent. Yeah. So how would you say that?
Bona fide.
Yeah, okay, perfect. We'll follow your lead.
Could do Italian accent. Bona fide.
You could. It's more interesting, but yes, okay.
But it's Latin.
So it's the root for all of our...
Yeah.
Yeah.
So arranged primarily for bona fide purposes other than to obtain the tax benefit. And 3, whether the avoidance transaction is abusive under subsection 245.4.
Okay, so in my view, I really don't like it when courts say that the court has set this out. This is the statutory test. It's not a test that the Supreme Court made up. It's a statutory test, and these are the 3 steps in the test. I mean... Yeah. It's just like where Shell is like, let me explain to you when interest is deductible, and they're reading you the statute. This is not common law.
It's statutory provision.
Yeah, exactly. So I don't know why the SEC has set out 3 steps. I mean, that's not, but okay. We have to accept it. This is how it is.
If there is more than one tax benefit, the court conducts a GAR analysis for each tax benefit.
Okay, I've never seen this before. So if there's more than one tax benefit,
you do more than one test.
Okay.
According to Lipson.
Oh, Yeah, see?
Now it's not moving like that. It's moving like that.
Okay, I'm gonna see if that little triangle would potentially, hold it in place. Let's see.
But I think if
You're absolutely right. It needs the counterweight.
if you just put an ITA
Yeah, but like,
on the tripod,
but if you put an ITA on the
yeah,
tripod, that's not gonna hold the thing, is it?
I think it's gonna hold the thing because it's like putting a sandbag
Oh, on the tripod.
on the
leg?
tripod. Yeah, on the leg.
Okay, I'll try that as well. Continue. Just keep reading. I'll be right with you.
Okay, if there is more than one, okay, that I read that. We are at 17. All three requirements must be fulfilled. The burden is on the taxpayer to refute 1 and 2, and on the minister to establish 3. The SCC has recognized that the line between legitimate tax minimization and abusive tax avoidance is far from bright. If the existence of abusive tax avoidance is unclear, the benefit of the doubt goes to the taxpayer. So the first question is, was there a tax benefit? So we're doing all the tests. During the relevant period, the definition of tax benefit in subsection 245.1 read as follows. Tax benefit means a reduction, avoidance, or deferral of tax or other amount payable under this act, or an increase in a refund of tax or other amount under this act, and includes a reduction, avoidance, or deferral of tax or other amount that would be payable under this act, but for a tax treaty, or an increase in a refund of tax or other amount under this act as a result of a tax treaty. Whether a tax benefit exists is a question of fact. When determining whether a tax benefit exists, the magnitude of the tax benefit is irrelevant. The determination may require the comparison of the taxpayer's situation with an alternative arrangement. When assessing the appellant, the minister assumed that the appellant had received a tax benefit as a result of Section 123.3 not being applicable and Section 123.4 being applicable in the appellant's 2016 taxation year. The appellant, in paragraph 28 of the agreed statement of facts, concedes these two tax benefits. The respondent did not argue that the appellant received any other tax benefits. The position of the appellant and the respondent is consistent with the facts before me. Therefore, I accept the parties' position that the only tax benefits realized by the appellant from the transactions at issue arose as a result of Section 123.3 not being applicable and Section 123.4 being applicable in the appellant's 2016 taxation year. Paragraph 29 of the agreed statement of facts states that the quantum of the tax benefit realized by the appellant is computing in accordance with the chart as Appendix B of the agreed statement of facts. The chart is attached as Appendix B to these reasons for judgment. Okay, so how much tax are we talking about?
$2.5 million of taxable capital gain.
Okay. We have a little bit of other.
Oh, okay. So we have. Oh, let me keep. Okay, where are you? Appendix, page 55. Let's take a look.
Okay, so as filed.
Hang on, wait, just a sec. I gotta get there. Page 55. Appendix B.
Here we are, Appendix B.
Okay, good. So what do we see?
So the taxable capital gain is 1.17 million.
Yeah.
We have other income for roughly 39.5 thousand.
Okay.
Taxable income of 1.14 million.
Okay.
So the general rate is 38%.
Yep.
Section 123, 433,000.
Yep.
We have the federal abatement, 10%.
Abatement.
Abatement, sorry.
Yeah.
114,000. So, and as filed, there was the general rate reduction of 148,000. So the tax payable,
I see. Yeah.
as filed, is $171,000. And now the minister says, we assess you the refundable tax.
Yeah.
$91,003.
Okay. It's
And
not that much, really.
we deny the general rate reduction. So the total taxes payable, according to the minister, was $410,000.
Okay, so it's not
The difference is not major.
Say it again.
It's not a major difference if
It's,
you look at it.
it's more the principle of the thing, is my guess. Yeah.
It's not like we avoided $1 million.
No, it's like
It's roughly
200. Yeah.
240,000.
230. Yeah, 230. Yeah,
230,000.
yes, right. Not that much.
I'm guessing
Not
it's
enough
not
to get upset
I'm
about.
guessing it's not the only taxpayer having
Yeah.
done this plan.
No,
though.
I think that's right.
Okay, so were the transactions at issue avoidance transactions? So let's go back to paragraph 23.
23. Oh, so much. Okay. Okay, so now we're into the first step of the. So they've told us
There's a tax benefit.
if there's a tax benefit. So we're into step 2. So whether there's a tax benefit was 1. Whether the transaction is avoidance, we're on to 2. Here we go. Okay, wait. So there was a tax benefit because why? Because you didn't have to pay the refundable dividend tax on hand.
Yeah, and you got the rate reduction.
And you got the rate reduction. So there's 2 tax benefits.
Yeah.
That's why they said the thing about we got to do the GAR twice.
But was there only one tax benefit?
Well, so that's the question. Is there
Because
1 tax benefit or 2 tax
The
benefits?
tax court says, therefore, I accept the party's position that the only tax benefits realized by the appellant from the transaction arose as a result of Section 123.3 not being applicable and Section 123.4 being applicable. So the only tax benefits is 2 things.
That feels like, well, I mean, I don't. Every tax dollar is a tax benefit, is it not?
Looks like it's both part of the same benefit because they go with one another.
Okay.
I'm not sure exactly what the argument was, but I feel like if you're not
Okay.
a CCPC, you get both, not the refundable tax and the rate reduction.
Okay.
Yeah. I mean, would you have to do the analysis for each? Like, was there a benefit for not paying the refundable tax, and was there a benefit to having the general rate reduction?
Right.
Because it's all
Right.
the cause of the benefit of both is are you a CCPC or not.
Yeah, exactly. Yeah.
It works
Yeah.
together.
Yeah, yeah, that's right.
Okay, avoidance transaction is defined in subsection 245.3 to mean any transaction. But for this section would result directly or indirectly in a tax benefit unless the transaction may reasonably be considered to have been undertaken or arranged primarily for bona fide purposes other than to obtain the tax benefit. Or B, that is part of a series of transactions, which series, but for this section, would result directly or indirectly in a tax benefit unless the transaction may reasonably be considered to have been undertaken or arranged primarily for bona fide purposes other than to obtain the tax benefit.
Yep.
The definition removes from the application of the GAR transactions or series of transactions that may reasonably be considered to have been undertaken or arranged primarily for non-tax purpose. As noted in Copthorne, an avoidance transaction may operate alone to produce a tax benefit, or may operate as part of a series of transactions which produces a tax benefit. Similar to the determination of whether a tax benefit exists, the determination of whether a transaction or a series of transactions is an avoidance transaction is a question of fact. If a transaction has both tax and non-tax purposes, then the GAR will not apply to the transaction if the non-tax purpose was primary. The SCC explained in Copthorne how one applies subsection 245.3 to a series of transactions as follows. Whereas here, the minister assumed that the tax benefit resulted from a series of transactions rather than a single transaction, it is necessary to determine if there was a series, which transactions make up the series, and whether a tax benefit resulted from the series. If there is a series that results, directly or indirectly, in a tax benefit, it will be cut by section 245.3, subsection S.
I think you're channeling the SCC there pretty well. Good.
Yeah. Unless a transaction within the series could reasonably be considered to have been undertaken or arranged primarily for bona fide purposes, other than to obtain tax benefit. If in a transaction within the series is undertaken primarily for a bona fide non-tax purpose, that transaction will be an avoidance transaction.
Okay.
When applying the GAR, the minister treated the rollover of the Soberling shares from Jackal to the appellant and the continuance of the appellant into the British Virgin Islands on April 29, 2015 as avoidance transactions.
Okay.
The appellant concedes at paragraph 30 of the agreed statement of facts that the two transactions were avoidance transactions.
Okay, that's pretty common, right? Like often the taxpayer will be like, yes, I did this to avoid tax. I'm allowed to avoid tax. See the Duke. Dum, dum,
Yeah.
dum.
And also, I mean, the first two in the test, it's up to the taxpayer to refute it. So
Right.
it's harder to say there was no tax benefit and there was no avoidance transaction.
Right.
It's easier to just agree that there was.
And just argue the abuse. Yeah.
I mean, what would be the counter argument on the avoidance transaction? Was there a real reason, a commercial reason to go in BVI?
Yeah, you'd need some reason, and
Yeah.
there isn't one.
Maybe I wanted to start a hotel in BVI.
But you didn't.
No, but me, I wanted to.
I wanted to. It's in your heart. It was in your heart.
I really
all
wanted
along.
to, and unfortunately, well,
It just didn't work out.
yeah.
Because I didn't pursue any opportunity. Anyway, yes. I'm with you, yes.
But I had some thoughts about it.
It's good. People should have thoughts. It's nice to have thoughts.
But you need to show it which was primary. The primary reason
was bona fide.
Yeah.
Something other than tax. Okay.
On the basis of the facts before me, I accept that the two transactions are the only avoidance
Are
transactions.
the only avoidance. Okay. All right.
Okay. As the SCC noted in Alta Energy, citing Canada Trustco and Lipson, tax avoidance is not tax evasion.
Okay. Thank you. Thank you. Thank you.
Thank you
That's-
for reminding us that if you do tax avoidance, you will not go to jail. Thank you.
This is so annoying. Okay.
Further,
All right.
tax avoidance should not be conflated with abuse, even if a transaction was designed for a tax avoidance purpose and not for a bona fide non-tax purpose, such as an economic or commercial purpose. It does not mean that it is necessarily abusive within the meaning of the GAR. Yeah, you are allowed to avoid tax as long as it's not an abuse.
Yeah.
Sounds good.
Yeah.
Sounds right.
I mean, the fact that that the court has to say this and that it has to be repeated, it just like, okay, I think we know that, but okay.
I mean, it was clear from Canada Trustco.
Yeah.
Yeah. The GAR will only apply if the avoidance transaction is found to be abusive. As stated by the SCC,
Like, how many times you have to say the same thing? I swear I could edit this thing down by at least 3 paragraphs at this point. This whole section should have been, is it avoidance? The parties agreed that it was.
I mean, why do you need...
You don't need to do this.
I don't know. I mean,
You don't
we
need to
spent
do
like
this.
20
You could've
paragraphs
just
on...
saved it.
The
first
parties
2
agreed.
Yeah. The first, exactly. So you have in the agreed statement of facts, they agree it was, there was a benefit. Do they agree there was, no, they agreed there was a tax avoidance. So
I think
you
they
have to
agreed that
establish the benefit.
They agreed there was a benefit. Didn't they?
I mean, you have to say that it's a benefit
I
as a matter of
accept
law.
the party's position that the only tax benefit realized by the appellant issued as a result of
Yeah.
120.3 being applicable.
Okay. I mean, I feel like, is there some reason that you couldn't have just said the law? As to the first 2 tests, or whatever, the steps, the parties agree. Let's move on to the third.
And finally, as stated by the SCC, a finding that the bona fide non-tax purpose is lacking, taken alone, should not be considered conclusive evidence of abusive tax avoidance.
Yeah.
Yes, I
Fine.
mean, of course.
Yes. Yes, obviously. Thank you.
Obviously.
Thank you. Thank you, court.
Thank you for reminding us.
I mean, I suppose if it was your first tax case ever, this is like news to you, or this is useful information, and so they try to, remind us. So then the only question that really matters here is whether they're abusive.
and see how the section is at the end of the page?
Yeah, but on mine it's not.
Yeah, but I have the PDF version.
Yeah, I don't know why. Yeah, strange.
Are the avoidance transactions abusive under subsection 245.4?
Okay.
Subsection.
Now you get to read the whole.
Oh no. Subsection 245.4 reads as follows. Subsection 2 applies to a transaction only if it may reasonably be considered that the transaction A would, if this act were read without reference to this section, result directly or indirectly in the misuse, in bold, of the provisions of any one or more of little I this act, 2 little i's the income tax regulations, 3 little i's the income tax application rules, 4 little i's a tax treaty, or 5 little i's, which is no longer little i's, but any other enactment that is relevant in computing tax, or any other amount payable by or refundable to a person under this act, or in determining any amount that is relevant for the purposes of that computation, or B, would result directly or indirectly in an abuse, in italic this time, having regard to those provisions other than this section read as a whole.
Emphasis added. So we added bold as one emphasis and italics as another emphasis. Like, come on. Okay.
And also the names are in italic, so you don't know.
Exactly. You don't know.
Maybe abuse is the name of the act, another act.
Yeah.
I don't know.
It's not great. But also, you didn't need to do that whole thing, but it's okay. I actually appreciate that the courts include the full text. I really do appreciate it, even though, you know, in this case, we didn't need, like, it doesn't matter whether a tax treaty, it doesn't matter. It's not relevant here. We're talking about the act. Yeah. But I still appreciate that they do it because the act changes, and in this case, the GAR has changed. So we are dealing with the old GAR, and I like to see the whole thing. So.
I like when the provisions are there because sometimes the decision is about a provision that is no longer in the act, for example. Yeah. And you're like, okay, what the provision is. And you're in the bus, you're reading a case, and you're like, okay, let's look at the provision. And you're like, where are they?
Right.
And you don't know. And you open you open TaxNet Pro on your phone.
And you're like trying to find the right version of it, and it's a pain. Yeah, right. Okay, so kudos to the tax court for including the provision. Thank you very much.
Yeah, thank you for that. We thank you.
We thank you, tax court, Mr.
Justice
Darcy.
Justice Darcy. Thank you. Although subsection 245.4 refers to determinations of 245.4.
Okay, yep.
Refers to determinations of misuse in bold and abuse in italic. The SCC has made it clear that there is no distinction between an abuse and a misuse. Yeah. Oh, that's why. That's why. To do something different because it's the same word.
I thought Parliament didn't legislate in vain.
Except when they do.
Yeah.
The SCC has stated the following. Section 245.4 requires a single unified approach to the textual, contextual, and purposive interpretation of the specific provisions of the Income Tax Act that are relied upon by the taxpayer in order to determine whether there was abusive tax avoidance. As a result, I will only use the term abuse.
You're like a one-person play act going on here. Very nice.
The determination of whether a transaction is an abuse or a misuse, I guess. We're just saying abuse.
So we're just using abuse to mean both abuse and misuse. So anytime you want to shorten it, you can just say CF DAC Investment Holding TCC paragraph 33.
In an abuse of the act involves the following 2 steps.
Okay, so now we're at step 3, determining abuse, and now we get 2 steps in this step 3. So substep 1 and substep 2. Here we go.
I mean, are there really 3 steps?
Or really 5?
Or 4?
Don't know. Okay.
I don't know anymore.
Yeah, I don't know. Okay.
I must first determine the object, spirit, and purpose of the provisions of the Income Tax Act that are relied on for the tax benefit, having regard to the scheme of the Act, the relevant provisions, and permissible extrinsic aids.
Okay.
And 2, once this step is completed, I will examine the factual context of the case in order to determine whether the avoidance transaction defeated or frustrated the object, spirit, or purpose of the provision in issue.
Okay, and he's citing Canada Trust Code for that. And see also Cawthorne and Dean's Knight. Okay.
I mean, they all say exactly the same thing for
that. You first figure out the object, spirit, and then you apply it. So you first figure out what the law is, and then you apply it. Revolutionary.
Shocking.
Really shocking. Really, I had no idea that this was how.
Strikingly, this is the test defined by the Supreme Court.
I mean, come on. I mean, it's weird, right? Like to be so obvious. I just don't understand. Like it's almost an educational role that the tax court is playing here, And it's sort of lulling you into this, like, okay, and this is how I'm going to do it. And it's all going to seem like rational. And then they're going to actually do it. And you're going to be like, what's going on?
And it's like, okay, so the test is there an avoidance transaction?
Yeah.
And is it abusive?
Right.
And to determine whether it's an abuse or not, you have to determine what the law is and then
apply it.
Apply the law.
Yeah. So in this case, the object, spirit, purpose, which may or may not be the three exactly the same things. And then after you determine what it is, see if what the thing you did frustrates or defeats the object or the spirit or the purpose. I would love to see a court case that just focused on spirit. What's the spirit of the law? I would like to know.
Spirit of the act?
Yeah.
I've never met the spirit of the act.
No, I've never met him either. Yeah. Him or her or it.
I think the object, spirit, and purpose of a provision really is the tax policy of the provision.
Yeah. The reason that it's in the act.
Yeah.
Yeah, I agree. All right. So how are you doing reading? You doing okay?
Sure.
I can read a little bit if you get tired.
Oh,
I prefer if you kept reading, but...
Well, I have some SCC coming, and I love doing this.
I know you love to, yeah. So, okay, well, we could do this. I can read the parts here, and then you could do that. It's up to you. Like, if you're good with it, keep going.
No, I can keep
It's just a lot.
going a bit.
Okay, keep going. Excellent.
One uses a unified textual, contextual, and purposive approach to identify the object, spirit, or purpose of the relevant provisions. It is the same interpretive approach as that employed by the courts in all matters of statutory interpretation. However, as the SCC noted in Copthorne, the analysis seeks a different result. In a traditional statutory interpretation approach, the court applies a textual, contextual, and purposive analysis to determine what the words of the statute mean. In a GAR analysis, the textual, contextual, and purposive analysis is employed to determine the object, spirit, or purpose of a provision. Here, the meaning of the words of the statute may be clear enough. The search is for the rationale. I get it?
Yeah, you got it.
Ooh.
Nice.
That underlies the word that may not be captured by the bare meaning of the words themselves. Bare meaning.
Yeah.
However, determining the rationale of the relevant provisions of the Act should not be conflated with a value judgment of what is right or wrong, nor with theories about what tax law ought to be or ought to do. Okay.
So they're trying to steer us away from a moral...
I mean, we're still doing an interpretation of the text, of what is in the Act. We cannot just set the Act aside and say, I think it should say that, but it does not, so let's pretend it says what I think it says.
Right, that's the danger. The danger is that a judge who doesn't like the taxpayer, to be like, naughty taxpayer, I'm going to interpret the law the way I wish it was written, instead of the way that it is written.
Yeah.
Yeah. Sorry, I got too comfortable and forgot we were on.
We're just having a discussion here.
I forgot. Okay. I think what I have to do, I will say, just production notes, I think it might be easier if I was sitting looking at you. It might be a little easier.
Right.
And so maybe I'm going to just get another webcam and we'll just do 2 webcams next time so that we can look across at each other.
Podcast.
Yeah,
the table in the middle and the camera there. So we're just talking to each other.
Yeah, it might be a little
that's
easier.
Better. Because now it's
I
like...
actually could bring a little round table in. Yeah, exactly.
But we don't need a round table. We just need this because this is like...
Yeah, it's true.
2 parts.
Yeah. Anyway.
Let's keep going. The SCC... and emphasis added, sorry. The search for the rationale underlies the word may not be captured by the bare meaning of the words themselves.
It makes me wish I had my bear mask. I think it's up there somewhere. Anyway, the bare meaning. Okay, okay. Not that kind of bear. Anyway, yes.
The SCC confirmed this approach in Dean's Night, emphasizing the rationale of the provision.
You're doing really good with the rationale, by the way. You nailed it.
Every time I see the word, I'm sweating.
I know. All you have to do is just stay French when you see it. Just stay French.
Rationale. It's like rational. La rationale.
Exactly.
La rationale de la provision.
Exactly. Just be who you are instead of being your English persona. You switch to the French persona.
That's a really French kind of
I
sentence.
know, it is, but it is the French word.
But the whole thing, like, en emphasant ça, d'emphase, en mettant l'emphase sur la rationale de la disposition.
Yeah. So it flows so much better en français.
It noted the following.
Okay, I'm ready.
This is Dean's Night.
Yeah. So it's Justice Rowe.
Rogue, yeah. I will not do it.
Don't do Don't do it.
The object, spirit, and purpose analysis has a precise function to discern the underlying rationale of the provisions. A consideration of the text, context, and purpose gives structure to this analysis. Indeed, the object, spirit, and purpose analysis should not turn into a value judgment of what is right or wrong, what tax law ought to be or ought to do, nor should it become a search for an overriding policy of the Act that is not founded in the text, context, and purpose of the provisions. Rather, a focus on the provisions text, context, and purpose ensures that the intrinsic and extrinsic evidence used to discern the provision's rationale remains tied to the provision itself.
Okay, so intrinsic and extrinsic evidence. Intrinsic meaning text-based, I assume, and extrinsic meaning whatever you can bring to the context.
Like technical notes,
Exactly.
the Hansard, etc.
History, yeah.
History, context.
Things people say, yes. Okay.
What is it? External context?
Yeah.
Like intrinsic would be internal context, and extrinsic would
Yeah,
be
so
external
actually
context.
that's interesting. So is another provision of the Act internal or external?
Internal, I think.
Yeah, I don't know.
Because I think you have 6. You have like the first 3, the major ones.
Okay.
Text, context, internal
Right,
context,
yeah.
and object. And then you have like external context, which could be other legislation, or you could look at like technical notes,
Yeah.
parliament debates,
Yeah,
administrative positions, case law.
yeah.
You have like the first 3 major, and then if that doesn't help, you can look at the other.
Yeah.
And all the trial texts all give a different name to all those arguments that you can bring to court.
Right, exactly, yeah. Yeah.
Yeah.
Okay. Okay, so we have the object spirit being articulate. Oh, wait, sorry. We have the Dean's Night, no, Copthorne, search for the rationale that underlies not captured by the bare meaning of the words themselves, which is a claim about plain. I think when they say bare meaning, they mean plain meaning. I hope that's what they mean, which itself is not that straightforward. I mean, it's a bit of a mess, I will say.
But the problem with interpretation is that we want to go outside this idea of a textual interpretation, but it must be grounded in the text.
Right.
So it's still a textual interpretation. The fact that you're adding context and purpose doesn't mean you're no longer doing a textual interpretation.
I know it's a little strange to me. The entire project is a little strange because they're saying the search for the rationale might not be captured by the quote unquote bare meaning. There is no bare meaning. There is no single meaning. Like it's just like absurd. The idea is, there is a plain meaning, and I don't have to look at context. I can just look at the bare meaning, and we all know that that's not accurate.
It's never simple when you do the interpretation. If you read a piece of legislation without context, you may think it's simple, but you add facts, and then it's no longer as simple as it seemed.
Yeah.
So there was never a bare meaning.
That's right. Right.
I think.
Right. Agreed. Okay, so but then confirmed in Dean's Night, with nothing emphasized here, just like talking about not value judgments. So we're worried about,
We're worried about a judge saying,
yeah,
I don't like the law, I don't
Yeah.
like the taxpayer, so let's do something that sounds fair.
yeah. There's just a worry of overreach, which has never been a problem in Canadian courts,
I don't think it has.
as far as I can tell. Although I'm sure taxpayers feel differently.
Well,
Right. I mean, it depends on the context. Like, you're going to feel like, yeah. Anyway, okay, so paragraph 37 of 543 paragraphs. Actually, how many paragraphs do we have?
234.
Yeah, yeah. So we have 200 to go. We're going to do it. We can
Let's
do
go
it.
fast.
Yeah.
When determining the
not
object, spirit, and
fast. No,
purpose of a
we just-
provision, the court refers to the provision itself. The scheme of the act and purpose of it specificates.
No.
As noted in Cop Thorne Dean's non-compliance with the text of the
Wait, when you
provision.
go too fast, then I don't get any of it. Okay. When determining, the court refers to the provision, the scheme of the act.
Scheme of the act,
Okay.
which is not the same as the spirit.
Apparently not. Apparently it's something else.
As noted in Cop Thorne Dean's compliance with the text of the relevant provisions is not the issue before the court. The minister would not have to rely on the GAR if the tax benefit of the transaction or series of transactions was prohibited by the text of the relevant provisions. Again, this is
Yeah.
common knowledge.
Yeah.
Dean's Knight refers to the wording of a provision as the means to give effect to the rationale behind the provision. The words are primarily a means of giving effect to Parliament's aim rather than a complete encapsulation of the aim itself. The SCC noted that the means do not necessarily provide a full answer as to why the provision was adopted. As my colleague Justice Owen noted in Husky Energy, the SCC is emphasizing that the means by which a provision achieves a particular objective will not always fully capture why Parliament enacted the provision. In short, as the SCC noted in its previous decisions on the GAR, the text of the provision is not determinative of the provision's rationale.
Okay, so why is he citing his colleague, Justice Owen? What are we adding here? Means not provide a full as to why adopted as my colleague noted. Means will not always be fully capture why Parliament enacted the provision. In short, the text is not determined. I mean, I feel like we're just saying the same thing over and over. Yeah?
I feel that since we started this section,
We've just been saying
It's
the
all
same
the
thing
same
over and
idea.
over. Okay.
the object, spirit, and purpose of the provisions in question should be articulated as a concise description of the provision's rationale. The Supreme Court again. The object, spirit, and purpose of a provision must be worded as a description of its rationale. Copthorne. When articulating the object, spirit, and purpose of a provision, a court is not repeating the test for the provision, nor is it crafting a new secondary test that will apply to avoidance transactions. Discerning the object, spirit, and purpose does not rewrite the provision. Rather, the court merely takes a step back to formulate a concise description of the rationale underlying the provision against which a textually compliant transaction must be scrutinized. I've noticed sometimes it's object, spirit, and purpose, and sometimes it's object, spirit, or purpose.
Yeah, I know. Yeah.
Is it the
Is it
same?
all three,
is it like
or is it
to-
one of the? Yeah, I know.
Can you
yeah.
just get the spirit without the object?
I don't know. It's very metaphysical.
Could you say like the object of the act is X, but the spirit is Y?
The object is X, but the spirit is Y. Yeah, sure. Good luck. Good luck with.
Good
Sure.
luck arguing this.
Yeah, I think it's hard. I think it's really hard.
And again, I have
Yeah.
a title at the very bottom of the page.
Yeah, it's somebody didn't check the or maybe they just don't care.
Just do like
Yeah.
like a page, a new page. Start title on a new page.
There's a thing like a setting you can put in Microsoft Word to prevent. I think they call it widows and orphans, or to keep lines together. Either one of those would have done the trick, but that's asking a lot.
Also, I'm a bit annoyed by the fact that all these titles should go under the main title, which is the abuse.
Yeah,
So we should have like a space.
I know. Yeah,
This is why when you use Word, use the outline.
function
The outline function is great for you.
And then,
You will
yeah.
see it.
formatting.
Yeah.
Formatting with word styles. Yeah,
In outline.
yeah, it
Use
helps.
this outline. Don't know why.
I don't know.
It's the best tool.
Yeah.
The respondent argues at paragraph 19 of his written submissions that the appellant abused the following 5 provisions of the Act. Subsection 255.
5 provisions. Okay.
5. Not
Didn't
one.
we agree above that there were just 2 that the people agreed on? Oh, I'm saying
There was
there's
two
2 they agreed
benefit
on.
that
benefits.
derive
Okay,
from
okay.
5 provisions.
Okay. Yep.
Subsection 255.1, which applies when a corporation is continued in jurisdiction.
Yeah.
The definition of a CCPC in subsection 125.7.
Yeah.
I think this is, it's kind of interesting that you can abuse a definition.
Yeah.
The definition of a Canadian corporation in subsection 89.1, section 123.3, which levies a refundable tax on certain investment income of a CCPC, and the portion of the definition of full rate taxable income included in subparagraph 123.41B3 relies. The definition of full rate taxable income is used to determine the amount of the taxable income of a corporation that is eligible for the 13% rate reduction provided for in subsection 123.42.
Okay, so
Ooh.
So we got to do the OSP of each of these.
Yep.
Great.
The OSP of the definition is to define.
I bet you're right. I guess you're probably right. Let's find out.
It would be crazy if the spirit of the definition is to define.
Let's find out.
Let's find out. I will now turn to the object, spirit, and purpose of each of these provisions. I will begin by considering the text of each of these provisions. While, as just discussed, the text is not determinative of the object, spirit, or purpose of a provision, it is relevant. The text helps the court determine what the provision was intended to do. When determining the object, spirit, and purpose, sometimes it's
I know. Yeah. In the same paragraph.
Considering what the text of the provision expressly permits or restricts may be relevant in determining what the provision was intended to do. In addition, the text can help to identify the nature or type of provision at issue, which can be relevant to understanding the rationale underlying it.
Okay.
After considering the text of a provision or provisions, I will consider the context and purpose of the provision or provisions at issue. At paragraph 91, Copthorne provides the following guidance on the contextual analysis. The SCC in Copthorne provided the following guidance.
Yeah.
The consideration of context involved the examination of other provisions of the Act, as well as permissible extrinsic aids. However, not every other section of the Act will be relevant to understanding the context of the provision at issue. Rather, relevant provisions are related because they are grouped together or because they work together to give effect to a plausible and coherent plan.
Shout out to Ruth Sullivan.
Oh, Ruth Sullivan.
Nice, yeah.
What did we just learn? I feel it's just the same again.
It's an argument. It's about to be an argument about which provisions do I have to look at. Like, how do I know when I'm... And I mean, it's a classic problem. How do I know when I've read enough to know what I'm reading? So this one is saying, okay, like, is section 2 relevant here? Maybe it's not mentioned, but it's probably relevant because it's defining taxpayers. Is section 3 relevant? Maybe to the extent it defines income from a source, and we're talking about source. You know what I mean? Like, but you could go too broad. Like, oh, you're going too far. That's too far. We got to like get a little closer to. That's
kind of, you cannot understand the Act without reading the Act.
Yeah.
Like the whole thing.
Right.
Because they all work together.
Yeah, so this is a problem for the Tax Act in particular, that it's too big and too sprawling.
Yep. So
when they're trying to interpret what corporation, what's the object, spirit, and purpose of Canadian corporation, like, should I start with section 1? Or what?
I don't know.
Right.
Maybe I want to look at other tax statutes. Maybe I want to look at the Excise Tax
Yeah, what about
Act.
the Excise Tax Act?
Maybe it's relevant. I don't know.
Yeah, exactly.
As noted in Deeds Night, okay, I feel like this is a paper where you just put everything you've read.
Yeah. Oh man, this feels a little stream of consciousness. Yes, it does. It does feel like that. Yeah.
It's like, at the beginning we were like, okay, we've read Dean's Night, we've read Copthorne, Lipson, Trusco, and Outer Energy.
And now you can believe us because we're going to tell you.
We're going to tell you we read those cases.
We're going to sprinkle it all over the yes. That is right. That's what's happening.
As noted in Dean's Night, the focus is on the relationship between the provision alleged to have been abused and the particular scheme within which it operates.
Okay.
The context can serve to identify the function of the provision within a coherent scheme.
Okay.
Why do we care about the function, though?
Context and function of the provision. Well, I guess I would say it's like, well, what's this tool supposed to do? in order to see what the tool does, then I'm going to say why I gave you that tool.
Okay.
So what does a hammer do? It hammers nails. Why would I give you a hammer to build a house? Or to build something? And not to,
not to knock
fix a
someone.
car. Yeah. we had very different ideas of what not to do with a hammer. But yes, both are correct.
Well, you could fix a car with a hammer.
Well, I know, but it's not ideal.
No,
it's not what it's meant
if you have
for.
a dent,
You can, but that's the point. You could have a hammer. You could use it to do lots of things. But the point is that why I gave you the hammer? I'm Parliament. I gave you this tool. Is that why I gave it to you? No, I don't know why I gave it, and that's why they're trying to make a distinction.
I give you a hammer so you can build things. If you're using a hammer to fix a dent in your car, it's not the purpose of the hammer.
Right.
But it's not.
I don't know
it's
if
not
you've
an abuse.
abused.
It works. It's fine.
It's fine.
You're not abusing.
Maybe.
But if you're knocking someone with the hammer, maybe you're abusing the hammer.
Yeah. Yes. Okay. Fair enough.
So I was
good.
able to mix the car
good
and
job.
the knock someone
You did a
example.
good job. You did a good job.
This is not scripted, by the way.
Can you tell? Okay. So where are we? So that's
46.
46. Okay.
With respect to purpose, Dean's Knights notes the understanding.
Okay, so this is important. By the way, this is an important piece of this because in the FCA, we're going to see a little discussion about whether the tax court did this right. The function and the purpose thing. Okay.
Dean's Knight notes that understanding the provision's purpose is central to the GAR analysis. The provision's purpose can help to discern the outcome that Parliament sought to achieve or prevent.
Is that not the same? Okay. Could you not have written that sentence? The provision's purpose is the outcome that Parliament sought to achieve or prevent. Is that not the purpose? Okay.
Yeah.
So it's not going to help me discern it. It is the thing I'm trying to discern, is it not?
Yeah.
Okay.
The SEC explains the purposive analysis at paragraph 68 as follows. At paragraph 68 of what? Okay, Dean's Knight. A purposive analysis permits courts to consider legislative history and extrinsic evidence.
Shout out to
See
Ruth Sullivan.
Ruth Sullivan at
Yeah.
SS 9.03. How do you say that?
The little thing is just a section symbol, so it's called section, yeah.
Section, okay.
Yeah.
These materials provide insight into the rationale for a specific provision, Of course, tax provisions can serve a variety of independent and interlocking purposes. Nevertheless, such provisions are intended to promote particular aims, and courts must therefore determine what outcome Parliament sought to achieve through the specific provision or provisions. I like how the court is saying something. It's like, by the way, the Supreme Court agrees. I did not just make it up.
I didn't just make it up. I have a cite, and the Supreme Court cited Ruth Sullivan, so it must be right.
Yep.
Yeah.
Similar to how one can understand the purpose of the section at issues in Dean's Knight, one can only understand the purpose of the sections at issue in this appeal
I wish they would say use the French term provision. Use the purpose of the provision at issue because section is not quite right.
It's
It was a subset, exactly.
It's the definitions.
Exactly. Yeah. So but anyway, the purpose of the sections at issue. Yep.
In this appeal, by considering the function that they play in the larger scheme of computing the tax payable by corporations, in particular, how the Act taxes private corporations that are CCPCs and private corporations that are not CCPCs. I will first consider the two definitions at issue, the definition of a CCPC and the definition of a Canadian corporation. I will then consider each of the three other sections that are at issue in this appeal.
Okay.
Object, spirit, and purpose of the definitions of CCPC and Canadian corporation. In addition to addressing the definitions of a CCPC and a Canadian corporation, I will also discuss the definition of a private corporation, since a corporation must be a private corporation before it can be a CCPC. Further, taxation of private corporations that are not CCPCs is relevant when determining the object, spirit, and purpose of the definition of CCPC and Canadian corporation.
Okay.
Subsection 248.1 states that for the purposes of the Act, CCPC has the meaning assigned by subsection 125.7. Section 125.7 defines CCPC as follows.
Holy moly.
In this section, ... Canadian-controlled private corporations means a private corporation that is a Canadian corporation other than. So we have like
Wait,
a
I know. It's
CCPC
like,
is private and Canadian, but not the following. So A, it's not a corporation controlled directly or indirectly in any manner whatever by one or more non-resident persons, by one or more public corporations other than the prescribed venture capital corporation,
okay.
by one or more corporation described in paragraph C, or by any combination of them. So if you are Canadian controlled, you cannot be controlled by a non-Canadian.
Correct.
But you don't have to be controlled by Canadians.
You don't have to be controlled by Canadians, but you cannot be controlled by non-Canadians. Yeah. Wait.
So it can be 50-50. If it's 50-50,
okay,
it's fine.
Right, okay.
50 Canadian, 50
yeah.
American.
Yeah.
That's fine.
Yeah.
As long as it's not 49-51.
Okay. And same for public corporations. So you can have public corporation ownership.
50-50.
50-50, but not more. And other than a prescribed venture capital or by a bunch of corporations that are...
So basically, it's not Canadian-controlled private corporation. It's non-resident control.
Not control.
And not public corporation.
Okay. I got it. Yep.
A corporation that would, if each share of the capital stock of a corporation that is owned by a non-resident person, by a public corporation, other than a prescribed venture capital corporation, or by a corporation described in paragraph C, were owned by a particular person, be controlled by the particular person. A corporation, a class of the shares of the capital stock of which is listed on the designated stock exchange, or D. Why do you need C?
Yeah, I know. Like so I was wondering that because it says publicly, what is it? Public corporation, and then listed on a designated stock exchange. Is that not the definition of a public corporation?
Yeah, I mean, if you're a private corporation, how can you be listed?
You cannot.
Well, it's there, so there must be a reason. Because Parliament does not speak in vain. Except when it does. In applying subsection 1, paragraphs 87 VV and WW, which is a different section than 87 W, like in the sense of two U's.
Right.
Here it's WW, which is technically UUUU.
Okay.
So paragraph 27, 2 VV and UUUU, including for greater certainty in applying those paragraphs as provided under paragraph 88(1)(e)(2), the definition, excessive eligible dividend designation, general rate income pool, and low rate income pool in subsection 89(1) and subsection 89(4) to 6, 8 to 10, and 249 3.1, a corporation that has made an election under subsection 89(11) that has not revoked the election under subsection 89(12).
Wow. I bet there's something really interesting in that paragraph, but I don't know what it is.
I think we don't really have to go further because we all know what 87.2, UUUU, 89.4, 6, 8 to 10, and 249 3.1 stands for. It's all part of a very intricate and relevant provision of the Act. It's the scheme about excessive eligible dividend designation.
Yeah, it's for integration, right?
It's all for integration.
Yeah, dividend integration.
Yeah. And you cannot basically if you send to a shareholder a dividend and you say it's a low rate dividend but it's not, then you get consequences.
Happen to you? So what is it saying? It's saying that a CCPC means a private corporation that is a Canadian corporation other than one that has made some election
when you send
and not revoked it.
Yeah.
Okay.
Let's not go there.
It is pretty detailed. We don't need it here, but maybe someday there'll be a case that's dealing with it.
I remember what it is, but it's...
No, that's too much detail.
It's too much, yeah.
No, it hurts my head. I can't with all that. Anyway, suffice it to say, LRIP, GRIP, RDTOH, all of this stuff, it's like...
Yeah.
Yeah.
The problem when I don't know what the provision is, I'm going to read it.
I know. You want to go back. But we're not going to because what we know is that unless we have this election... in place, it doesn't matter to us. And none of our facts so far talk about that election being in place, so we just get to ignore that part of the statute for now. Yeah. And what we're looking for is a Canadian corporation that is not controlled by a non-resident person.
Yeah.
That we need a Canadian corporation that is not controlled by a non-resident person, and
But you must be a Canadian corporation.
yeah. Okay.
The definition states that CCPC means the words that follow.
Okay. Fine. Instead of includes.
Oh.
You know, because when you see corporation means, it doesn't say means, a corporation means, it just says incorporation includes associations, blah, blah, blah. So that's what it means. It says it's exclusive, not, or exhaustive, not,
Okay.
not open-ended.
As a result, the definition is exhaustive. Okay.
Yeah, it's like a closed definition,
perfect.
yeah.
The definition provides that in order for a corporation to be a CCPC, it must be both a private corporation and a Canadian corporation.
Okay. Breaking it down. So it has to be both private, can't be public, and Canadian. And now we're going to have to define both of these.
And both are defined.
Okay.
Private corporation is defined for the purposes of
I bet
the
it
Act
means not public.
in subsection 248.1 by reference to the meaning assigned by subsection 89.1. Subsection 89.1 defines private corporation as follows. Oh, that's long. It's not just
It's no, exactly.
Okay.
Yep.
Private corporation at any particular time means a corporation that at a particular time is resident in Canada, is not a public corporation,
Yep.
and is not controlled by one or more public corporations other than prescribed venture capital corporations. It's there everywhere.
Looks a lot like the same
venture
definition.
capital,
Yeah. Yeah.
or prescribed federal crown corporations,
Okay.
or by any combination thereof, and for greater certainty, for the purposes of determining at any particular time when a corporation last became a private corporation, a corporation that was a private corporation at the commencement of its 1972 taxation year,
Wow.
and thereafter, without interruption, until the particular time, shall be deemed to have last become a private corporation at the end of its 1971 taxation year, and B, a corporation incorporated after 1971 that was a private corporation at the time of its incorporation, and thereafter, without interruption, until the particular time shall be deemed to have last become a private corporation immediately before the time of its incorporation.
Yeah. Okay.
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 This definition applies at a point of time, in time. It provides that in order for a corporation to be a private corporation at a particular point in time, it must, at that particular point in time, be resident in Canada.
Yeah.
And not be a public corporation, and not be controlled by one or more public corporations, or prescribed federal crown corporations, or by any combination of these corporations.
Okay.
As will be discussed, the term private corporation is used throughout the Act when determining the taxation of corporations that are not public corporations. While the definition of a CCPC is one example of where the term is used, other examples include the provisions dealing with refundable Part 4 tax and the provisions dealing with capital dividends.
Okay.
A public corporation is defined for the purposes of the Act in subsection 248.1 and subsection 89.1. Generally speaking, it is a corporation that is resident in Canada and has a class of shares listed in the designated stock exchange.
Yeah. Okay.
Shocker.
Yeah, I
If
know.
you
There's a lot of
have
repetition here.
Stock on the stock exchange,
You're
you're
public.
no longer private.
You're not private.
Who would have thought, really?
I don't know, really. It's striking.
Striking, really. Subsection 248.1 states that for the purposes of the Act, Canadian corporation has the meaning assigned by subsection 89.1. Subsection 89.1 defines Canadian corporation as follows. Canadian corporation at any time means a corporation that is resident in Canada at that time and was A, incorporated in Canada, or B, resident in Canada throughout the period that began on June 18, 1971 and that ends at the time. And for greater certainty, a corporation formed at any particular time by the amalgamation or merger or by a plan or arrangement or other corporation reorganization in respect of two or more corporations, other than as a result of the acquisition of property by one corporation by another corporation, pursuant to the purchase of the property by the other corporation, or as a result of the distribution of the property to that other corporation on the winding up of the corporation, is a Canadian corporation because of paragraph A, only if C, that organization took place under the laws of Canada or province, and D, each of those corporations was immediately before the particular time a Canadian corporation.
Okay.
So in order to be Canadian, he must be incorporated in Canada.
I mean, it's a really basic rule for us.
And resident.
Or. It's one or the other. Incorporated or resident, and then with a bunch of...
No, it's that is resident in Canada and was incorporated in Canada.
A corporation that is resident in Canada and was incorporated or resident through a period and blah, 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 a bunch of stuff.
So if you were not incorporated in Canada but resident on June 18, 1971, you are a Canadian corporation. But if you were not incorporated in Canada in 2025, even though you're resident, you're no longer Canadian because you were not incorporated in Canada. So it's a and,
Yeah.
but there is an or test, but only for the corporations that were resident in 1971,
For some reason.
which must not be a lot of corporations. June 18, 1971. It's a very specific point in time. I'm wondering.
Well, like Bombardier.
Pretty sure it was incorporated in Canada. It must be a corporation that was not incorporated in Canada, but was resident of Canada on June 18, 1971.
Okay. Yeah, that must be a pretty small. But there must be something there, or they wouldn't have written this thing in there.
No, for sure there are some.
Okay, but the point is, you're Canadian if you're resident plus
Incorporated.
either incorporated or this
you were
other thing.
resident in 1971.
So in our case, resident and incorporated both. Okay.
So we need both. So even
We need
if
both,
you're resident, if you weren't incorporated under the laws of BVI, you were not a Canadian corporation.
Yeah. Interesting. Okay. Okay. So. Okay.
Yeah.
How you doing?
Which usually you don't want that, right?
I know. I know.
I mean, you don't want to incorporate in BVI to be resident in Canada.
Canada,
you just lose the benefit.
There was no point to it.
Yeah.
Exactly.
Except if you don't want to be a CCPC. But again, if I'm starting an investment business, if I'm incorporated a corporation today, my corporation will be a CCPC.
Yeah.
So I can just incorporate under BVI and I will never be a CCPC.
Yeah.
Is there a difference between I continue my existence in BVI or I create my corporation in BVI to avoid being a CCPC?
Good question.
Can the incorporation be an abuse of the law?
Right. Another case. Different case.
Yeah, let's do this and test it.
Why not? Good idea.
I don't know, we could ask the CRA through a technical interpretation.
Sure. I'm sure they get right on it.
Or maybe they should just join the podcast and give the answer.
Just get in here and explain things to people. Okay.
Can we have someone from CRA?
Right?
Okay, let's continue.
All right.
Under this definition, a corporation will be a Canadian corporation at any point in time. At the particular time.
At any time, if at the particular time, a corporation will be
at any time. If at a particular time, it is a resident of Canada and was incorporated in Canada.
Okay.
Because of the definitions of private corporation and Canadian corporation, in order for a corporation to be a CCPC at a particular point in time, the corporation must be resident in Canada and incorporated in Canada. Also, it must not be a public corporation or controlled by one or more public corporation or prescribed.
So they've summarized the law. Yeah.
I got it, but
okay, I know.
Even if the corporation is a private corporation and a Canadian corporation, it will not be a CCPC if it is included in paragraph A to D of the definition of CCPC. Paragraphs A to C excludes corporations controlled directly or indirectly in any manner by one or more non-resident persons. Corporations controlled by one or more public corporations, corporations with a class of shares listed in a designated stock exchange, or any combinations of them. Paragraph D of the definition provides that the corporation that has made an action under subsection 8911 is deemed to not be a CCPC for the purpose of the small business deduction rate in the eligible dividend scheme.
Okay.
The definition of CCPC, private corporation, and Canadian corporation were first added to the Act in 1971 as part of the 1971 tax reform legislation.
Hence all these rules about
1971. That's why.
Yep.
At the time of their introduction, the government emphasized the importance of recognizing whether a corporation was described in the Act as a private corporation or a CCPC. The Department of National Revenue's 1971 Guide on Corporation Taxation noted the following. The importance of the income tax implications when a corporation is a private corporation or a particular type of private corporation, such as a Canadian cultural private corporation, cannot be overemphasized. The reader is therefore asked to pay particular attention to the exact term used when a corporation is described in the Act. As will be discussed, the importance of the definitions of private corporation and CCPC in determining the taxation of a corporation under the Act continues under the current scheme of the Act. The definition of CCPC at the time that it was added to the Act in 1971 read as follows.
Oh, it was shorter. It was much shorter.
Was short.
Okay.
Every time you look at the history, it's like at some point the provision was like one sentence.
Yeah, one sentence, and then it grew into a monster that you can't even understand anymore.
It's like the first Tax Act that was 8 pages.
Yeah, exactly. Yeah. Hyperlexis, they call that in English. Yeah, like where you just never stop ballooning the text. Amazing. Okay, well, you have to read this in an old English accent because this is...
It's 1971. Canadian controlled private corporations means a private corporations that is a Canadian corporation other than a corporation controlled directly or indirectly in any manner whatever by one or more non-resident persons, by one or more public corporations, or by any combination thereof.
I had no idea you had this new character in you.
This is old legislation. So far I have Supreme Court, I have finance, I have old legislation.
You haven't done taxpayer voice yet, though, so hopefully we'll get... Usually we need some testimony for that.
Yeah.
Yeah, unfortunately we don't have any here. Okay. But wow, new character unlocked. Very good. Okay.
Maybe I should read Duke of Westminster in this voice.
Wow, if you could do the whole... Oh my god.
Oh yeah.
Okay. All right,
like,
so
today we'll be the Duke of Westminster. Hi, I'm Lord Tomlin today.
You have to wear your robe. You need a wig.
Can we find a wig, like a real horsehair?
I think
wig?
we need to find a wig. There's got to be. Are they available?
I'm going to be Lord Tomlin.
Yeah, I think we're going to have to do it. Yeah, I think we got to do it.
We have to ask like the faculty. Maybe there is a wig somewhere. There must be a wig somewhere.
Even if you could find that wig, I don't think you would want to put that anywhere.
Wait, it's actually made from horsehair.
I know, but it's been sitting in a box or something. Like it's gonna have. I don't even want to think about it.
Maybe I could put like a swimming.
Like a swimming cap first, and then you won't be hot at all. I must say I like our podcast a lot.
So if you just joined, we are actually reading DAC Investment Holdings, and we are at paragraph 65. Just for context.
Okay.
Okay. It's very serious. Parliament has amended the definition of numerous.
Okay, but so hang on. This first definition is pretty basic, right? It's like the same idea as that we have today. Has to be private, so not public. Has to be Canadian, meaning resident.
Meaning not controlled by a non-resident.
Not non-resident and not controlled. No, it's three things. Has to be private, not public. Has to be Canadian, which must have been defined also at the time, and then has to not be controlled by a non-resident.
Yeah.
Basically the same.
It's the same idea.
It's the same idea. Nothing has changed.
Just added a bunch of stuff.
A bunch of details, right. Okay. Which is usually the case, right? That's usually what happens. Okay. So, we've amended.
It was amended in 1980 to provide that the corporation did not lose its status as a CCPC if it was controlled by a public corporation that was a prescribed venture capital corporation.
Okay, 1980, we had venture capital.
We care about venture capital.
Apparently.
I don't know what the definition is.
Venture capital is like...
Prescribed venture capital?
Yeah.
So it must be
what the idea... Yeah.
It was amended in 1988 to add text similar to current paragraphs B and C of the definition.
Okay.
Minor amendments were made to the definition of CCPC in 2001. This included adjustments to the wording of the provision and the addition of the reference to paragraph C in paragraph A that is found in the current version, and The definition was amended twice in 2007. The first of these amendments added paragraph D for the purposes of the Succession 8911 election discussed above. The second of these amendments substituted
Good, you're doing awesome. The term
designated stock exchange
for
prescribed stock exchange.
I think that might be because the regulations is where you get the definition, maybe, of stock exchange.
But they just changed designated for prescribed.
No, I think it's in the Interpretation Act.
Oh, I think it is.
The definition of a prescribed
prescribed
stock exchange. Yeah. Oh,
Or
probably.
it's somewhere else.
But yeah, I know.
I'm not sure where is it.
Yeah.
The definition of Keynesian corporation at the time that was added to the Act in 1971 read as follows. Keynesian corporation.
Okay. Yeah, same
At
definition.
any time, is a corporation that was registered
Yes,
in Canada
good.
at the time and was one little I incorporated in Canada, or two little I's resident in Canada throughout the period commencing June 18, 1971,
Yeah.
and ending at the time.
Yeah.
And there was a reference to April 27, 1965.
Okay.
The definition was amended in 1977 to remove the text after subparagraphs 89.1
Wow,
into the lines
okay.
above. The definition
Well, if you ever want to do a deep dive into the history of the definition of corporation, it's here. It's here in DAC Investment Holdings.
The research,
It's
we've
all
seen
here.
the research about the GAR cases.
Yeah.
Now it's the research about the history.
Yeah, yeah.
It's well made. That's so long. We still don't know.
Yeah, we have no idea
We don't know where we're going.
we don't know where we're going. Yeah, we're just wandering.
We're taking a very long path.
A
to get
very
there.
long path, yeah.
The definition was amended in 1977 to remove the text after subparagraph 89.1a2 above. The definition was then amended in 1994 to the current version by including the text referring to amalgamations after paragraph B. The text of the definition of Keynesian corporation creates a class of corporations that meets the conditions of the definition. The definition is intended to differentiate between corporations that are resident in Canada and corporations that are not resident in Canada, as well as between corporations incorporated in Canada and outside of Canada. Okay. Pursuant to the definition of a CCPC, a private corporation cannot be a CCPC unless it is a Canadian corporation.
Okay.
As a result, to be a CCPC at a
Wow,
particular
have we
point
not
in
already
time,
said this 17 times by now?
a corporation must either be incorporated in Canada or have been resident in Canada continuously since June 18, 1971. The text of the definition of CCPC is intended to narrow down the pool of private corporations that qualify as CCPCs to include only those that are Canadian corporations and that are not described in paragraph A to D of the definition of CCPC. As will be discussed, the effect of a corporation being defined as a public corporation, a private corporation, or a private corporation that is a CCPC
Wow.
is key to determining the object, spirit, and purpose of the provisions that issue these appeals. This will be evident once the function that each of these the definitions plays in the scheme of the Act is considered. Numerous.
This will be evident once the function that each of the definitions plays in the scheme of the Act is considered. Okay. It's passive language. So what he means is, I'll make this clear once I consider the function that each of the definitions plays in the scheme of the Act. Okay.
Yep. Numerous provisions of the Act distinguish between
Wow.
a public corporation, a CCPC, and a private corporation. As well, certain provisions only apply if a corporation is a Canadian corporation. This results in different taxing regimes for public corporations, CCPCs, and private corporations that are not CCPCs. I think this is where the court is going.
Yeah.
You can be a public corp, you can be a public corp, you can be a CCPC, or you can be a private corp that is not a CCPC, and you will be taxed differently depending on what kind of corporation you are.
Yeah. Public, a CCPC,
And
private
not
non-CCPC. Yep.
Which, I mean, yeah,
Yeah.
okay, makes sense.
Fine. Took him 72 paragraphs to get here.
Yeah.
Yeah.
And the rate will be different, as will be
Yeah,
discussed.
yeah, right. As will be. Okay. All right. Now I think we get to, I mean, sadly, he doesn't tell us where he gets this rule, but we get to section 2. We're going to start at the beginning now.
Yeah.
Yeah.
All corporations that are resident in Canada are taxed on their worldwide income.
Which is a very loose way of saying section 2.
Section 2.
Yeah.
However, for policy reasons, the Act draws important distinctions between public corporations and private corporations, and between private corporations that are CCPCs and private corporations that are not CCPCs.
Okay.
I don't know. Do we have 3 different kinds, or do we have 2 different kinds, and one kind has 2 like sub
kinds?
Yeah.
Yeah. So if you were to draw it, would you draw like public, private, and then CCPC, non-CCPC?
I think I would do this.
I think that's right. Yeah. Generally
speaking, private corporations are entitled to a number of advantages that are not available to public companies. Oh, now it's companies. Further, CCPCs for some reason. Further, CCPCs are entitled to a number of tax benefits that are not extended to private companies that are not CCPCs.
Okay, so we've interchanged the term corporation and company here, which is totally fine, but it's a little jarring after you explain everything to us 700 times, the most basic of things. To not explain that basic thing is like, okay.
It's just that in the Act, it's always corporation.
Yeah, I know.
It's private corporation. So when the tax court is saying private companies, I'm just like, is the court still referring to private corporation as defined in the Act, or is it more broadly a company?
Right. The definition is not Canadian-controlled private company.
No, it's corporation.
Yeah.
So if you're saying company, I'm thinking you don't want to say corporation. There must be a reason why.
Yeah. Could the reason be oops?
Maybe.
Yeah.
But I don't know.
Yeah.
This can be seen by contrasting the taxing regime for CCPCs and the taxing regime for private corporations that are not CCPCs.
Okay.
Most private corporations that are not CCPCs
This is great. This is like a primer on the entire...
on rate.
I mean, you could just basically pick this up and drop it into a corporate tax textbook and you'd be done.
Yeah.
You just have to fix corporation where it says company.
Like how to explain rates.
Yeah, here it comes.
I mean, you have this thing in the Act where you have this general provision saying the rate is 38%.
Yeah.
And the first time you read this, you're like, wow,
38%.
Corporations are paying 38%.
Wow, yeah.
That's a lot. And then you realize that no one is paying 38%.
Yeah, it's a lie. It's a lie.
It's a lie, yeah. Most private corporations that are not CCPCs are only subject to the general Part 1 tax rate of 28% on their taxable income, the general tax rate.
Yeah.
This rate is composed of the 38% tax levied under subsection 123(1) of the taxable income of a corporation, reduced by the federal abatement of 10% of the corporation taxable income earned in the year in the province. As I will discuss in more instances, the 28 general rate is reduced by a further 13% under section 123.4, resulting in the corporate tax rate of 15%.
I don't know why he's always telling us that he's going to discuss something that he could have just told us right there.
It's like, as I will discuss.
I'm going to tell you in a minute, but let me tell you this first. Yeah.
The calculation of the tax rate for CCPCs is not as straightforward. Oh, no, it's not.
It's different.
It's
yeah.
The applicable tax rate varies depending on the nature and amount of the income. A CCPC must identify its active business income and its aggregate investment income.
Okay.
So now you have this.
I mean, I'm going to draw it on the board. The board is not on the screen, but I'm going to draw it on the board because I'm going to use this later on. So go ahead.
Well, maybe I could move the camera, and we can.
When you get to the camera, wait, there's like all kinds of stuff on the board that needs to not be in the picture, probably. So maybe next time.
Okay, I will not be filming.
You know what? I have a better idea. Just a sec. I got a great idea. We're going to use paper. Because paper will do the trick.
I feel like when I was learning about what a CCPC, what a private corporation, what all these things are.
Yeah. You could have used this.
Yeah. And you try to figure, it's like a Venn diagram where you're like, okay, say CCPC is private, but private is not CCPC.
Yeah.
But it could be that you were like both private, Canadian control, and CCPC.
Yeah. Exactly. Okay, so we said we divide the world of corporations in Canada into public and private.
Yeah.
Don't worry, I'm going to show it to the camera. Public and private.
Public and private.
And then we subdivide private into CCPC and not CCPC, right?
Yeah, sounds
That's
good.
right. Okay, and then over here, when we have CCPC, then we're going to divide its income into, tell me again?
Active business income, ABI,
Active
biz,
Inc.
and aggregate investment income. Invest income.
So ABI and AII. I've also seen this as AAII. I wonder why that is. But anyway, okay. All right, so that's our flow chart so far. Okay. And then?
ACCPC,
Yeah.
at the outset,
Yeah.
is liable to pay tax at the 28% general tax rate on all of its income. However, the 28% general tax rate is reduced for active business income of the CCPC that is eligible for the $500,000 small business deduction.
Okay, so then we're going to further divide this active into SBD eligible.
Like first half mil and the rest.
Yeah. Not SBD eligible, right?
Yeah.
And that's like up to less than or equal to 500K.
Yeah, 500K. Half a
and
mil.
this is over 500K.
And this is, of course, calculated with all related corporations. You cannot just create 4 CCPCs and have 2 mil. You have to divide it.
Right. You have to, like, you can't play games and, like, combine your core. Yeah, there's all kinds of anti-avoidance rules, special anti-avoidance rules.
That would be too easy.
Yeah, it would be. We would all be planning all kinds of crazy stuff, yeah. Okay.
In the relevant years, the portion of the CCPC's income that was eligible for the small business deduction was subject to an effective tax rate of 11% in 2015 and 10.5% in 2016.
And now is it 9%? No?
No, it's 9,
Yeah.
9%. It's like 3% in Quebec, so you pay 12.
Yeah. So the federal rate was 11, now 9, and everything above is still this 28?
Still the 28.
Okay. And now it's probably 25, I think it is, 25 and a half maybe?
Is it 26.5?
26 and a half?
Yeah, I think it's 26.5.
I think you're right.
Like usually when I give examples, I choose 26.5.
Yeah. Okay, so there's our rates for our different kinds of income. All right.
The CCPC's business income that is not eligible for the small business deduction is in most instances subject to the same 15% tax rate applicable to most private corporations. The general rate minus the 13 section 123.4 reduction.
Oh, so it's not 28 and 26.
Oh, I think this
because
is
we forgot
combined.
the, yes. Right.
Yeah, Quebec.
Right. That's combined.
Combined.
Yeah,
I
yeah.
think. Is it?
No, it is because the federal rate is 15% once you take away the 13 and the 11.
Oh, yeah.
The
10.
10 point and 2/3 or whatever it is, right? Isn't it? No, it's
10.
just 10.
Abatement
It's
is
the
10.
yes,
the
right.
10 2/3 is the refundable tax.
Yes, right. Okay, so it's oh yeah. So it's 38. I always do like 38 minus 13 and minus 10. So 38 minus 23 is 15. And that's what makes our federal rate 15.
Right.
And so what we're saying is this used to be kind of a not too bad, but then if we add in, so this is not right. This has to be 15-ish, but that's the Fed rate only, Fed.
Yep.
And every province has a tax rate, and so it pushes it back up to closer to 20. I think we say 28 for Quebec, or 26 and a half for Quebec. Yeah. Okay. All right. I stand corrected. We stand corrected. All right.
Well, how to figure out what is the tax rate if you're a corp?
Yeah. So much fun, right?
It's hard.
Yeah, it is hard. Okay. So where are we? Paragraph
80.
Okay. Here we go.
The
All right.
CCPC's income, that is aggregate investment income, is, at the time that the income is earned, subject to the 28 general tax rate, plus an additional refundable tax under Section 123.3. This resulted in a CCPC paying, in the year that the aggregate investment income was realized, tax at an effective rate of 34.66 in 2015 and 38.66 in 2016.
Okay.
Well, 38 and 2/3. Because technically it's 38.666.
Yeah. And this is the Part 4 tax?
This is the refundable part 1 tax.
So
In
this
French,
is
we say FRIP. Fraction remboursable d'impôt d'appartement. I'm not sure. I don't know what the word is in English. How do they call the part 1 refundable tax? Just the part 1 refundable tax? There's no nickname?
I don't know, because I think it's on the when you distribute ERDTO, NERDTO, that's where you get the
RDCOH.
yeah.
But I don't know the name for refundable part 1
Yeah,
tax.
I think it's just part 1 refundable tax.
If you know it, just drop it in the comments.
Like, share, subscribe. If you're still with us, good job. If you just got here, welcome.
Just as a reminder, we are reading DAC.
DAC. That's right. Okay. Okay. So, and trying to map out this little chart. Yeah. I've made this chart several times, and each time I make it, I'm like, why is this so complicated? Okay. But anyway.
However,
yep.
on payment on a dividend, a significant portion of the tax was refunded, resulting in an effective tax rate of 8%. The taxation of the CCPC's investment income will be discussed in more detail when I discuss section 123.3. So again, even though the corporation pays a lot of tax on investment income, as long as it is sent back to the shareholder as a dividend, the corporation doesn't pay that much tax because it gets refunded.
Right. Okay, so here's what's going to happen. Students are going to want to come into my office because they're picking up stuff for an event.
Oh, okay.
So we can keep going, or we could stop and pick it up another day. Or what would you prefer?
I can continue if you...
Yeah, so then I think I'm just going to open the door and leave the sign up.
Sure.
But let them come in and get what they need.
Yeah, we're going to get people coming
and then
That's fine.
Yeah.
That's fine.
I don't think they'll disrupt us too much. But they may even be sitting in the hallway right now. We'll have to find out.
Okay, so let's continue. In summary, a CCPC may be taxed on some of its business income at the same rate as the rate paid by a private corporation that is not a CCPC. It may be taxed on another portion of its business income at a lower rate. It may be taxed initially of its investment income at a rate that is 10 and 2/3% higher than the general tax rate, but then taxed at the significantly lower rate on the payment on the dividend. Okay, so a CCPC can pay a different rate depending on the context.
Okay.
So it's very confusing.
Very confusing, yeah. Okay, so maybe tax initially on investment income 10.66 higher, but then tax lower on the payment of a dividend. Okay, yep.
The specific tax regime for CCPCs is contained in a number of provisions. Who would have thought? Striking.
That all of this would
That's
be
not
in
just
different.
one.
Yeah, it's in different.
And they're all different.
Yeah, they're all different
It's
provisions.
like the
Yeah,
GAR.
we could start writing them down. Okay, maybe
Okay,
they're
but-
going to tell us. Okay.
But all those provisions, are they different from the GAR?
Yes, each one is different from the GAR.
Wow.
Each one is different. Then the GAR, only from the GAR. They're all the same
All the
with
same,
each other.
but different from the GAR,
Yes,
right? Okay.
yes.
Now it's clearer.
Now it's more
So
clear.
basically in the Act, it contains two sets of rules. The Act and the GAR.
There's really only two provisions.
Yeah.
Okay.
The Act and 45.
245. Oh,
Okay, for
painful.
example,
Okay.
numerous sections of the Act only apply to corporations that are CCPCs.
Wait, I lost you.
Where
Where are
82. Other sections only
Okay.
apply to corporations that are not CCPC. And certain sections may apply differently to corporations
Okay.
depending on whether the
So he
corporation
said
is
this
a
above.
CCPC.
Now he's reminding us that he told us he was going to tell us about this, and now he's telling us
Nice.
about this.
These
Okay.
provisions relate to both the taxation of the corporation and the taxation of the shareholders of the corporation.
Okay.
This can be seen from the following examples. Subsection 127.10.1 of the Act provides an additional refundable investment tax credit for scientific research and experimental development
Okay,
expenditures.
he's just going to tell us about a bunch of stuff that CCPCs can get.
Why are we talking about...
Holy, look at this long list of things he's going to tell us.
Wow.
Examples about different provisions that apply to CCPCs.
Okay.
Okay.
So scientific research
And experimental. Oh, I always forget what that E is for. Shred.
Shred.
Yeah.
Shred.
I always forget. I'm always like, an E. Educational? No.
Experimental.
Experimental.
And you have to keep all the documents related to this
Side
credit.
note, we are not your tax lawyer, but you should keep your documents, though.
Please. Do not shred it, or you won't get shred.
Oh, my God. We've been doing this too long when I'm laughing at that. This is terrible. Okay.
The payment deadline for corporations' payment of its taxes extended by 1 month for certain CCPC.
Okay.
That's good. You don't have to pay right away. You can pay a month later.
Oh, great.
Great.
For some, not all.
For some. The normal reassessment period for a corporation that is a CCPC is 3 years.
Here's the rule.
Yeah, while the normal reassessment period for a corporation that is not a CCPC is 4 years.
Okay, I'm going to write that down on my little thing here. For 4 years,
and
reassess, and 3 years reassess. Why is that?
Why as a government,
why do they
limit
do
yourself to 3 years for CCPCs?
Do you know why?
I don't know.
I have no idea. No.
I don't know. What is the spirit?
The idea is to make life easier for small businesses. They don't have to hang on to as much paper. They can shred it.
Maybe they can shred it earlier.
Faster. I mean, I don't know that that's such a hard thing to do, keeping track of paperwork, but
I mean, it is.
I still have my tax returns from like 20 years ago, so.
I'm not sure I have them.
You only get rid of tax returns when you move. Like when you move, you change your residence. Yeah. That is when you're like, oh, okay, do I really have to haul this around? No, shred it. Okay.
Yeah, last time I was doing, I was looking at my all my papers that I hold on because I print everything.
I know.
Like every paper I've read for my research.
I know. I have
in a binder.
Piles. I know.
Like
it's bad.
I got this huge 3-inch binder and I put all my research in this.
Yeah. No, but it's such I know why you do it, and I did it too until I was so drowning in paper. But it takes a couple decades, so just keep going. You're fine. You won't drown until a couple decades from now. But then you will be drowning, and you'll be like, I don't know what to do. I have this pile of paper that I marked up, and I tabbed, and I underlined, and what am I going to do? And at some point, you just got to be like, I'm going to recycle it.
But usually when I tell this, people are like, why don't you just use a computer?
Yeah.
I'm like, no, but I like reading.
There's something about, I know, it's true.
Tabs.
It's very old-fashioned of us, but I think it's pretty common in tax. Like, especially the Act. Like, I can read it online if I'm looking for something, but oh my gosh.
You know, when people are telling me like, oh, just use TaxNet Pro or Nosha or whatever, I'm like, it's better to use the paper version because you get a sense of where the provision is in the Act.
Yeah.
And I think this is very helpful in understanding the provision.
Yeah.
I'm just sad that we need 2 acts all the time.
All the time. It's too many words. We got to cut it.
Also is that I would really like it if it were like the other statutes and you get the bilingual text.
I know, side by side.
Yeah.
But then it would be 4 volumes.
But it's 4 volumes anyways because you get to look at both.
Yeah, it's true. I don't know what to tell you. We can't win this. We can't win this fight.
Okay, the normal reassessment period, I read that. Under the Act, an individual resident in Canada who is a shareholder of a CCPC, that is a small business corporation, is generally entitled to a capital gains exemption on the sale of his or her CCPC shares.
Okay, that's the lifetime.
Like 1.25 mil.
This is the lifetime capital gain.
Yeah.
So this is a good thing. This is a lifetime.
Is it still 1.25?
I think it's gone up. I think it's almost 3 now.
Really?
I swear it's really a lot more.
Because I remember they increased it when they increased the capital gain inclusion rate.
I know. And then they went back on the inclusion rate but didn't change I know. This is how government works. But anyway, that's different. Okay, lifetime capital gain exemption, yes.
Yeah, shareholders of of private corporations that do not have CCP status are not entitled to this capital gain exemption.
Yeah.
Subsection 7.1.1. Ooh, stock options. Differs the payment of tax on stock option benefits realized by an employee of a CCPC.
Okay, now that's something I don't usually teach this in the basic course, even though we teach stock options, but this is like a wrinkle. It's like, oh, you know how when I issue stock options, no tax? Yep. You have to wait till you exercise, but if you're a CCPC, you can wait until you sell.
Yeah.
Yeah. So, plus deferral for stock ops. Right?
Yeah.
Okay. What else? Oh, I'm just like making my notes here as we go. Okay.
Shareholders of eligible small business corporations who sell their shares in exchange for other shares of eligible small business corporations are generally entitled to a rollover of their capital gains on the disposition of their shares. One of the requirements for a corporation to qualify as an eligible small business corporation is that it must be a CCPC.
You can get a rollover.
You exchange shares, yeah.
But you can do that whether you're a CCPC or not a CCPC. You can do it 85.
Yeah, but you sell the shares in exchange for shares in another corporation.
Oh, I know what you're. Yes, that's right. It's like yeah, I know. It's like as long as you continue your investment in a similar,
in
it's
other
kind of like a
CCPC.
like-kind exchange.
Yeah.
Yeah. Okay. I'm going to call it a like-kind exchange. It's not quite that, but it's kind of like that.
It's kind of is. Taxpayers may reduce their taxable income from any source by the amount of their allowable business investment loss. An allowable business investment loss is the loss resulting from the disposition of a capital property that meets certain requirements. One of these requirements is that the property is either a share or a debt that in a CCPC that is a small business corporation.
Okay, so you might have to explain this a little bit. So there's something where if you end up with a operating loss on the active side of your CCPC.
Usually when you sell the shares.
It's when you sell the shares.
When you sell capital property that meets certain requirements. I guess
it's an investment loss.
Debt also. Like if you have a debt issued by CCPC and you sell it at a
loss.
Oh,
okay. So investment loss, not active business. So it's on the AII side of things.
Well, it's when you sell the shares of the CCPC.
Okay, so if the owner of the CCPC sells the shares of the CCPC...
Incurs a loss. Instead of having a capital loss,
which is restricted to capital gains, it becomes this ABIL, allowable business investment loss, which you can use against other income, like your wages or whatever.
Exactly.
Okay, so that's another advantage to ABLE deduction. That's interesting, right? Because like what we're doing is we're saying not only do you not have a lifetime capital gain exemption, you're not going to have gain. You're not even going to pay tax on the gain on the shares, but on the loss side, if it happens that your CCPC is a loser, you can use that loss against your other income in a way that you never would be able to in any other circumstance. There's a lot of benefits.
Basically, if I'm an investor, I think the question is, do I invest in a public corporation on the TSX or whatever, or do I take the risk of investing in a CCPC?
Right.
And investing as a CCPC is interesting because I have this lifetime exemption, and if ever I lose money on it, I will be able to reduce my income, not just waiting for a capital gain.
Yeah.
So it's an incentive in a way.
It is.
Yeah.
I mean, this is a long list of benefits to small business ownership in Canada. Yeah. Everybody should have one. Sorry, I forgot again. I forgot. Okay. Excellent. So that's ABLE.
You're able.
Able makes you able. Able. Okay, I'm just putting that there so I can go back in the video and pull this little clip where we were talking about ABLE and make a little video and put the little video on wherever, because that's a nice little explanation.
So we'll come back to the podcast.
Come back, we're back.
We are back.
We're still here. We never left. It's not, you can't call it a comeback. We never left. Okay. You got to stay ready if you want to be ready. Okay, anyway.
This is the plus, but there are also minuses.
Okay, there are minuses to being CCPCs.
Let's look at the minuses.
This is why Justice Woods talked about pluses and minuses. Yeah, okay. This is where it's coming from. Okay.
There are also certain provisions that benefit CCPCs, but that do not benefit corporations, including a private corporation such as the appellant, that are corporations resident in Canada, but that are not Canadian corporations. The appellant lost its status as a Canadian corporation and thus its status as a CCPC once it was continued in the British Virgin Islands.
Yeah.
Since the appellant ceased to be a Canadian corporation, it also ceased to be a taxable Canadian corporation. As a result, it lost the benefit of certain provisions, such as the following. Section 85, which allows property to be transferred to a taxable Canadian corporation on a tax-deferred basis. While the rollover provision is available to a CCPC, it is not available to a private corporation, such as the appellant, that is not a taxable Canadian corporation. So that's the minuses of being not a CCPC?
I'm very confused. Wait a minute. Just back up a second. Benefit CCPCs, but don't benefit corporations that are corporations resident but not Canadian. But then why is he talking about cease to be a taxable Canadian corporation? He missed a step. Okay. So he says, when you continue into BVI, you're no longer a Canadian corporation because you have to be resident in Canada and incorporated in Canada. And the moment you're no longer, what moment you continue in BVI, you're not resident, but they are resident. What part of it is they not resident? How are they?
A taxable Canadian corporation?
Yeah, but we have to stop being a Canadian corporation. And the thing that stops you being a Canadian corporation
is incorporated in Canada. So you're not a Canadian corporation. You're resident without being Canadian corporation, as defined by the...
But it was incorporated in Canada.
No, because once you continue your existence in BVI,
it's
like you never
it's like you died and you restarted?
Well, there's this provision in the Act at the end of the Act that basically deems... Well, I'm not sure
it's
if
5.1. It's 5.1.
Yeah, which says basically that for the purpose of the Act, if you continue your existence in BVI,
it's as if you were. That's it. That is why there's a potential abuse here, because it's this provision that deems you to never have been incorporated, specifically when you do this. Okay, so that makes you not a Canadian corporation, but why would you stop being a? What does it mean to be a taxable Canadian corporation? There's no such thing as a non-taxable Canadian corporation unless you're charitable or non-profit, which has charitable status.
Well, it's a definition, and we don't have...
Well, okay, I'll get you an act.
Need an act.
We could look it up online, since we're online, but we're not going to. We're going to look it up in the act.
Must be 89.1, I guess?
I think that it might be... what are we looking up?
Taxable Canadian
corporation. Yes, I would guess 89.
Must be.
Let's see. I will also look it up.
Let's pull the Act.
I can look it up on here. Let's see. I mean, that's a strange idea.
Taxable Canadian corporation means a corporation that, at the time the expression is relevant, A was a Canadian corporation and B was not, by reason of a statutory provision, exempt from tax under this part.
Okay, but so that's why I'm saying, like, what's going on here?
Because for Section 85 rollover, I think you must be taxable Canadian
corporation. But I mean, they are taxable.
No, they're not.
They're a Canadian resident corporation that's taxable.
No,
how is
they
it
are
not
not
taxable?
a Canadian corporation. So they are not a taxable Canadian corporation, even though they are taxed under Part 1.
Holy, okay.
They are a resident corporation, but not a Canadian corporation. So even though it's taxable under Part 1 of the Act, because it doesn't mean the requirement of being a Canadian corporation, it's not a taxable Canadian corporation, even though it's a taxable corporation that is resident in Canada.
That is what I'm struggling with. I struggle with this. Okay. So what we're saying is, let's just see if we can work this out also with a little chart here.
Because that's a weird situation where you are a non-resident, but you're taxable in Canada.
I know, right?
Without being Canadian.
Exactly. So you'd have resident. We have Canadian, and then non-resident.
Yeah.
Those are the categories. Resident and Canadian are two different categories. Resident a CCPC has to be 1 plus 1,
plus the
resident
other.
plus Canadian, and but a Canadian corporation has to be resident plus incorporated.
Yep.
Plus incorporated, and in our case, 5.1 of one. I think it's 127. I'll find it in a second.
No, it's 200 for something. 240. Is it 249?
No, I thought it was in
250.
I don't remember.
Could be
Yes,
250.
yes,
250.
yes. 250 tells me deemed never incorporated if continued. Okay. Abroad, right? So, okay, here's my little, here's my chart. It's not great.
This only works because you don't have a treaty to do a tiebreaker.
Yeah,
'Cause
exactly.
usually you would just be a resident
Yes.
of the other country.
Yeah, that's right. That's right. And you would no longer be resident in Canada.
But you
But
would
this
be
is the funny.
taxed, yeah.
That is true. That's why the treaty is interesting here, that there's no treaty. Okay, so for a rollover, you have to be both resident and Canadian and taxable.
And taxable as a Canadian.
So these could each be, this can be taxable or non-taxable. Can a resident be taxable and non-taxable? No.
A Canadian could be non-taxable.
A Canadian can be taxable and
Charity.
non-taxable. So there's an interesting little wrinkle here in the residence category, like the who, because you being a resident or being resident is a description of you, but you being Canadian or not Canadian is like a distinct description of you. You could be resident and not be Canadian,
Yeah.
or you can be resident and Canadian, and as a resident, you're taxable. But you could be a non-taxable Canadian who's subject to tax under the Act, but not taxable,
Yeah.
exempt from tax, because you're a charity or
yeah.
nonprofit
Yeah.
with charitable status. Okay, it's very confusing, but the point is, in order to get a rollover, you must be a taxable, you must be Canadian, and you must be resident. And so his point here is to say, once you continued, by virtue of 5.1, you're no longer Canadian, which means you're no longer a taxable Canadian corporation. When you go to 85, you're not going to meet the definition in the rollover.
Exactly.
I'm telling you, believe me, what I just said actually makes this sense. It actually does make sense.
But I think we should start baby tax like that. Like, what is taxable, what is Canadian,
Yeah.
what is resident.
Yeah.
And at the end of the class, everyone would be like,
Huh? Well, they're sort of like that anyway.
and then you would give examples like a corporation was incorporated in Barbados and all the meetings are held in Alberta. But we have a treaty with the country,
Right.
so
Right.
it's not, the beers does not.
Oh, man.
It's funny how the beers does really rarely apply.
Yeah.
And
Yeah.
here it applies.
It applies. Yeah. Yeah. Okay, so now we have explained. It's unfortunately but he doesn't really explain this. But the point is, if you go to 85, it's not enough to be Canadian corporation. You have to be a taxable Canadian corporation.
Yeah.
So he can't just say you don't get your 85 because you're not a Canadian corporation. It's not precise enough. You need to add that, and you have to be taxable thing, even though it's not relevant
because
to us
if you're
here,
Canadian exempt, you don't get the
yeah.
85 rollover.
for obvious reasons. If the reasons aren't obvious, then for another day. Okay.
Yeah, go talk to us.
Leave a comment.
Leave a comment down below if you want an explanation on this.
Like, subscribe, share with your friends.
And
We're back.
And we're back.
We're discussing DAC. We're at paragraph 84.
84 bullet 2.
Working through the things that happen if you're not a CCPC. Okay. So
section-
no 85.
Section 87, which allows a corporation to amalgamate on a tax deferral
So no
basis,
amalgamations.
only applies to TCC, taxable Canadian corporation,
Okay.
small t, big C, small c.
Yeah. That's the definition. Yeah.
For the same reason, Section 88, which allows corporations such as CCPCs to be wound up on a tax-different basis, is not available to private corporations such as the appellant.
Yeah.
And the dividend gross up and tax credit mechanism provided for in subsection 82(1) and section 121 is this. I was expecting a sentence.
I know, but
But no,
No.
it's discussed.
he's going
in
to tell
the
us
next
that
paragraph.
he's going to tell us about this.
These
Anyway.
provisions do not apply to dividends received from corporations or resident in Canada, but that are not taxable Canadian corporations.
No longer in italics, but should be in italics. Yeah. Okay.
As mentioned previously.
Okay. So number one cardinal rule that comes from my really basic rules for writing good papers in law school is that if you're telling me that you already told me something before, then something's wrong with the structure of your argument. You might want to consider, just how you've organized your material.
As mentioned previously, tax regime for CCPCs extends to the tax paid on distributions to its shareholder.
Okay, so that's where we drew this you get a refund on dividend thing over here. We drew it there because that's what we're going to talk about.
The Act has a specific set of rules that integrate the tax paid by corporations and shareholders when dividends are paid to a corporation shareholder. Do we call this integration? I think we do.
Yes, we do.
These rules apply differently to CCPCs and non-CCPCs, particularly non-CCPCs that are not Canadian corporations, such as the It's like CCPCs, not CCPCs, resident CCPCs. It's
Non-CCPC, non-Canadian, yeah. So that's interesting because then under not CCPC, you might have two here.
You kind of have like
Canadian
and
not Canadian.
Since a corporation is not entitled to deduct dividends paid to shareholders from its taxable income.
Yes.
Okay. Profits paid out to shareholders as dividends are taxed twice. Do we have double taxation?
Yeah.
Do we?
We do not. In Canada, do we? No. Because what's the sound?
Applause.
Yeah, we should have some applause for that. It's so ridiculous because we're so worried about this kind of double taxation. I mean, I've never understood why we can get so exercised about this double taxation that we will rewrite an entire act to deal with it, integration, and nobody cares at all that my wages are subject to double tax every time I go to the store and buy something and have to pay the consumption tax on already taxed income. But nobody gets pressed about that and says, integration, we need integration.
Yeah, but your salary is paid in pre-tax income, and the company gets a deduction. So is there a double non-taxation going on?
Oh my gosh, I see Carter ahead. Let's keep going. Okay, profits paid out to share. Okay, so the idea here that if we did not have an integration system, which we do.
But do we really?
We're not going to actually have this problem, but if we didn't have integration, we would have a problem that corporate income would be taxed, then you would pay the dividend out, and the shareholder is taxed on the dividend. Okay.
First, at the corporate level, as income of the
Of the
company,
company.
and second, as a shareholder level, as personal income of the individual shareholder.
That's right.
The Carter Commission.
Well, I don't know what the sound is, but 'cause I can't hear it, but I'm sure it's amazing.
The Carter Commission recommended the elimination
Yeah.
of this double tax by integrating corporate and personal income taxes through a dividend gross-up and credit system. The tax reform of 1971 implemented a system of integration for Canadian investment income of private corporation and with a limit, the Canadian active business income of CCPCs. The dividend gross-up and credit system has evolved over the years, both for policy reasons and to take into account the ever-changing corporate tax rates. Under the current system, Canadian corporations pay two types of taxable dividends, eligible dividends and non-eligible dividends. Generally speaking, an eligible dividend is a dividend paid by a corporation from its after-tax income that was subject to the general tax rate. A non-eligible dividend is a dividend paid by a corporation from its after-tax income that was subject to a lower rate of tax, such as income of a CCPC that was taxed at the eligible small business tax rate or was part of its aggregate investment income. Eligible dividends have a higher gross-up and credit imputed to shareholders than non-eligible dividends. The Act imposes restriction on paying eligible dividends based on the status of the corporate payer. The restrictions or penalties imposed under Part 3.1 of the Act when a corporation pays an excessive eligible dividend. The Act contains different tests for the imposition of Part 3.1 tax, depending on whether the corporation is a CCPC or a Canadian resident corporation that is not a CCPC. Generally speaking, the rules are as follows. A CCPC may pay an eligible dividend in a taxation year only to the extent of its general rate income pool, the GRIP, at the end of its taxation year without being subject to Part 3.1 tax, and a Canadian resident corporation that is not a CCPC. I think we need a word for that, like a non-CCPC Can Corp.
Yeah.
Can Res Corp. Pay eligible dividend in any amount. However, any such corporation cannot pay an eligible dividend free of Part 3.3 tax until it has paid non-eligible dividends and reduced its lower rate income pool, LRIP, to nil. GRIP is defined in subsection 89.1. The definition only applies to a taxable Canadian corporation that is a CCPC in a particular taxation year or to a deposit insurance corporation in a particular taxation year. A CCPC's GRIP balance, which is computed at the end of a taxation year, can be a positive or negative amount. While the formula is long and complex, it generally reflects the income of a CCPC that is not part of the aggregate investment income and income that has not benefited from the small business deduction or any other special tax rate. LRIP is defined in subsection 89.1.
I think that the practitioners call it LRIP. But LRIP
I prefer RIP.
is preferable, clearly. I don't know why they don't. So we're adopting LRIP.
And tell us, do you say LRIP or RIP? Comment down below.
If anybody comments LRIP in my comment section of this video, I'm going to send you free tax merch. So you need to send me, if you comment, make sure that I can figure out who you are so that I can send you free tax merch for following along and being part of our journey through DAC, which our journey is still ongoing.
We still don't know where
Wait,
this
no.
is going in terms of
Nothing.
abuse.
Nothing.
Because if you remember, we had like
This is a
question
real-
1,
yeah.
tax benefit. Question 2, was there an abuse transaction? Question 3, is there an abuse? And we're still in the historical context.
Of what is a CCPC.
Yeah.
Or I think what we're eventually going to try to figure out is what's the rationale of the refundable dividend
But, like,
tax?
why do we have the CCPC regime? Like, why are we
why are we-
defining
yeah.
CCPC in the Act?
Yeah, and actually it's going to, I think we'll get to the interesting question here, which is like, what difference could it possibly make if it's a Canadian guy sitting in, did we say he was in Alberta?
Ontario.
Sitting in
Is it
Ontario.
Ontario?
Yeah, Ontario, yeah. Sitting in Ontario with his Canadian corporation that he has continued into the BVI. Why should he not get the CCPC? Like, why should he be booted out of the CCPC regime at all?
Because the substance is the same. It's the same guy, same corp.
Nothing has changed.
The only thing that has changed is that the paper that has the name of the corporation on is no longer issued by Canada, but by the British Virgin Islands.
And that deemed by 255.1, deemed to not be incorporated in Canada, but actually it is incorporated in Canada.
Was first incorporated in
So
Canada.
you have to start thinking, like, why are we giving all these, like, we saw the long list of, breaks for CCPCs, that whole long list.
Yeah.
We're saying, like, at some point he's going to break the chain and not be a CCPC.
But that's kind of my question at the beginning, which what's the difference between continuing your existence into BVI or just incorporating?
Starting at the beginning.
Starting in the BVI.
Yeah. I mean, there's effectively no difference due to 255.1.
The only difference is that if you were incorporated in BVI from the beginning, you could never had the lower CCPC rate. So
That's right.
You
never
have the
would have had-
minuses, but you would have never had the pluses.
Yeah.
But does it make any difference?
Yeah, I don't know. That's a good question. So we're getting there. Look at, we're almost there. I can see object, spirit, and purpose coming.
Yeah.
We're almost there. In
Especially
summary.
Spirit.
But anyway, LRIP. LRIP is defined.
LRIP is defined in subsection 89.1. The definition does not apply to CCPCs. The definition does apply to all other corporations resident in Canada. A non-CCPC's LRIP generally reflects income that has benefited from certain preferential tax rates.
Okay.
In summary,
Whoa. Yeah.
the rules in the Act that affect integration through eligible and ineligible dividends recognize the different tax regimes for CCPCs and non-CCPC. I think since the beginning, it's like, hey, by the way, CCPCs and non-CCPCs are different, and I will show you how they're different.
Yeah. I'm going to show you how they're different. Yeah.
As mentioned previously, shareholders of a corporation that, like the appellant, is not a CCPC and is not a Canadian corporation cannot benefit from the dividend gross-up and credit system. A corporation must be a Canadian corporation in order to use the dividend gross-up system, the dividend gross-up and credit system.
Okay, so you have to be Canadian in order for you not to have double tax, effectively, integration. And then if you're not Canadian, you don't get the integration regime, which is going to mean that you're going to have the Canadian level of tax, and then you're going to have a second level of tax not grossed up and not credited for the corporate level tax.
Yeah.
Okay, fine.
As
Okay,
the shareholder,
yeah.
the only difference as the shareholder is that do you want higher income and higher credit or lower income, lower credit?
That's it.
That's it.
I mean, that you want to be a Canadian corporation, you want to get this integration because it does allow for some deferral. Because, even if you're not a CCPC.
Well, the thing is, if you are the shareholder, an individual shareholder, you will pay less tax personally if the corporation paid the general tax. Because you pay whatever rate, marginal rate you're at minus
That's right.
15.
So I prefer that.
9.
I prefer the corporation. As a shareholder, I prefer the corporation pay the tax because then I feel like I'm paying less tax when I get a dividend.
So I prefer investing in a non-CCPC, so I must have incentives to invest in a CCPC, which is
but
the
you
lifetime
but wait a minute.
capital,
Yeah, all that. Yeah.
exclusion,
Here. The 3-year reassessment, the lifetime capital gain, the deferral for stock options, the like-kind exchange deal, and the able deal. Okay, but that's only if you don't understand that. Like when you're a shareholder and you get your dividend statement and it has a lower rate of tax attached to it, you're not actually better off because the corporation would have issued more profit if it paid less tax. So it's 6 of one, half dozen of another.
Yeah, but if it's a small business and I'm the only investor in the business and the rest of the investors are like the people that has created the business, I just care about do I benefit from investing in this corporation versus just putting money on the stock exchange.
Exactly.
And even though I pay more taxes, I benefit because of all those things.
Yeah.
When I'm gonna sell it, I can exchange for another CCPC. I might have my lifetime exemption. If I incur a loss, I can deduct it.
Yeah.
So you must have like an incentive to invest in a CCPC, and they are.
Yeah. Plenty.
Yeah.
Okay.
But the downside to it is that if the CCPC earns investment income, we don't want the corporation paying less tax on the investment income. We want the money to be either reinvested in the corporation, in the business, or sent back to the shareholders as a dividend. And then the shareholder will be taxed on its marginal rate.
Yeah. Okay, good. So then we're at paragraph 95. Again, we're reading DAC Investments.
Object, spirit, and purpose of the definitions, especially spirit. The respondent's position with respect to the object, spirit, and purpose of the definition of a CCPC is set out at paragraph 124 of its written submissions. This paragraph reads as follows.
Okay, so the respondent being the king?
The king.
The king, and to recall that it is the king's job to say what they think the object, spirit, and purpose is. What is the case that says it's your job? You're the guy that wrote it. You're the Parliament wrote it, so it's your job to.
It's one of I don't know. Is it Trusco?
Yeah, maybe one of
them.
them. Yeah.
So the king The object, spirit, and purpose of the CCPC definition is to ensure that private corporations, directly or indirectly controlled in any manner whatever by Canadian residents, are subject to the entire deferral regime applicable to the investment income of CCPCs. This is how the respondent, the king, described the object, spirit, and purpose in his pleadings, in my pleadings.
It's my pleading. I know. Why does he say? Why is it in the third person? Anyway. Okay. Yeah.
This description is more precisely a description of part of the OSP of the CCPC definition. The definition mainly serves as a criterion for obtaining benefits, especially the small business deduction on the first $500,000 in active business income. The appellant argues that the object, spirit, and purpose of the definition of CCPC is to enumerate the specific criteria chosen by Parliament to be afforded such status.
Wow.
I agree with the appellant.
Wow.
So the definition is there to define. Who would have thought, really?
That has to be wrong. That just has to be an incorrect statement of law.
The spirit of a definition is to define. Is there more? I mean, I understand that a definition defines, like, the function.
It's you're describing the tool. That's all you're doing.
It's
and
like,
that's not right, I don't think.
It's like saying, like, the function of a hammer is... like
to hammer things.
To hammer things. But why am I giving you a hammer?
Exactly.
I
just don't,
It's not to hammer people.
Although some people will use it for that. Holy cow. All of that. Like, I think 20, 30 paragraphs in to say that the object, spirit, and purpose of the definition of CCPC is to enumerate the specific criteria, is to define CCPC.
Okay, but why Parliament chose these criteria?
No discussion here. No discussion.
I mean,
wow.
I'm guessing the spirit of the definition is, why do we need this definition? The reason is not just to define, it's why do we have the idea of the CCPC?
Yeah. What's it doing in the Tax Act? Yeah.
Well, it's there to define CCPC. Without the definition, we would not have a regime. Yeah, but why do we want to define CCPC? Well, to define it, of course.
Yeah.
Can you imagine having the CCPC regime without the definition? It would not serve any purpose.
Yeah, it's not going to work. No. It's not going to work. All right, so he agrees with the appellant that that's the OSP, and that is going to be a basis for appeal. Right there. That paragraph 97, the shortest one in the whole, five words, the shortest paragraph in the whole thing, that's going to be the mistake of law, or the alleged mistake of law that goes up on appeal.
Well, we'll see at the FC level.
Yeah.
If the FC agrees with the appellant.
Yeah, we'll see, yeah.
Well, it will be the respondent, I think. Is it there? Are we going the other way around? Is it the Crown appealing? Must be the Crown appealing.
No, I think the taxpayer loses at tax court.
Loses?
You tell me. Skip to the spoiler alert.
Oh, actually, it was like paragraph 0 there.
Okay. Was the appeal dismissed or allowed?
Is allowed. With
costs. Okay. So the taxpayer won.
And your reassessment is referred back to the Minister of National Revenue for reconsideration and reassessment on the basis that the appellant's transaction, as set out in the attached reasons for judgment, did not result in abusive tax avoidance for the purposes of Section 245.
Okay, so the taxpayer won. Okay. Spoiler alert, the taxpayer is about to win this case. And it's supposed to go back to the minister to reassess, but instead the minister appeals.
Yeah. The minister is like, no.
Yeah. Interesting. Okay. Back to paragraph 98. So I just circled your 97 so that when we get to the FCA, we can remember if this was so we can see if this was the paragraph. Okay.
From the time of the definition's introduction until the present, the rationale of each definition has not changed. I'm still sweating every time.
I know it.
The Act contains a detailed and specific regime for taxing CCPCs, including specific provisions for taxing their business income, for taxing their investment income, and for taxing distributions to the holders. Other provisions provide specific benefits to corporations that are defined to be CCPCs. The object, spirit, and purpose of the definitions of a CCPC is to provide a dividing line between those corporations that are taxed under the specific regime for CCPC and those corporations that are not taxed under this regime. Okay, now we have a new OSP.
Yeah.
The OSP of the definition is to differentiate the definition from the rest.
From the operating
But we
rule.
still don't know why we need the
Yeah.
definition.
It's very strange. Yeah.
It's like the function of the definition is to tell us what goes in the definition.
Yeah,
which
but
is
then
still
how could you ever abuse such a provision? You couldn't. So the implicit argument is you cannot abuse a definition. Yeah.
except that there is no provision in the act that says why we have the regime in itself. So you could never
That's right.
abuse the
That's
CCPC
right.
regime.
That seems right. Yeah. Okay.
Similarly, the object, spirit, and purpose of the definition of a Canadian corporation is to set out the specific criteria that must be satisfied before a corporation is considered for the purposes of the Act to be a Canadian corporation. Who would have thought?
Who'd have thought?
Section 123.3. The title is just Section 123.3. Section 123.3. I think now, you know, in like French literature, you have this prize for the best page 100.
You have the prize for the best page 100?
Yeah, you judge a book based on just one page.
What? Really? You just pick a book and read page 100?
Yeah.
Really?
I think we should start picking cases and just reading paragraphs.
Just read page or paragraph. We should have the paragraph 100 prize?
Yeah. Because this one would not win.
Well, what is okay.
It's just Section 123.3.
It gets an F. Okay, let's see. I'm going to just test this theory. So you look at page 100 and you decide whether the book is worth reading?
Yeah.
Effect on tax base allocation. That's a nice title at the beginning.
That's a perfect
that's looking
page
pretty
100.
good.
This is a good page 100.
Go read it. Go read it. Wow. Yeah, it's talking about how to reduce competition at source.
Wow.
With pass-through taxation. Okay. I just decided I won the contest for myself. Anyway, but this guy loses. Okay, paragraph 100 is not good. Not good.
Unfortunately, not.
The paragraph 100 test. Let's try to remember this to add to our repertoire. The paragraph 100 test. Okay.
100.
And we say that DAC is just a statutory text.
That's a low tier, I think.
I
for
would say
paragraph
like that's
100.
like on a scale of 1 to 10, 0.
Yeah.
No, it's not 0 because you could do worse.
Or maybe it's A to E or F, and that's an F. Maybe we should do a tier at some point. You know those videos when they rate?
Yeah, I know. That's what I'm thinking. We could do a whole series on just paragraph 100s. Do the paragraph 100 test. We're doing this. This is going to happen in the future, by the way. So, FYI. So, we need to figure out the scale. We need a scale.
Yeah, we need a scale from, is it like A to
A to F?
E?
Is it A to F? Or is it like
sometimes there's
1
like an S tier when it's like grade, which is like above and beyond.
The S tier is like from video games, right? Like when you're at the top, you're S tier. Yeah.
S tier.
Yeah. Final boss level. Anyway, okay. Got it. Paragraph 100 does not inspire, is the point of this discussion. Okay, continue.
Okay, 122.3. There shall be added to the tax otherwise payable under this part for each taxation year by a corporation that is throughout the year a Canadian-controlled private corporation, an amount equal to 10 2/3% of the lesser of A, the corporation's aggregate investment income for the year, within the meaning assigned by subsection 129.4, and B, the amount, if any, by which its taxable income for the year exceeds the least of the amounts determined in respect of it for the year under paragraph 125(1)(a)(2)(c).
Okay. Now he's going to explain it in 101.
The provision levies a 10 2/3 tax on the lesser of the CCPC's aggregate investment income,
Okay.
within the meaning assigned by subsection 129.4, and the amount determined under paragraph 123.3b.
Yep.
There interesting. We don't have the subsection here, just the
Yeah,
paragraph.
they didn't give us that. Yeah.
The amount determined under paragraph 123.3b is the amount by which the CCPC's taxable income exceeds a small business deduction limit determined under paragraph 125.1a to c. Since in most instances the CCPC's aggregate investment income will be less than or equal to the amount calculated under paragraph 123.3b, the section 123.3 tax is normally 10 to 3% of the CCPC's aggregate investment income.
Okay.
Section 129.45
Well,
is
I
the
thought we already
aggregate
did
investment
this.
income.
Okay, apparently we didn't. Okay, 129.
Aggregate investment income of a corporation for a taxation year means the amount, if any, by which the total of all amounts, each of which is the amount, if any, by which the eligible portion of the corporation's taxable capital gain for the year
Okay.
exceeds the total of two little i's.
Wow.
The eligible portion of its allowable capital losses for the year and three little i's. The amount, if any, deducted under paragraph 111.1b in computing its taxable income for the year, or b, the corporation's income for the year from a source that is a property other than one little I, exempt income, two little i's, and among included under subsection 12, 10.2, in computing the corporation's income for the year. Three little i's, the portion of any dividend that was deductible in computing the corporation's taxable income for the year, and four little i's, income that, but for paragraph 108.5a, would not be income from a property, exceeds the total of all amounts, each of which is a corporation's loss for the year from a source that is property.
Okay, so more or less, if you would have said, like, what's my aggregate investment income, I would have said, well, what's my investment income? Well, so it's net capital gains, which is what they're describing,
Yeah.
and other income from royalties, interest, dividends, other income from property.
Yeah.
Yeah. Net capital gain and income from property, income from not business, income from property.
Yeah, I
Yeah.
mean,
That's basically what it is.
yeah, that's basically what it is,
Yeah.
but you need the definition with all
Yeah.
exceptions.
Yeah.
The eligible portion of a CCPC's taxable capital gains or allowable capital losses is the portion that cannot reasonably be regarded as having accrued while the property or a property for which it was substituted was property of a corporation other than Canadian-controlled private corporation. As a result, paragraph 129.4a only includes taxable capital gains or allowable capital losses of a CCPC to the extent that they accrued while the corporation was a CCPC.
Okay.
Subsection 129.4 provides that the corporation's income or loss for the year from a source that is property includes the income or loss from a specified investment business carried on in Canada other than income or loss from a source outside of Canada. Generally speaking, a specified investment business is a business whose principal purpose is to earn income from property. Subsection 1294 excludes from a corporation's income or loss from a source that is property, income or loss from any property that is incident to or pertains to an active business carried on by it, or that is used or held principally for the purpose of gaining or producing income from an active business carried on by it.
All right, so we're getting rid of incidental to active business. Like, I have to keep a bank account.
Yeah.
Would that be like if I have to keep a bank account to keep my
That would be
operating
active.
income? That would be...
Like, for example, I don't know, you need a huge amount of money. For example, if you have a gas station, for example, and you pay for your own gas, you need a huge bank account to pay for the gas and delivery.
Yeah,
I don't know how much it is, but maybe you need like $200,000-$300,000.
right.
So, and you probably earn a few
get
dollars.
cash on- yeah. Yes.
You have cash on hand.
Yeah.
You probably earn a few dollars from the bank because you have this
Yeah.
huge deposit. But it's part of the active business because
Yeah.
you have to keep that cash in your account.
Yeah, for sure. Okay.
So paragraphs B1 till I to B4 little i's of the definition of aggregate investment income
Well, he just told us this, but he's going to tell us again.
exclude the following from a corporation's income from a source of its property. Exempt income. Income paid out of a NISA fund number 2.
Yeah, it's a very... I just looked it up, actually, just to see. It's just an extremely...
which relates to certain agricultural income stabilization programs.
yeah.
A NISA fund number 2.
Yeah.
This is Have you ever met a NISA fund number?
I
Because
never in my
personally-
life did I meet her.
Personally, I only met NISA fund number 1. But I've heard number 2 is much better.
Stop. But yeah, it's
if you have met a NISA fund number 2, drop a comment down below. Like and subscribe.
once again, free merch is coming to anybody who drops a comment about NISA fund number 2, especially if you know her. That's some serious merch you're gonna get. Okay.
Can I get a mug saying I love NISA?
I think you could. We could arrange that. Yes. Who doesn't love NISA fund number 2? What's not to love? Yeah.
Intercorporate dividends that are deductible under subsection 112.1 or subsection 113.1, and income that is deemed under paragraph 108 4A to be property
5A.
income when distributed by a trust.
Yeah.
The text of section 123.3 and the definition of aggregate investment income indicate that section 123 is intended to levy a 10 to 3% tax on a CCPC.
Holy cow! For the 15th time, yes.
Composed of the excess of its eligible
Wow.
capital gain over its allowable capital loss plus its net income for property that the CCPC does not use in its activities, so that is incidental to the activities.
As will be discussed, this tax is refundable. Yeah, you already told us that. I guess you're going to tell us again.
As will be discussed, and was discussed,
It will be
will be.
again.
this tax is refundable. The refundable tax is refundable.
We love you, Tax Court, but honestly, come on.
It's very doctrinal.
Yeah, is it? Just like,
It's very
yeah.
doctrinal. I feel
Yeah.
like
It's a lot.
Yeah.
It's a lot. Hey, we're not even halfway there yet. Let's keep going.
Let's keep going. Section 123.3 was added to the Act in 1996.
Yep.
Originally, Section 123.3 imposed a refundable tax of 6 to 3% on aggregate investment income. This amount was increased in 2016 to the current rate of 10 to 13 to coincide with an equivalent increase to the highest marginal rate on personal income tax in the same year. Section 123.3
Okay.
is part of a legislative scheme in the Act for the taxing of investment income of the CCPC. The search for the rationale underlying the text of the provision requires consideration
Okay.
of this legislative scheme. The rules concerning the investment income of CCPCs attempt to make the corporation an investment vehicle of little tax significance. I like how the sentence is
Whoa.
a quote, and that's
Of?
it.
Of what? What is paragraph? What is footnote 81?
Peter Hogg, McGee, and Lee, Principles of Canadian Income Tax Law.
So it's some doctrine. So what we call a doctrine in Canada when professors say things.
But
The
it's
rules concerning investment income attempt to make the corporation an investment vehicle of little tax. Okay, it's okay. What they mean is the rule here is to make it so you don't benefit by incorporating
Yeah.
your pocketbook.
Yeah.
Yes,
also it's weird. Like, not saying like like professors.
I know.
whatever said,
I know.
just
They
like,
here's the law. I know. Yeah, I'm not a fan of it. Yeah.
the Act contains 2 sets of rules that attempt to accomplish this objective. The first set of rules, the previously discussed dividend gross-up and credit scheme, attempts to integrate the tax paid by CCPCs and their shareholders through the use of eligible and non-eligible dividends. The second set of rules attempts to discourage the retention of investment income in the CCPC while maintaining the integration of the CCPCs and its shareholders' tax structures. This set
Okay.
of rules comprises Section 123.3 and the sections that provide for a refundable portion of the CCPC's Part 1 tax.
Okay. Discourage the retention of investment. That makes sense to me. Sure.
That's a spirit.
Yeah.
That's spirit.
Yeah. I agree. That is a spirit.
That's spirit. Very spiritual.
Here, let's put right spirit on the side of that paragraph 113 so we come back to it. It's very spiritual. Yeah, it's stating, why do we have this? Oh, it's to discourage, why do we have it? To discourage retention of investment income in a CCPC. So, yeah, good ghost. Good. Show the audience. Okay.
Section 123.3 attempts to discourage the retention of a CCPC's. Is it just what I just read? investment income.
It's
by
exactly the
initially
same.
taxing
Yes.
the investment income.
This is going to tell you how it's going to do it.
38 2/3 tax rate.
Yeah.
This is made up of the 28% general tax rate plus the 10 2/3 tax levied under section 123.3.
Which we first encountered about 30 paragraphs ago.
The 23 2/3 tax rate is intended to be roughly equal to the highest personal tax rate paid by individual shareholders and thus reduces or eliminates any advantage that would arise in retaining the investment income in the corporation and deferring the payment of the tax that emerges on the distribution of the investment income to the shareholders of the CCPC.
Okay, this is actually not a terrible explanation here. So we say we want to discourage. How are we going to discourage? By replicating the personal rate. Okay, and then okay.
This was explained by the government at the time that Section 123.3 was introduced as follows.
It's 1995.
Effective July 1st, 1995, refundable tax will be levied on investment income received by Canadian-controlled private corporations. This tax will reduce the current deferral advantage to individuals earning investment income through these private corporations instead of earning such income directly. The deferral advantage arises when the corporation tax rate applied to this income is lower than the marginal tax rate of the individual shareholders. This was then used July 1st, 1995.
Beep, 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 beep. Breaking news.
As noted in the budget document, the Section 123.3 tax is refundable. I'm glad I learned this.
There is some. You just we're on camera, so you can come in. If you don't want to be heard, just come in and get what you need. Yeah, you can grab anything you need. You're not on camera and you're not in the mic, so you're fine. For everybody watching, it's just that's how a day in the life. Okay. Okay, so wait a minute. The refundable, this is I think the 15th time we've heard that it's refundable, but
it's refundable.
Just to be clear, this is the one, this tax that gets us up to the individual rate.
Yeah.
The corporation doesn't have to pay it. In the end, the shareholder has to pay it. It's refundable. Yeah.
So the corporation pays, gets a refund.
And then gets a refund, yeah.
So it's not net zero because
you pay it. Problem. Yeah, you have to. Yes, that's right. Okay. Yes, it prevents deferral. It doesn't eliminate the tax. It prevents deferral, and the corporation has to bear the tax until.
So basically, if you pay the tax, you don't have this money to invest.
Yeah.
So
yeah.
Similar comments were made by the Department of Finance explanatory notes that were issued at the time that the refundable tax levied under Section 123.3 was increased from 6 2/3 to 10 2/3%. The comments were as follows. Section 123.3 of the Act imposes an additional amount of tax under Part 1 of the Act on investment income of a Canadian-controlled public corporation, a CCPC.
You might not want to come back here because we're on camera. What do you need? Get it. Oh, yeah, we got all kinds of stuff going on here. Help yourself. Careful. Coffee. Okay. No, you're good. Do whatever you need to do. Keep going. Don't stop.
Can we get a little chicken sound before you leave?
That probably we should program into the board.
A corporation that is a CCPC throughout the taxation year must add to this tax otherwise payable under Part 1 for the year an amount equal to 6 to 10% of the lesser of two amounts. The objective of this additional tax to reduce personal income tax and default possibilities that the individual earning investment through income directly might always obtain by earning such income through a CCPC. This income is amended. This section is amended to increment the tax rate from 6 to 10%, consequential to the introduction of a legal personal tax rate of 32% in Section 137.2.
Okay, so what happened here is that we increased the tax on individuals, so we had to increase the refundable part of CCPC.
Because the idea of the refundable tax is to reflect the highest possible personal tax rate.
I can't believe they've ever been able to raise tax rates. It's amazing, really, when you think about it.
Just the top rate.
Yeah, just the top rate, yeah.
But now we're lowering.
I know. I mean, that's just it. It's it's bizarre that there was a time when you could increase the tax rate by several percentage. Goodbye. I cannot wait to see this set up. This is amazing.
But I remember that at the time, because of provincial, like Quebec plus federal, the tax rate was higher than 50%. And people were outraged.
I know.
You earn $1 and you give 53 cents to the government.
Yeah. That's another topic. Yeah. Okay. Guess what? The tax is refunded.
The tax is refunded to the CCP because if you didn't know, this tax is
in case you didn't know,
just in case you just joined.
Yeah,
we're talking about a tax that is refundable.
Yeah.
The tax is refunded to the CCPC when dividends are paid out to shareholders.
Okay.
This is done through the use of a CCPC's refundable dividend tax on hand (RDTOH) account.
Yeah.
The RDTOH account was created as part of the 1971 tax reform. All private corporations establish an RDTOH in which they credit the part for tax paid on deductible intercorporate dividends. During
right. Okay.
CCPCs, in addition to crediting their RDTOH account with any part for tax that they paid during the year, credited their RDTOH with 32/3% of their aggregate investment income. The 32/3% represented the 10/2 tax
Holy
on the
moly.
CCPC paid under Section 123 on its aggregate investment income and the tax of 20% of its aggregate investment income, which represent part of the tax paid at the 28 general tax rate. So that's why earlier the judge said at the end the corporation would pay only 8%.
Okay.
Because you get the refund for 32/3.
Yeah. Okay.
On declaration of taxable dividends, private corporations, including CCPCs, were entitled to a dividend refund of 1/3 of the value of the dividend up to the amount of their RDTOH account.
Okay.
While during the relevant years, both CCPCs and corporations that were not CCPCs maintained RDTOH accounts. Only CCPCs were entitled to a refund in respect of the Part 1 tax that they paid on the aggregate investment income. Private corporations that were not CCPCs were only entitled to claim a dividend refund in respect of the Part 4 tax.
Okay.
The purpose of paying a dividend refund to CCPCs in respect of the Part 1 tax that they paid on the aggregate investment income was to lower the tax rate to a level that allowed for the integration of corporate and shareholders' taxes under the first set of rules. During the relevant period, a CCPC paid Part 1 tax at a rate of 8% on its aggregate investment income after receiving the dividend refund.
Okay.
The effect of Section 123.3 of the refundable dividend tax mechanism is to first tax the CCPC's aggregate investment income at a high rate to try to minimize any tax deferral that may be realized by the CCPC during the distribution of the aggregate investment income to its shareholders, but then to tax the aggregate investment income at a low rate once it is distributed to the corporation's shareholders. This low tax rate allows the dividend gross up and credit system to operate properly. The Minister of Finance explained this scheme at the time of the introduction of Section 123.3 as follows. The RDTOH account of a private corporation accumulates two amounts. All of the Part 4 tax paid by corporation of its portfolio dividend income, and for CCPCs up to 20 percentage points of Part 1 tax paid on its investment income other than deductible dividends and taxable capital gains. The corporation is then free to distribute taxable dividends out of both its return earning and this RDTOH account to the shareholder. In recent years, the spread between corporate and personal income tax rates has generally increased. In several provinces, the top personal tax rates exceed the top corporate rate by a significant amount. This creates an incentive for individuals to defer tax by accumulating investment income in the private corporation rather than earning the income directly. By imposing an additional refundable tax of 6% of investment income earned by CCPCs, this proposal will reduce or eliminate the deferral advantage of earning investment income in the corporation as opposed to earning it directly. Because this additional tax will also be credited to the RDTOH account, the integration of the corporate and individual tax structures will be maintained. Corporation will now receive a refund of their RDTOH as a rate of $1 for every $3 of taxable dividends paid.
All right. I can hear your voice starting to go, so let me read the next section. You recover, drink some water, and then you'll pick it up again. So, all right. So what I think we have here is like a restatement of the things we've already been talking about in terms of the purpose, the spirit, the deferral, the integration. Like, it's a pretty good. It's not a bad explanation. I will say, like, it's a little bit tedious in the sense that it repeats, but it's not an overall bad. Yeah, it's pretty good.
I get it.
I get it too, and I think I might use this actually in my corporate tax materials. I may just use this exact discussion. Why not? Just like, here, read this from DAC. Read DAC for this part. Okay, even though it's long, you know, and I mean, there's some organizational problems here, but that's okay. All right.
It's a bit repetitive.
Yeah, it's but I do understand this idea. It's like, okay, so remember, it's refundable. Now I'm going to explain to you that when it's refundable, this is when. Okay, like it is kind of okay. Yeah. All right, so take a rest for a minute and do what you need to do. Walk around if you need to. Object, spirit, and purpose of Section 123.3. The respondent argues that the object, spirit, and purpose of Section 123.3 is to prevent Canadian resident individuals who control a private corporation from deferring tax on the investment income of the corporation. The respondent states the following at paragraph 25 of his written submissions. Even though the text of Section 123.3 applies to only CCPCs, the object, spirit, and purpose of Section 123.3 is broader. The object, spirit, and purpose is to prevent a Canadian resident individual from deferring tax on investment income, including taxable capital gains, earned through private corporations that they control, directly or indirectly, in any manner whatever. This OSP, wow, it says OSP. It actually says OSP. This OSP is found in the legislative history of the integration/anti-deferral regime for the investment income of a private corporation, of which Section 123.3 became part. The appellant disagrees with the respondent's position. Okay. It argues that the object, spirit, and purpose of Section 123.3 is to prevent a Canadian individual who controls a CCPC from deferring tax on investment income of a corporation. In its view, the government never intended for the provision to apply to a private corporation that is not a CCPC. I see. So the respondent here is making an argument that the OSP is broadly to prevent any Canadian from deferring tax on investment income earned through a corporation they control. And the appellant is saying, no, it's only to prevent a Canadian who controls a CCPC specifically from deferring tax on investment in that form. In its view, the government never intended for the provision to apply to a private corporation that is not a CCPC. In its view, the text of Section 123.3 indicates that the intention of Section 123.3 was to levy the refundable tax on CCPCs. The use of the words Canadian-controlled private corporation in Section 123.3 reflects part of the means used by the government to translate its aims into legislative form. However, as the SCC noted in Dean's Night, the means do not necessarily provide a full answer as to why Parliament adopted the provision. I must reach my conclusion on the object, spirit, and purpose of Section 123.3 based on the text plus the contextual and purposive analysis just undertaken. As discussed, Section 123.3 is part of the scheme for taxing investment income of a CCPC. The scheme involves two sets of rules, the rules relating to integration affected by the dividend gross-up and credit scheme, and the rules attempting to discourage retention of investment income while maintaining integration, which are set out in Section 123.3 and in the dividend refunds scheme. Holy cow, we're going to go through this again? The first set of rules, the dividend gross-up and credit scheme, contain a specific scheme for CCPCs. As discussed previously, the dividend gross-up and credit scheme distinguishes between eligible dividends and non-eligible dividends. A CCPC, unlike a corporation that is not a CCPC, must calculate a GRIP account balance. The CCP's ability to pay an eligible dividend is dependent on the balance in this GRIP account. The exclusion of a CCP's investment from its GRIP account recognizes that the investment income of the CCPC is taxed at a lower rate once it is distributed to the CCPC's shareholder. In short, the dividend gross-up rules contain a specific scheme for CCPCs. It is the same for the second set of rules, which are contained in Section 123.3 and the refundable dividend tax provisions. Section 123.3 only applies to CCPCs. More importantly, even though all private corporations establish an RDTOH account, only a CCPC is allowed to credit their RDTOH account with a portion of the Part 1 tax that it paid on its investment income. The amount credited by the CCPC to its RDTOH account includes both the tax that it paid under Section 123.3, plus a portion of the tax paid at the general tax rate. The amount credited in respect of the general tax rate represents tax that is paid by both CCPCs and private corporations that are not CCPCs. However, Parliament has chosen to not include private corporations that are not CCPCs in the RDTOH scheme for Part 1 tax. Huh?
Okay.
The two sets of rules evidence that Section 123.3 is part of a legislative scheme that the government only intended to apply to CCPCs. Okay, so we're just trying to caveat it off here, I think.
We're like, okay, it could apply more generally, but the Parliament decided
but this is not what they wrote.
CCPC.
That's right. This conclusion is consistent with the various pronouncements made by the government when it introduced Section 123.3 in 1995 and when it amended the provision in 2016 to increase the rate. It is clear from these pronouncements that the government was aware that the tax deferral opportunity existed for all individuals who held shares in private companies, but that it only chose to impose the Section 123.3 refundable tax on CCPCs. The appellant argues that the history of the rules for RDTOH make it clear that Parliament intended for the refundable tax regime, which Section 123.3 joined in 1996 like it's a club, as it applies to Part 1 tax on investment income, to only apply to those private companies that are CCPCs. What do you make of this? What's going on here?
It's just like we have a set of rules for CCPCs, so where are we going with this? And of course it only applies to CCPCs because we have this...
The whole point is that you're getting a lower rate in the CCPC that you're not getting in the non-CCPC.
But I'm feeling the problem here is that the abuse is kind of the abuse of the CCPC scheme as a whole, so you cannot really say it's the abuse of like the definition or the provision.
It's the
scheme. But GAR doesn't apply on scheme.
But the scheme is in the components that produce it. So you can't.
But can you abuse like all the provisions that relates to CCPCs? Like
I mean, I don't know.
It's kind of the thing.
I mean, this is the problem, is that they're going through each provision one at a time, and they're going to say, well, you can't abuse a definition. You either are or are not described by the definition.
Yeah, it's like you can't abuse 123.3.
But I don't see why not. You can abuse a definition. If you say a definition, you either are or are not described in the definition, and you do all kinds of kind of crazy things to not be described when you kind of are described, then that's an abuse. Why not?
Right. The definition is the best example, I think, of this idea that you have criteria and you just tick the box. The definition is like ticking the box, and if you do something that allows you to not tick a box that you should be ticking, then you have to ask if it is abusive or not. Or the opposite is true.
Right.
Like a definition is you tick the box, and usually you would not tick the box, but you do something funny to tick the box.
Yeah.
Then you have to ask, is it an abuse of the law? So if you say the spirit of the definition is to define, then you could never abuse a definition because you cannot abuse defining something.
Right, whether you're in or not, whether you're described or not described. Okay. Okay, where am I? 133?
Yeah.
The appellant argues that the history of the rules for RDTOH...
34.
At the time, I just read that and I didn't even remember. That's right. At the time, Section 129 was introduced in 1971 as part of the 1971 tax reform, aka the Carter Commission reform. The definition of RDTOH in subsection 129.3 allowed all private corporations, not just CCPCs, to add 25% of their Canadian investment income to their RDTOH accounts. Okay. In 1981, the Act was amended to restrict... That's wild. Okay. Okay, I have questions. The Act was amended to restrict the addition to the RDTOH account in respect to Part 1 tax paid on investment income to corporations that were CCPCs. The words private corporation in paragraph 129.3a were replaced with the words Canadian controlled private corporation throughout the year. Okay. Oh man, I'm so curious now. Okay. As a result, private corporations that were not CCPCs could no longer benefit from the RDTOH rules with respect to the Part 1 tax that they paid on investment income. This change was explained in the 1982 Department of Finance technical notes as follows. Paragraph 129.3a of the Act defines the refundable dividend tax on hand, RDTOH, of a private corporation. This represents the portion of tax on investment income which is refunded to a private corporation on payment by it of dividends. There are two changes to the calculation of refundable dividend tax on hand. First, the corporation must be a Canadian control. That does not explain why. They did not explain. This literally just tells you that we made a change, but doesn't explain why they made the change. Oh, my word. Okay, I agree with appellant that the history of this definition of RDTOH shows that Parliament intended for the refundable tax regime for Part 1 tax, which now includes Section 123.3, to only apply to CCPCs. Okay.
Okay, but what's the spirit of this provision? I don't know, but it applies to CCPCs only. The spirit is for this provision to apply to CCPCs.
This is hard. This is hard to understand this, yeah. Okay, the SCC has consistently stated that the OSP analysis should not become a search for an overriding policy of the Act that is not found in the text, context, and purpose of these provisions. However, this is exactly what the respondent is asking me to do. In my view, the text, context, and purpose of Section 123.3 does not support a finding that its object, spirit, and purpose was to prevent Canadian resident individuals from deferring tax on investment income held in any private corporations. Oh, my goodness. Wow. Angels dancing on the head of a pin here. A consideration of the text, context, and purpose of Section 123.3 leads to the conclusion that the object, spirit, and purpose of this section, its rationale, is to, together with the refundable tax regime and the dividend gross of a tax credit regime scheme, prevent the use of a CCPC to defer taxes that may be payable at a higher rate by the shareholders of the CCPC while maintaining the integration of taxes paid by CCPCs and the shareholders.
I'm not sure why the government is saying it's deferring
why
tax
are they
on
doing that?
any private corporations.
Why did they do that?
Because it's clear that the scheme is there for CCPCs. Like,
so why?
If I have a 51% ownership by non-resident and I'm the 49% shareholder, it's not a CCPC, so all the scheme will not apply.
Right.
And I can keep the money in the corporate investment income and I will not pay the CCPC rate and the refundable tax rate on this because it's not a CCPC. I mean, why? I'm not sure I understand.
Yeah, I don't get it. I don't get it. I don't understand the government's argument there. Like, there must be a reason that you want to argue for the generality, but the generality is not necessary here. I mean,
I think if we redo this sentence, I think the text, context, and purpose of Section 123 is to prevent Canadian resident individual from deferring tax on investment income held in a CCPC.
Yeah. Well, anyway, he says that's the purpose of that one. So what do we have so far? Just to recap, if we go back up, we started with this, hey, there's these 4 or 5 provisions, and we're going to go through each one, right? Yeah. The 5 provisions being
the 2 definitions.
Way back. Holy moly.
It's far away when we were younger.
Jeez, oh my gosh. Okay, so he's going to, yes, here they are. So paragraph 41 is the one that says there's 5 provisions. We did the first one, which is the one that tells us that once you've continued, you're no longer Canadian. We did not look at that. He did not even look at that.
We've looked at the definition.
We looked at the definition of CCPC.
And now we've looked at 123.3.
We did the definition of Canadian corporation, and we did 123.3, which levies the refundable tax. And now we're going to look at the GRIP and the LRIP, but we never did this.
Are we doing it at the end?
I wonder.
Maybe. Oh yeah, we're doing it at the end.
Okay.
Not in the order.
Not in order. Expected. Oh, okay. So it might have been helpful if he had said, like, in paragraph such and so to such and so, I will discuss blah blah. But anyway, that's not what happened. Okay, so where are we? 130 something.
140.
Hey, now we're really making progress. We're making progress. Are you ready again?
I am.
Okay, let's go. I'm sorry to tell you that you have to read this. Look it.
I saw.
No, this is terrible.
It's terrible. I will read it fast.
You're going to speed read it?
I'm going to speed read.
Okay, I love it. We're going to have a speed run in a moment. All right. So just to remind everybody that's watching, we're reading DAC Investment Holdings, the tax court case. We're currently working through the OSP of each of the provisions said to be abused. We're at section 123.4. Take it away.
Thank you.
Like, subscribe, share.
Like, subscribe, share, and comment for more. We are reading tax cases. This is the Tax Files, everyone, with Professor Christians and by Clip.
And we do it because we're nerds. And we would do it alone if we have to.
It's fun.
Yeah, it's fun.
So, section 123.4. Subsection 123.42 provides what is referred to as the general rate reduction. The subsection reduces the general rate of a corporation by the general rate percentage. The subsection reads as follows. General deduction from tax. There may be deducted from a corporation's tax otherwise payable under this part for a taxation year the product obtained by multiplying the corporation's general rate reduction percentage for the year by the corporation's full rate taxable income for the year. And the tax court italicized the year.
They emphasize the year.
The year.
Okay.
The general rate reduction percentage is defined in subsection 123.41. For years after 2011, the percentage is 13%. As a result, the tax rate that the corporation pays on its full rate taxable income is reduced from the general tax rate of 28% to 15%. The full rate taxable income of a corporation is defined in subsection 123.41. The definition distinguishes between the income of a corporation throughout the year, that is throughout the year as CCPC, the income of a corporation that is throughout the year an investment corporation, a mortgage investment corporation or mutual fund, and the income of all other corporations. It reads as follows. And that was speed read. 123.41, the definition in the subsection applied to this section. Full rate taxable income of a corporation for taxation is AA. If the corporation is not a corporation described in paragraph B or C for the year, the amount by which the portion of the corporation taxable income for the year, or for greater certainty, if the corporation is non-resident, that portion of the taxable income earned in Canada for the year. This is subject to tax under section 123.1 exceeds the total of I. If the amount is deducted under subsection 123.11, from the corporation's tax otherwise payable under its part for the year, the amount obtained by dividing the amounts deducted by corporation's general rate reduction percentage for the year to the lies. If the amount is deducted under subsection 125.12 for the corporation's tax otherwise payable under its part for the year, the amount determined in respect of the deduction of the formula in the subsection through the lies. The corporation's income for the year corporation income for the year from personal services business and for the lies. The corporation is a credit union throughout the year and the corporation injected an amount for the year in the subsection 125.1 because of the corporations of subsection 137.3 and 4. The amount, if any, that is the product of the amount, if any, determined for B, subsection 137.3 multiplied by the amount determined for C in subsection 123.3 in respect of the corporations for the year. B, if the corporation is dependent controlled private corporation throughout the year, the amount by which the amount of the corporation's taxable income for the year that is subject to tax under subsection 123.1 exceeds the total of little I. The amount that would, if paragraph A applied to corporations, be determined under subparagraphs AI to 4 lies in respect of the corporations for the year and 2 little lies. The least of the amount, if any, determined under paragraph 125.1A to C in respect of the corporation for the year and 3 little lies, except for a corporation that is throughout the year a cooperative corporation within the meaning assigned by subsection 136.2 or A. Credit union, the corporation's aggregate investment income for the year, while the meaning assigned by subsection 126.9.4 and C. If the corporation is throughout the year investment income corporation, a mortgage investment corporation, or a mutual fund corporation, nil.
That is insane. I think you should read the whole act. I just feel like you really have something going here. It's really going to be amazing. They said emphasis added. I have to go back. See, where? Oh, there. It's at the very beginning. Full rate taxable income. That must be it. No, apply.
This section.
What? Okay.
Why?
So first of all, you all got all that from the. Okay. So, definition distinguishes between the income of a corporation that is throughout the year CCPC, that is throughout the year an investment corporation, a mortgage investment corporation, or a mutual fund, and the income of all other corporations. Okay, it's distinguishing between income of different kinds of corporations. And then it says they apply in this section, and this is important because
it's just for the section, not for the rest of the act. Why is it important? We're going to figure out.
I guess we're going to find out, yeah.
Under paragraph C of the definition, the full rate taxable income of an investment corporation, a mortgage investment corporation, or a mutual fund is nil. This means that such corporations are not entitled to claim the general rate reduction.
Okay. Mortgage or mutual
Does
fund?
it apply? No.
No, it's irrelevant.
Yeah. No.
Yep.
Paragraph A of the definition applies to all corporations other than CCPCs, and corporations described in paragraph C of the definition. Under this paragraph, the full rate taxable income of the corporation is the corporation's taxable income that is subject to tax under subsection 123(1) minus the amount set out in subparagraph 1I to 4 lines of paragraph E of the definition. Subparagraph 1 of the line to 4 lines refer to the following. Amounts deducted by the corporation in respect of manufacturing and processing profits,
Oh, yeah.
and
I
electrical
can't remember this.
energy and
Yeah.
steam sales.
There's a lot of steam being sold in this
sales.
judgment. But anyway, that's neither here nor there.
I just want to read a judgment where the business is selling steam.
Well, I think we've had... Anyway. How do you even sell steam? With a coal fire plant?
You
Or
sell-
a fog machine?
I think it's like, in Vancouver, there is like a clock that works on steam.
Really?
I think it still works on
Like a
steam.
Boiler.
Like there are steam
Are you going to
pipes.
sell the steam itself? No, you sell the boiler.
No, you sell the steam. Like in New York. There are like places where steam is coming out
Yeah.
of the ground.
Yeah.
This is the steam company selling steam.
Okay. Who's buying the steam?
Apparently, all the big buildings in New York,
They want the steam.
they want the steam
That's heat?
for
it hot?
heating because it's like more ecologically friendly than like oils.
Yeah.
Because the steam is like a byproduct of electricity or something like that.
Okay. Hey, I'm here for it.
This is,
Sell some steam.
this is very podcasting. Talking about steam.
I mean, this is how this is going to go with us because we get distracted when we're reading these cases as we come to something that we don't.
We're just
Necessarily.
steam sales.
Just steam sales. I would love to sell some steam. That seems like selling air or like snow. Let me sell you some snow. I have some right there.
But do you have steam?
I could produce some steam.
Are you in the steam business?
I could be in the steam business. Yeah, I could do it. I feel like plugging in the fog machine right now to prove it, but I'm not going to though because that's not today. Not today. Okay.
These amounts are otherwise subject to rate reductions. The corporation's income from a personal service business and certain amount is in respect of a credit union. Paragraph B of the definition applies to CCPCs. Only to CCPCs.
Yeah.
A CCPC's full rate taxable income is the CCPC's taxable income that is subject to tax under subsection 123(1) minus the amount set out in subparagraphs 1I to 3 lies of paragraph B of the definition. Subparagraph 1I to 3 lies refers to the following. The amount just discussed that are set out in subparagraphs 1 to 4 lies of paragraph A of the definition. Is it still the steam?
Yeah.
Okay. The amount of the CCPC's active business income for the year that is eligible for the small business deduction as determined under paragraph 125, 182C,
Okay.
and the CCPC's aggregate investment income for the year as defined in subsection 129(4). The text indicates that Parliament intended that the general rate reduction be available to all corporations other than corporations set out in paragraph C of the definition. Further,
Okay.
the text indicates that the intention was not to apply the general rate reduction to income that was taxed at a rate that was lower than the general tax rate of 28%, the 38% general corporate tax rate minus the 10% abatement, such as the income of a CCPC that is either investment income or income that is eligible for the small business
Okay.
deduction of or the income of a corporation that is eligible for the manufacturing processing profit credit. Is there a credit for steam? Is the manufacturing credit also works for steam? I think it does, right?
I do not know. Okay, so just to be clear, this general rate reduction is the 13, or the 10. No, the abatement is the 10.
Abatement is the
General
10.
rate reduction is the 13. Everybody gets that general rate reduction unless you've got other reductions somewhere else.
Like the steam credit.
Yes, exactly. So that means that if you get some other reduction, you don't get the general reduction.
It's like there is specific reductions for steam, so we're not giving you the general reduction.
Yeah. So one wonders why there's a general reduction at all, but it's for this purpose. It's like I'm going to have a bunch of different reductions for different kinds of taxpayers with different circumstances, and if you don't get one of these special ones, you get the general.
The idea is you all start at 38, and then you do pluses and minuses
for some reason.
And you end up at the rate.
Yeah.
I mean, Parliament could just have said, like, if you earn that type of income, your tax is 15 or 13 or 10 2/3 or whatever.
I know.
But we're just
like
playing with.
It's a very strange thing that we do this. Yeah.
And then it's like you increase, you lower.
What do you need? Do you need sunglasses? There's a whole bin. Oh, there is? Yeah, man. One of these says sunglasses. Look. Classic.
There's a whole box of sunglasses.
Yeah. Take them. Use them. Enjoy them. That's amazing. I'm like, why is he looking at my sunglasses for? That's so funny. Okay.
It's crazy, people, they come in for sunglasses, some come in for steam.
We have everything. One-stop shop.
Yeah.
Sunglasses, steam, we got it all. Okay, so our point is that we just decided to do this strange thing where we would have like a higher starting rate. Everybody gets a reduction from that rate. It's just in different combinations.
Is it possible to not get a reduction?
Well, personal services corporations, they don't get any reduction.
So you get the abatement if you're taxable in Quebec? I guess you do.
Know. Yeah, I guess you must.
I guess you do, yeah.
You must do. But it's bizarre. That's a whole other question. Like, it's a strange idea, but that's what's going on here. So that's 146. Just saying, hey, we have this general rate, we have this default rate. Everybody gets different deductions. If you get one, you don't necessarily get the other.
And you could even go higher than 38.
Yeah, you could easily.
Like exactly 38 2/3
here
for the investment income.
Right.
But part of it is deductible, by the way, in case you didn't know.
Yeah, exactly.
This can be seen from the exclusions under paragraphs A and B of the definition. So paragraphs 1I and 2 lies of paragraph A of the definition, which also applies to CCPCs, exclude income that is eligible for the lower corporate tax rate available in respect of a corporation's manufacturing and processing profits, and its income from electrical energy and steam sales.
Yeah, that.
Steam sales. With respect to CCPCs, paragraph B of the definition extends the exclusion to the CCPC's profit from its active business that are taxed at a lower rate as a result of the small business deduction and the CCPC's aggregate investment income. As discussed, the CCPC's aggregate investment income is originally taxed at a high rate. However, after the application of the RDTUH rules, the aggregate investment income is taxed at a lower rate than the general tax rate.
Okay, so the general tax rate is the 38.
So you pay higher, but once you get the refund, it's lower.
Yeah.
Who would have thought?
Who would have thought?
I don't know.
What an amazing
Really
way to math. The math is mathing.
The math is mathing.
The maths.
The portion of a CCPC's business income that is not taxed at the lower small business rate is eligible for the general rate reduction. Section 123.4 was enacted in 2001 The section originally provided a general rate reduction percentage of 1%
Okay.
for non-CCPCs and a reduction of 7% for a CCPC's business income between $200,000, the small business limit at the time, and $300,000.
Okay.
In the 2000 budget, the government stated that it intended, within 5 years, to reduce the federal corporate rate by 7% on all business income not currently eligible for special tax treatment.
Do you think they meant 7 percentage points or 7%? Like going from 30%,
I think
7%,
it's 7%.
7% of 30% and reducing it by that, or 7 percentage points, so going from 30 to 23?
I think it'll be going from 30 to 23.
Okay, well, there's a big difference, right?
Indeed.
Okay.
The 2000 budget plan explained the government's purpose behind enacting the section, namely that it was being used as a mechanism to keep Canada's corporate tax rate competitive, and specifically that it was targeting areas that were otherwise not subject to favorable tax treatment,
Okay.
which is,
Oh
of
my
course, not
gosh.
the case of Steam.
Of course not.
Okay, I have to read this. The government of Canada now.
You have to say it. It sounds like making. Whenever you start with making, it's hard to not. It's me,
It's mimic. Mimic. Making the economy more internationally competitive. Mimic. It's mimic. Making the economy more internationally competitive. Reduction in the tax rate for highest tax sectors.
Lord. Okay.
To prosper in the global economy,
Yeah, here we go.
Canada needs a business tax system that is internationally competitive. This is important because business tax rates have a significant impact on the level of business investment, employment, productivity, wages, and incomes.
Sure.
Canadian effective tax rates for small businesses, the manufacturing and processing (M&P) sector, and the resource sector
Steam.
are by and large internationally competitive. But they are too high. Clearly, they're too high.
Yeah, they're clearly
Because
too high. Always.
We should mimic.
We need a mimic.
As a result of special tax preferences, small businesses effectively have a federal tax rate of about 12%, while the M&P and resource sectors have a federal tax rate of about 21%. Shocking. Really?
Yeah.
Should be the same. However, other sectors, all the money is going for the steam company.
Yeah, I know. It's an outrage. It must be fixed. We must fix it. We must
However,
address.
other sectors of the economy, like the steam, are subject to the high general corporate tax rate without any special provisions.
Yeah.
These highest tax sectors include fast-growing service and high technology firms and steam
Yeah.
that will influence the pace of Canada's future economic and social development. In recent years, many industrialized countries have either reduced their
Race to the
corporate
bottom.
tax rates
Yeah.
or announced their intention to lower them. It's like we need like a, I don't know, minimal global tax maybe.
What a great idea.
If no action were taken, Canada's general tax rate would not be competitive with those of our trading
You
partners.
see how we speak? This is how we talk about
It's like-
tax.
It's not let put an end to competition.
No.
It's like, no, we should join
Yeah.
and double down
Get
and
more,
be
yeah.
even more competitive.
Yeah.
And just race to the bottom, man.
Just keep racing until there's nothing left. Then try building a military when you don't have any money. But I digress.
Yeah, well, the government's objective is to reduce within 5 years the federal corporate income tax rate to 21% from the 28% on business income not currently eligible for special tax treatment. As a first step, the budget proposes to reduce this rate to 27% effective January 1st, 2001. Once fully implemented by 2004, the combined federal provincial tax rate, including both income and capital taxes, would be reduced from the current average of 47% to 40%.
That seems very high considering where we are.
A more competitive level vis-a-vis other G7 countries.
Yeah. G7. I mean,
G7, yeah.
one of which doesn't have a healthcare system, but hey,
The taxes are too high for corporations.
taxes are too high. Yeah, they're too
You
high.
cannot. This drive to spur investment was again reiterated by the Minister of Finance in his October 2000 economic statement speech, where the government increased the speed at which it intended to reduce the federal corporate tax rate. The Minister
What do you think
of
is
Finance
that? What is
noted the
all
following.
this? Why is the court telling us
What
about
happened
all
in
this?
2000? Who lowered their taxes in 2000? Was it the U.S.?
It's just the .com boom, and I
Yeah.
don't know. Yeah, take whatever you need. Don't be sorry. This has been going on.
Okay, do you have a USB-C to USB-C? I know you're
Yeah, for sure. Yeah.
I mean, we are using some, but
there's more. Okay. Sorry to take you away
Don't
from this.
No, Raphael, keep reading. Don't ever
Okay.
stop reading.
in Budget 2000, we set out a 5-year plan to lower that rate from 28 to 21%. The plan called, I'm just going to mute this one. The plan called for a 1-point drop next year, with the remaining reduction taking place by the end of 5 years. Today, to ensure that these companies remain internationally competitive, we're accelerating that plan. In addition to the 1-point reduction, general corporate tax rate scheduled for the coming year, will now legislate a 2-point cut in each of the following 3 years. By accelerating and legislating this timetable, companies can invest with
You know what it
certainty,
is?
knowing precisely when and by how much their taxes will
I know what it is. It's the e-commerce boom.
Yeah.
It is like, it's right when e-commerce is taking off.
Mm-hmm.
You know, the Apple's about to invent the iPhone, or like it's about to get rolled out. Like, this is what's going on, and it's before the crash. So this is like prime. This is, you know what this is? This is when everybody's shorting the housing market. The big short. That's it's happening right now.
Yep.
Yeah. So we're going crazy. Like, we're like, oh, we got to get in on this like American Google started. American companies are heating up. We've got to be competitive. BlackBerry's in the mix. Yeah. BlackBerry's, out there in the world competing. That's what's going on. Okay, fine. And then
in the 2006 budget, the government proposed to increase the general rate reduction percentage to 9% by January 1st, 2010.
So it's another tax cut, just in a different way.
We're going to increase the reduction.
Increase the reduction, yeah. Something that's harder to see.
Yeah. It's easier to sell. So it's not I want to lower the tax rate. I'm just increasing the reduction.
Yeah.
In 2007, the government proposed to further increase the general rate reduction percentage to its current rate of 13% by 2012.
All right.
When announcing both of these changes, the government emphasized that the purpose of the increase in the general rate reduction percentage was to reduce the general corporate income tax rate to help build a tax system that is internationally competitive.
So incredible how much changed from that till just a couple years later when everything crashed. Yeah. It's like, we got to be competitive. We got to slash and burn these rates. We got to give more corporate subsidies because we got to get out there and be internationally competitive, and we're not competitive. And then, boom. Wow. Okay. So, just a question, do you recall who is the Prime Minister and who's the Minister? Is Finance Morneau? Bill Morneau?
2010.
2006? Anyway, it doesn't matter.
Harper?
I was thinking
it's Harper. Flaherty?
It could be. Could be. Yeah. Okay.
I'm not sure.
All right.
In his 2006 budget speech, the Minister of Finance emphasized that the rate reduction affected by Section 123.4 was intended to apply to income that is taxed at the general corporate income tax rate. He noted the following. The rate reductions will apply to income that is taxed at the general corporate income tax rate. This income does not include small business income that is already eligible for the small business deduction, investment income of a Canadian controlled corporation, which income is eligible for a special refundable tax, the income of credit unions eligible for the corporate tax rate reduction under Section 137 of the ITA, and the income tax and the income of mutual fund corporations, mortgage investment corporations, most deposit insurance corporation, and investment corporation as defined in the ITA, which income already qualifies for special tax treatment. Consistent with these proposals, measures will be introduced for taxation years that begin on or after May 2nd, 2006, to clarify that full rate taxable income does not include any taxable income of the corporation that is not subject to tax at the general corporate income tax rate applicable under Section 123 of the ITA.
Okay. I'll read a little bit. Conclusion on the object, spirit, and purpose of Section 123.4, including subparagraph 123.4, 1B3 little I. The respondent argues that the object, spirit, and purpose of Section 123.4 is as follows. The object, spirit, the respondent argues that the object, spirit is as follows. The object, spirit, and purpose of Section 123.4 is to exclude CCPC investment income from the corporate tax rate reduction available under that section because such income already benefits from a preferential corporate tax rate when the CCPC is paid the dividend refund under Section 129. And, as with Section 123.3, to prevent Canadian resident individual shareholders from benefiting from a tax deferral on investment income earned through a private corporation which they control directly or indirectly in any manner whatever, and which they would not benefit from had they earned this income directly. Section 123.3 enhances the existing role of refundable Part 1 tax on aggregate investment income, which ultimately does confer a benefit on a CCPC that pays out dividends. The government did not want to give the benefit of a lower tax rate to such corporations. The last paragraph of the respondent's argument appears to be more of an argument relating to whether the appellant has abused Section 123.4 rather than an argument with respect to the object, spirit, and purpose of the section. The appellant argues that the purpose of Section 123.4 is to make Canada's business tax system more internationally competitive. MEMIC. The appellant argues MEMIC, the last paragraph, I'm not understanding paragraph 156 there. It's clear from the text of Section 123.4 and the various statements made by the government when introducing and subsequently increasing the general rate reduction that the OSP of Section 123.4 is to lower the general corporate tax rate such that the highest non-refundable corporate tax rate levied under the Act is 15%. The 15% is composed of the 28% general tax rate minus 13% general rate reduction provided for in Section 123.4.
So what is the OSP of this provision? It's to
MEMIC.
It's MEMIC.
Yeah.
To be more internationally competitive. So that's it.
Wow. Hard to abuse a provision, the objective of which is to MEMIC.
I mean, if you MEMIC, you just achieve the rationale of the provision. So you cannot abuse MEMIC.
But how are you internationally competitive if you're totally Canadian?
But the purpose of the provision is to MEMIC.
Yeah. Okay.
And it's probably right.
I'm not sure it's not right. I think it is right.
It's right.
Yeah, it's definitely. I mean, they could have just done it across. They could have said like across the board. Can we forget all this silliness and just have 15% rate across the board? We could have done that, and they didn't do that. And they didn't do that because they're trying to be more surgical. Yeah. All right. Hey, we're finally at subsection 250.5.1. This is very exciting.
Finally.
What can I help? What can I help you with?
The drum with the tiny tax band on it.
Oh, the cajon. That's there.
Okay.
Yeah, it's like under the thing. You're gonna have to dig it out from this side. Yeah. Good luck.
Sure.
Best of luck to you. Noah's gonna dig out a cajon now, and he's gonna play it on the way out of the office because that is what we do. Good luck. Oh my God. Yeah. Fortunately it's very light, but it's like a little bulky. Yeah, that's it. That's the whole thing. Watch your head. Okay. Watch your everything. You're great. Now, so just back out gently, carefully. I'm going to show you. Step over. Okay. Yep. So far, so good. Mm-hmm. Okay, just stop right here behind me.
Sure.
Yep. Put it down. Sit on it. Now hit it. That's it.
Yeah. That's some high-tech stuff.
It does actually have you can power it up, and then it has different effects.
This is good to know.
If you want the power, you gotta plug it in.
This is great. I'm gonna be a menace.
Yeah.
Perfect.
Okay. So I think the power is just one of those, it looks like a normal plug things. There's probably one hanging on the back of the door. Yeah. Best of luck. when we're done this, I'll take us down and live stream the event, whatever the event is.
Subsection 250.5.1.
I don't know why we don't have the whistle. I mean, Noah, oh my gosh, maybe they'll come back and get some small instruments. We need them to take those instruments and use them. Anyway, okay. Yeah, so finally, we were promised 255.1 at the beginning, but it came at the end. Are you ready, or do you want me to read?
Oh, I'm going to read it.
You got it? Great. Pressed into
still
service.
Have, more than 50 paragraphs?
Yeah, there's a lot, but we're almost through the...
Okay, 15 pages. We have time.
We can make it.
We can make it.
We're going to make it.
Okay, subsection 250.5.1 reads as follows.
Yeah.
Continued corporation. Where a corporation is at any time, in this subsection referred to as the time of continuation, granted article of continuance, or similar constitutional documents, in the particular jurisdiction, the corporation shall, A, for the purposes of applying this act, other than subsection 254, in respect of all times from time of continuation until the time, if any, of continuation in a different jurisdiction, be deemed to have been incorporated in the particular jurisdiction and not to have been incorporated in any other jurisdiction, and B, for the purpose of applying subsection 254 in respect of all times from the time of continuance until the time, if any, of continuation in a different jurisdiction, be deemed to have been incorporated in the particular jurisdiction at the time of continuation and not to have been incorporated in any other jurisdiction, which is pretty much what I said earlier.
Yeah,
You're deemed
exactly.
to never have been incorporated in Canada, but only have been incorporated in
Yeah.
the BI. Subsection 255.1 was added in the Act in 1994.
Okay.
With various effective dates. It applies when a corporation is continued in the particular jurisdiction. The subsection applies when a corporation that was not incorporated in Canada is continued in Canada, and when a corporation that is incorporated in Canada is continued in another jurisdiction.
Okay.
For example, it applies when the appellant, which was incorporated in Canada, was continued into the British Virgin
I
Islands.
think this is the first mention of the facts applied to the facts in like 100 paragraphs of generalities. Yeah. Okay.
Paragraph 255.1a applies for purposes of applying the Act, other than subsection 254. Under paragraph 255.1a, the corporation is deemed in respect of all times from the time that it was continued in the new jurisdiction to have been incorporated in the new jurisdiction and not to have been incorporated in any other jurisdiction, which is what the law says.
Yeah. Yeah.
As noted in the Department of Finance's 1994 explanatory notes, the continued corporation is treated as having been incorporated in its new home jurisdiction only for the purpose of applying the Act from the time of continuation and only until continuation into a different jurisdiction. So if you want to continue back into Barbados or something.
Yeah.
Paragraph 255.1b applies for the purposes of the deemed resident in Canada rule in subsection 254. Generally speaking, subsection 254 deems a corporation that was incorporated in Canada after April 26, 1965 to be a resident of Canada throughout the taxation year. Paragraph 255.1b provides that for the purposes of applying subsection 254, the continued corporation is deemed to have been incorporated in the new jurisdiction at the time of the continuance and not to have been continued in any other jurisdiction. Prior to the enactment of Section 255.1, Section 88.1 of the Act, which was enacted in 1980, dealt with the continuation of a corporation. This section, which was repealed in 1994, generally effective after 1982, read as follows. Corporate immigration.
Okay.
Where, at any particular time after August 28, 1980, a corporation that was incorporated in Canada, other than a corporation that was not at any time resident in Canada, A, has been granted article of continuance or similar corporate constitutional documents in a jurisdiction outside Canada, or B, has become resident in a jurisdiction outside Canada and would, as a consequence thereof, be exempt from tax under this port on income from any source outside Canada derived by it after the particular time by virtue of any act of parliament or anything approved, made, or declared to have the force of law thereunder. The following rules apply. C. The corporation's taxation year that would otherwise have included the particular time shall be deemed to have ended immediately before the particular time, and the new taxation year of the corporation shall be deemed to have commenced at the particular time. D. The corporation shall be deemed not to be a Canadian corporation at the particular time and all subsequent times. E. Each property owned by a corporation immediately before the particular time shall be deemed to have been disposed of by it immediately before such time for proceeds of disposition equal to its fair market value at the time.
and such proceeds shall be deemed to have become receivable, and to have been received by it immediately before such time. F. Section 48 does not apply to the corporation for the taxation year in which it is deemed by paragraph E to have disposed of its property. And G. Each property deemed by paragraph E to have been disposed of by the corporation shall be deemed to have been reacquired by it immediately after the particular time as a cost equal to the proceeds of disposition thereof as determined in that paragraph. It was more comprehensive. Like you would just sell everything like
deemed disposition as if when you emigrate.
When you emigrate, yeah.
Interesting. Okay.
While current subsection 255.1 deals with both corporate immigration and immigration, former section 88.1 only dealt with corporate immigration. Further, under former section 88.1, a corporation was deemed to dispose of all of its assets at fair market value upon immigrating from Canada. This deemed disposition was not included in subsection 255.1. The following extract from the 1979 Budget Supplementary Information indicates that Section 88.1 was a response to tax planning strategies involving corporate continuances. Canadian corporation can avoid tax by taking steps to technically adopt residence in a jurisdiction outside Canada. Where such transfer occurred after December 11, 1979, the corporation would be deemed to have disposed of all of its property at fair market value, thus ensuring an appropriate level of Canadian tax.
You sounded like a sad character when you read that.
However, Section 88.1 resulted in unintended consequences, leading to its repeal and the introduction of Section 255.1 and certain concurrent amendments. What were the adverse effects? Paying too much tax?
Let's find out.
This was referred to in the 1994 explanatory notes, which noted the following.
Okay, please explain it. Instead of just telling us that you made a change, please explain why.
In many jurisdictions, a company incorporated elsewhere may be naturalized by submitting to the new corporate law of its new home, the place where it holds papers. Such an action is often described as corporate continuance or continuation. New subsection 255.1 of the Act, together with certain concurrent amendments concerning taxpayers' residence, fixes the tax consequences of continuation into a different jurisdiction. The basic principle of Section 255.1 is that the continued corporation would be treated as having been incorporated in jurisdiction into which it is continued. A corporation, for example, that was originally incorporated in Canada but was subsequently continued abroad will cease to be treated as having been incorporated in Canada and will therefore no longer for that reason be deemed to be resident in Canada, although it may remain resident by keeping its central management and control in this country. Similarly, a corporation incorporated abroad or incorporated in Canada and earlier continued abroad will become resident in Canada on being continued here.
So they explain nothing.
Well, they explained that
the exact rule that they applied.
A continuation
for no reason.
Is a continuation.
Yeah, but they didn't say what is this unintended consequences. What are those unintended consequences?
Well, it's the fact that, for example, a corporation that was originally incorporated in Canada but was subsequently continued abroad will cease to be treated as having been incorporated in Canada, and will therefore no longer, for that reason, be deemed to be resident.
Well, is that an unintended consequence?
Of course, it is. It's too harsh on the taxpayers.
Okay, here comes some doctrine.
In his 1993 Canadian Tax Journal article, Michael G. Flatters describes some of the problems with Section 88.1 as it stood at the time. In particular, a corporation incorporated in Canada that was continued to another jurisdiction would lose the benefit of its Canadian corporation status, but could continue to be deemed to be a Canadian resident under subsection 254. This could result in the corporation being taxed as a Canadian resident even though its central management and control were not located in Canada, and the corporation was continued to a foreign jurisdiction.
Huh? How would it be deemed to be a Canadian resident? Okay.
And not be a Canadian corporation. Okay. Additionally, an inbound corporation.
Oh, it's because it's because the 88.1 didn't say to you, once you continue, we are going to treat you as if you were no longer incorporated. As long as you were incorporated in Canada, once incorporated, always. Once a Canadian corporation, always a corporation. And 88.1 didn't fix that. Right. You couldn't get out of it. You'd have to shut down the whole corporation, sell everything, and then start a new one.
Right.
Otherwise, you're always going to be Canadian, even if you have no connection to Canada.
Additionally, an inbound corporation not originally incorporated in Canada would not be able to qualify as a Canadian corporation,
Right.
even if its central management and control were in Canada. Mr. Flatters explained how subsection 255.1 could remedy the previously noted flaws with section 88.1. The addition of subsection 255.1 and the repeal of paragraph 88.1d appear to deal with the asymmetrical treatment of inbound and outbound continued corporation as Canadian corporations and taxable Canadian corporations.
Okay.
A corporation that was incorporated in Canada and that is continued under the laws of a foreign jurisdiction will now be regarded for the purposes of the Act as a corporation incorporated into foreign jurisdiction for the time continuation until any future continuation in a different jurisdiction. Conversely, a foreign corporation continued under the laws of Canada or one of its provinces will be regarded as a corporation incorporated in Canada for the purposes of the Act at all time from the time of continuation until future continuation. Continuance.
Okay.
In a separate 1983 Canadian Tax Journal article, Mr. Robert Cousin and Mr. Robert Dart provide a similar explanation of the problems with the former Section 88.1 and the relief provided by subsection 255.1.
Oh boy.
Section 88.1 and 219.1 have had draconian and inappropriate consequences.
Whoa.
Draconian and inappropriate consequences in the case of a corporate continuance of a Canadian resident corporation outside Canada.
Oh my goodness, where's my violin? I gotta play it for these poor corporations.
So unfair.
So unfair.
These provisions have entailed the full application of departure taxation, even though conventional wisdom assumes that, at least in many cases, the continued corporation remains resident in Canada. But why do you want to continue outside Canada if you're still a resident in Canada? I don't.
Right? I mean, nobody seems to query that basic question, but
but for tax reasons, are there commercial reasons?
Maybe
Probably they are.
There are very certainly. Yes, I'm going to guess there are. For example, I can't get creditor protection in Canada like I can get in some places.
Right.
I'm trying to hide my assets from my spouse. I can't get that in Canada, but I could get it somewhere else.
Oh yeah, maybe at the time I wanted bearer shares.
Yeah. Perfect.
Like beneficial ownership.
Exactly. Right.
Not in the sense of husky. The other beneficial.
The other
ownership.
Kind. Yeah.
Because the recently has two the same term.
Yes, for two completely
concepts.
different. I know. Yeah. Great.
These provisions have entailed the full application of departure taxation, even though conventional wisdom assumes that in at least many cases the Canadian corporation remains resident in Canada. Subsection 254 deems a corporation incorporated in Canada to be resident in Canada, and even a continued corporation appears to be properly described as incorporated in Canada. In these circumstances, the interaction of these provisions yields the unappetizing result of departure tax followed by continued gain taxation of the corporation.
It's gross. It's unappetizing.
I don't want to eat that.
No, I don't want to eat that.
So unappetizing.
Don't eat that.
It's not appetizing. I want an appetizing tax result. I think I should just refuse to pay taxes on the...
It's unappetizing.
It's unappetizing.
Come on.
I want the amount to be appetizing. I want to eat this amount. Unappetizing.
Okay.
Completely unappetizing. Proposed section 128.1 provides a more logical rule.
More advertising rule?
Departure taxation will depend solely on change of
residence. Yeah.
Of course, after such a change, the corporation will not be subject to Part 1 tax as a resident. However, there remains the question how to deal with continuance, because that would also be unappetizing.
Yeah, it would be so unappetizing.
Proposed section 255.1 provides that from the time a corporation has been granted the article of continuance in a particular jurisdiction, it will thereafter be deemed to have been incorporated in that jurisdiction and not in any other jurisdiction. The rule will apply from time to time, so that serial continuances will give rise to serial deemed places of incorporation. You're a serial continuer.
Wow.
This means that a corporation incorporated in Canada after April 26, 1965, which has been deemed to be resident in Canada by paragraph 254A, will no longer be deemed to be resident once it continues to some other jurisdiction.
Okay.
Okay.
So basically, in a nutshell, does it not say that what we're proposing is that we change the rule so that your continuation does not change your residence unless you want it to change your residence, unless you intend that by also moving management and control out.
Shouldn't the rule be like if you're continuing in another jurisdiction but remain resident, then you don't have to pay taxes on immigration. But if you continue in another jurisdiction
and you sever your residence,
you become a non-resident by virtue of a treaty, for example.
That you do have a disposition. But I think you do. That is the rule, is it not?
I don't know. Do you? I think you
I think as soon as you are no longer if you switch from being resident to non-resident, then you trigger that disposition rule.
There must be.
Well,
there? Drop in the comments below if you know.
Exactly.
I'm not sure. We'll have to do research on that. Because
I'd have to look at that.
It would be a good way
but
to.
I mean, it's too
it's
too easy now. Nobody's gonna have any.
Well, it's hard to
I guess
become a non-resident.
Yeah, but I mean, here the idea is like, hey, don't trigger disposition on the continuation if I'm still here. I'm just continued in another jurisdiction.
Yeah.
That's the upshot of it.
Because if you have a business in Canada and you have a PE, even though you're a non-resident, you will still pay taxes.
You're still gonna, yeah.
Yeah.
Okay. Okay. Where are we? 173.
173. The deeming of a corporation under subsection 255.1 to be incorporated in a specific jurisdiction impacts the taxation of the corporation under the Act.
Yeah.
Firstly, it can determine whether a corporation is resident in Canada for purposes of the Act, and thus tax on its worldwide income.
Yeah.
Is there a secondly somewhere? No. I don't know. I was expecting to see that.
I know. I don't see a secondly. Maybe it's further down. No, I think there's only a firstly.
Okay. Under subsection 254, a corporation incorporated in Canada. Can we have a name for this? Like a corporation incorporated in Canada. Can we have like something shorter, like
Canadian born?
Incancorp. I don't know. After April 26, 1965, is deemed to be a resident in Canada.
Yeah.
Corporations that are resident in Canada are taxed on their worldwide income. Corporations that are
God.
not resident in Canada are only taxed on their income from Canadian sources.
Yep.
Merci.
It's good.
Corporations that subsection 255.1 deems to be incorporated outside of Canada are no longer subject to the subsection 254 deeming rules. Such corporations will then not be considered resident in Canada unless their central management and control are located in Canada. In fact, this is the situation of the appellant after it was continued outside of Canada. It was no longer deemed to be a resident of Canada under subsection 254, but remained a resident of Canada, taxed on its worldwide income, because its central management and control remain in Canada.
Yep.
If the corporation is a private corporation that is resident in Canada, subsection 255.1 in effect determines whether the corporation may be taxed under the regime for CCPCs, corporations immigrating to Canada, or be taxed as a private corporation that is not a CCPC, corporations immigrating from Canada. As discussed previously, in order for a corporation to be a CCPC, it must be a private corporation and a Canadian corporation. In order for a corporation to be a Canadian corporation for the purpose of the Act, it must be incorporated in Canada. Therefore, the effect of section 255.1 is that a CCPC that emigrates from Canada ceases to be a CCPC at the time that it is continued in the jurisdiction. It will remain a private corporation, provided it remains a resident of Canada. Similarly, a corporation that immigrates to Canada becomes a Canadian corporation at the time it is continued in Canada and thus is eligible to be a CCPC if it also becomes a private corporation. As discussed previously, the status of a corporation as a Canadian corporation is important for various other provisions of the Act. For example, a corporation that loses its status as a Canadian corporation as a result of being continued in the foreign jurisdiction can no longer avail itself of the rollover provision in Section 85.
I think you just forgot, like, it's like 100 paragraphs later. I forget what I said, so I'm just going to say it again. Like, what is the idea of this? I don't understand. It's very annoying.
The amalgamation in 87 and the wind up in 88. As noted by the appellant, a corporation's loss of CCPC status as a result of Section 255.1 applying at the immigration of a corporation from Canada causes the corporation to have a deemed year end and may require the corporation to add an amount to its RIP account. What?
Whoa!
Oh, so what did we just read?
What have we learned?
I don't know.
I'm not sure.
I mean,
well, here you go. Conclusion on the object, spirit, and purpose of subsection 255.1. We're getting there. We're getting there. Ding.
Finally, the substance.
Substance.
I don't know what is worse, reading 150 paragraphs of facts, like witnesses.
Oh my gosh. We got to do chemical. Or 150 paragraphs of like abstract legal. But listen, it's great in the sense that it really does give you a little primer on this area. I'm not mad at it. It's just a lot. It's a lot.
Good. It's just.
It's a lot.
I don't know how it could have been a bit less repetitive.
Yeah.
Because
I mean, I think we could rewrite, but there's a reason for it. Yeah.
But I think also the problem with like a judgment as being a way of doing this doctrinal work is that there are different sections and you kind of have to repeat the analysis all the time. It's not like a doctrinal work in a paper.
Where you're like, make the thesis and then support the thesis. Like this one is like each one, like here's what I need to prove, here's the proof, I proved it. Yeah. Yeah. Okay, I'll read a couple paragraphs.
Thank you.
Conclusion on the object, spirit, and purpose of subsection 250 sub 5.1. The respondent states in his written submissions that the object, spirit, and purpose of subsection 255.1 is not to allow an individual I think it should be to not allow, but anyway, not to allow an individual resident of Canada who controls a private corporation to circumvent the regime applicable to CCPC investment income. Boy, that's a bit of a stretch, I would say. Okay.
I don't see how 255.1 says anything
I don't
about
see anything like that. Not based on what he just explained, not a thing. No. Okay, so, but look at paragraph 181. This is another instance where the respondent's argument with respect to the object, well, he really does not like the respondent's argument.
No.
Object, spirit, and purpose of a provision is more in the nature of an argument with respect to whether the transaction defeated the object, spirit, or purpose of the provisions in issue. The respondent notes at paragraph 179 of his written submissions that, quote, the government's intent was to address anomalous and unfair results flowing from the interplay of continuations and corporate residence. This is a statement with respect to the object, spirit, and purpose of subsection 255.1. The appellant agrees with this statement, but argues that it requires additional context. It is clear from the government's action in replacing section 88.1 of the Act with subsection 255.1 and in making certain concurrent amendments that the rules in the Act dealing with continuation in a jurisdiction outside of Canada were not working as intended, and that the continuation of a corporation into Canada needed to be addressed. It then added subsection 255.1 to address these issues. The rationale of subsection 255.1 is, ready? Drum roll, please. That was a
this one.
To equate the place of continuance of a corporation with its place of incorporation in order to ensure that upon the continuation of a corporation in a different jurisdiction, the various provisions of the Act that refer to the place of incorporation, such as the residence deeming rule in subsection 254 and the subsection 89.1 definition of Canadian corporation, produce the results intended by Parliament with respect to the taxation of the corporation under the Act.
That is quite a spirit.
Wow. Now we return to the question, did the appellant abuse the object, spirit, and purpose of the sections at issue? Having determined the object, spirit, and purpose of the provisions at issue, I must now determine whether the result of the transactions defeated or frustrated the object, spirit, and purpose of these provisions.
186.
A finding of abusive tax avoidance will be made when a taxpayer relies on specific provisions of the ITA in order to achieve an outcome that those provisions seek to prevent. when a transaction defeats the underlying rationale of the provisions that are relied upon, and when an arrangement circumvents the application of certain provisions, such as specific anti-avoidance rules, in a manner that frustrates or defeats the object, spirit, or purpose of those provisions.
I like that. I like that
not
paragraph.
bad. Yeah.
It's good.
Sure.
I think just to have this kind of guidance.
That's
what
when you're
is an
going to have a
abuse.
finding of abuse, of abusive tax avoidance. Actually, yeah, I like it.
I like it, yeah.
Citing Copthorne at paragraph 72, the SEC noted in Dean's Knight that these considerations are not independent of one another and frequently overlap. The SEC emphasized that the analysis must be squarely focused on abuse, stating, courts must go beyond the legal form and technical compliance of the transactions. They must compare the result of the transactions to the underlying rationale of the provision and determine whether that rationale has been frustrated. In coming to such a conclusion, the abusive nature of the transaction, quote, must be clear, unquote, citing Trustco, Copthorne, and Alta Energy. As stated in Canada Trustco, quote, courts have to be careful not to conclude too hastily that simply because a non-tax purpose is not evident, the avoidance transaction is the result of abusive tax avoidance. Subsection 245.4 does not consider a transaction to result in abusive tax avoidance merely because an economic or commercial purpose is not evident, end quote. The avoidance, okay, here we go. The avoidance transactions in this appeal involve the transfer of the SoberLink shares to the appellant and the continuance of the appellant into the British Virgin Islands. Once the appellant was continued in the British Virgin Islands, it was no longer a CCPC. It is clear that the purpose of these two transactions was to change the status of the appellant from a CCPC to a private corporation that was not a CCPC prior to the appellant's disposition of the SoberLink shares. Shortly after the avoidance transactions were completed, the appellant sold the SoberLink shares, realizing a taxable capital gain of 1.2-ish million, which became part of its aggregate investment income. Since the appellant was not a CCPC at the time that it sold the shares, its aggregate investment income was taxed at the 15% corporate tax rate applicable to income that is not otherwise subject to a preferred tax rate. This resulted in the appellant paying less tax than the tax that Mr. Siviero would have paid if he had been taxed personally on the sale of the shares. As a result, Mr. Siviero realized a greater after-tax return on the gain from the sale of the SoberLink shares held by the appellant, comparable to the after-tax return that he would have obtained if he had realized the gain personally. The personal taxation of Mr. Siviero on the gain realized from the sale of the SoberLink shares will, in effect, be deferred until the proceeds from the sale are distributed to him by way of dividend. When this occurs, Mr. Siviero will be required to pay tax at his marginal tax rate. He will not receive the benefit of the dividend gross-up and credit scheme since the appellant is not a Canadian corporation. In addition, the appellant will not receive a dividend tax refund in respect of any of the Part 1 tax that it paid at the 15% tax rate. If the appellant had not carried out the avoidance transaction, its aggregate investment income would have been taxed at the 30 2/3% tax rate applicable to aggregate investment income under the taxing regime for CCPCs. This would have resulted in the appellant paying the tax roughly equal to the tax that Mr. Siviero would have paid if he had been taxed personally on the sale of the shares. Because of the dividend refund mechanism, if the appellant had remained a CCPC, the tax paid by the appellant on its aggregate investment income under the taxing regime for a CCPC would have been reduced to 8% on the distribution of the proceeds from the sale of the shares to Mr. Siviero by way of dividends. Also, if the appellant were a CCPC, should be was there, I think.
Oh, word.
If they were?
They were.
Okay. If the appellant were a CCPC, Mr. Siviero would receive the benefit of the dividend gross-up and credit system for non-eligible dividends. In summary, the conversion of the appellant from a CCPC to a non-CCPC resulted in Mr. Siviero, through through the use of the appellant realizing a significant deferral of tax on the taxable capital gain realized on the sale of the SoberLink shares. Once the proceeds of the sale are distributed to Mr. Severo, the appellant will pay tax at a higher rate on the taxable capital gain realized on the sale of the SoberLink shares, 15% rate compared to the 8% rate paid by a CCPC after it receives the refundable portion of the tax originally paid at the 30 2/3% rate than it would have paid if it had remained a CCPC. Mr. Severo will not receive the benefit of the dividend gross up and credit system, a benefit that he would have received if the appellant had remained a CCPC. Thus, Mr. Severo executed the avoidance transactions, or directed the appellant to execute those transactions, to realize the tax deferral that arose from having the appellant taxed under the regime for a private company that is not a CCPC and that is not a Canadian corporation, as opposed to having the appellant taxed under the regime for CCPCs. The question that I must answer is whether the appellant abused the provisions of the Act at issue by carrying out the avoidance transactions in order to be taxed under the regime for a private corporation that is not a CCPC and not a Canadian corporation. Clearly, Mr. Severo and the appellant took steps to realize this tax deferral. As noted previously, the SCC has affirmed on numerous occasions the Duke of Westminster principle that taxpayers can order their affairs to minimize the amount of tax payable. However, as noted in Dean's Knight, this principle is not absolute. It does not apply when the transactions that are intended to minimize tax result in an abuse of the provisions of the Act. Okay, what do you think happened? What do you think we heard there? What I think we heard is that
It's like
the court
is asking itself, like, what exactly is the benefit?
Yeah, it is. It's meandering through, and it's saying, well, okay, on the one hand, you're not gonna get the refundable tax. You're not gonna get Part 1 tax that is increasing your corporate tax rate above 15%. But on the other hand, later when you pay a dividend, you're not going to get the refund of that tax, and you're not going to get your integration, so you're going to be worse off.
Exactly. It's like,
so how can I
really
say
is a question of tax deferral.
Yeah.
Especially when you play with the individual marginal rate.
Yeah, that's just it. It's a timing case.
Yeah.
And the taxpayer decided, he looked at the two alternatives and came to the conclusion that I am going to defer. And part of the reason you're going to defer is because I control when I pay that out as a dividend. So I control when it comes into my income. I can wait 20 years.
Yeah. So if you think about it, like if you want to retire, and you have most of your money in the TFSA, you get it out tax free, and you need like $20,000 a year in income, you get it from the BVI corporation, you will pay like zero tax on this.
Yeah.
So saying that you don't get the benefit of the credit and the gross up, like, depends on your income.
Also assumes that continuing back into Canada just before you, like, I'm not sure what happens. Like, what if you continue back into Canada and you're sitting on that income and then you pay it out? Is there something to stop the CCPC paying it out and getting? I mean, it will not.
It's not going to get a refund because you didn't pay the tax.
No, but the shareholder will get a credit, dividend and gross up in credit, will it not? Why wouldn't it? So you could reverse some of the.
Technically, I guess, yeah, but not the full thing.
You can't reverse all of it, but you can reverse.
Well, I don't know how it would work because you would not have an RDTOH in a corporation.
No, but you still get gross up in credit.
I guess you do.
Yeah.
I don't know how it works.
I think so.
Yes, you do. But also in BVI, I guess there is like no withholding tax.
Right.
Probably.
So the guy could move himself to BVI, himself become a non-resident.
Yeah. And not pay tax at all. I mean, if the goal is when I retired, I want to go live in BVI, Why not?
Yeah.
I mean, it's still $2 million.
I know.
I could
I
just
know.
get a home in BVI and move there.
Okay. We're really getting close now. Are you ready?
Real substance.
Okay.
The respondent's allegation of abuse is summarized in paragraph 19 of his written submissions, which reads as follows. The appellant misused Section 255.1 to circumvent the regime applicable to a CCPC's investment income, specifically Section 123.3 and the full rate taxable income definition. In subparagraph 123.41b3 lies, Parliament did not intend for subsection 255.1 to be used to thwart that regime. The appellant also abused Section 123.3 and the full rate taxable income definition, as well as the CCPC definition in subsection 125.7 and the Canadian Corporation definition in subsection 89.1. The object, spirit, and purpose of each of these provisions have been frustrated by allowing an individual resident of Canada to obtain a tax deferral advantage on the taxable capital gain on the sober-earning shares. The foundation of the respondent's argument is that the purpose of the provision at issue extends past CCPCs to all private companies, not corporations. The appellant argues that once it was continued in the British Virgin Islands, it did not avoid the application of certain select provisions applicable to CCPCs. It ceased to be subject to all of the provision of the Act applicable to CCPCs. This did not abuse any provision of the Act, since the Act clearly sets out two separate codes for the taxation of private corporations that are CCPCs and those that are not. 2 permits a corporation to change its status, and 3 sets out the precise consequence of such a change. As discussed previously, the Act contains a different taxing regime for public corporations, CCPCs, and private corporations that are not CCPCs.
Oh my word.
The regime for CCPCs contains specific rules relating to taxation of The regime rules were previously discussed in detail. I have summarized the regime in the next few paragraphs, just in case you need it again.
Okay.
While private corporations that are not CCPCs pay tax on their business income at the general tax rate, CCPCs pay tax at both the general rate and the lower eligible small business tax rate. The Act contains a legislative scheme for the taxation of investment income of a CCPC that does not apply to private corporations that are not CCPCs. The scheme is composed of 2 sets of rules. The first set of rules, the dividend gross up and credit system, attempts to integrate the tax paid by a CCPC and its shareholders through the use of eligible and non-eligible dividends. While the system is available to shareholders of other corporations, it contains special rules for CCPCs. Further, the system does not apply to a private corporation, such as the appellant that is not a CCPC and not a Canadian corporation. Wow. The second set of rules, which are made up of Section 123.3 and the sections that provide for CCPC's refundable portion of its Part 1 tax, attempts to discourage the retention of investment income in a CCPC while maintaining the integration of tax paid by the CCPC and its shareholders. The retention of income in the CCPC postpones the tax payable at the shareholder level. The second set of rules does not apply to non-CCPCs. The Act contains a number of other provisions that only apply to CCPCs, most of which are intended to provide benefit to CCPCs that are not available to other corporations. I agree with the appellant that by carrying out the avoidance transaction in order to be taxed as a private corporation that is not a CCPC, the appellant did not abuse any of the provisions at issue. Parliament has chosen, for policy reasons, to have different sets of rules for different corporations. For example, it has chosen to have different taxing regime for public corporations, CCPCs, private corporations resident in Canada that are not CCPCs, corporations that are not resident in Canada, and foreign corporations that are resident in Canada. If a corporation does a certain thing,
no, wait.
It is transferred.
If a corporation does a certain thing,
it is transferred from one taxing regime to another. This is what occurs when a CCPC is continued in the foreign jurisdiction and moves from being a CCPC to a non-CCPC. It can also occur when a corporation that is resident in Canada takes steps to not be a resident of Canada. Once it takes such steps, it is no longer taxed under the regime for corporation resident in Canada, but rather is taxed under the regime for corporations that are not resident in Canada. Another example is when a corporation that is a taxable corporation takes steps to become an exempt corporation. Parliament recognized that a corporation may move from the taxing regime for a CCPC to the taxing regime for a non-CCPC. This can be seen in subsection 249.3.1 and section 89. Subsection 249.3.1 provides for a deemed year-end for a corporation that becomes or ceases to be a CCPC. The corporation's taxation year that includes the time of the corporation becomes or ceases to be a CCPC is deemed to end immediately before that time. This deemed year-end leads to consistency when applying the provisions in the Act that contains the taxing regime for CCPCs and the taxing regime for private corporations that are not CCPCs. As a result of the deemed year-end, corporations' change in status from a CCPC to a non-CCPC severs the link between the corporation's operations when it was a CCPC and its operations after it ceased to be a CCPC. Its operations prior to the deemed year-end when it was a CCPC are taxed under the regime for a CCPC, and its operation after the deemed year-end when it ceased to be a CCPC are taxed under the regime for a non-CCPC. This allows for the proper application of numerous provisions of the Act, whose application is conditional on the corporation either being a CCPC or not being a CCPC at the point in time or throughout the period. For example, the application of certain provisions, such as Section 123.3 and 123.4, is dependent on the corporation being a CCPC throughout the taxation year. The deemed year-end has the same effect when a corporation that is not a CCPC becomes a CCPC. The Act also contains transitional rules that affects a corporation's calculation of its eligible and non-eligible dividend when it either becomes or ceases to be a CCPC. The transitional rules require adjustments to either the corporation's LRIP account or its GRIP account. As discussed previously, the LRIP and GRIP are part of the dividend gross-up and credit system. A Canadian resident corporation that is not a CCPC maintains an LRIP that reflects its income that has benefited from certain preferential tax rates. The corporation cannot pay eligible dividends unless its LRIP account to zero. Subsection 89.8 contains rules that apply when a corporation ceases to be CCPC. These rules may require a corporation to add an amount to its LRIP account. A CCPC maintains a GRIP account that reflects its income that has not benefited from preferential tax regimes. A CCPC may only pay eligible dividends to the extent of its GRIP balance. The Act contains rules in subsection 89.4 that apply when a resident corporation becomes a CCPC. These rules may require the new CCPC to add an amount to its GRIP account. Clearly, by providing transitional rule for the RIP and GRIP account, Parliament recognized the corporation could change its status from a CCPC to a non-CCPC or vice versa. But also a CCPC could just become like on the stock exchange. Yeah, so you need rules to get in and out.
Yeah, it's just the statement that Parliament gave you rules, sometimes you're in, sometimes you're out, is not incompatible with a statement that says you could abuse those rules to try to get in or try to get out. Like, I don't understand why the court doesn't seem to even contemplate that idea.
I feel like I'm just reading a list of what is different.
What is on this side of the line and what's on... Yeah, and nothing about trying to jump the line to get from one to the other.
I mean, I think that the problem is it's not you are allowed to change your status. It's more if you become public or if you become owned by non-residents. Yeah, you have to change status because you no longer qualify. It's not a... Yeah,
it's very...
It's not a choice. It's not a tick the box.
I know. It's very strange. It's a very strange view here,
In my view, the appellant, by entering into the avoidance transaction in order to be taxed under one taxing regime put in place by Parliament as opposed to another taxing regime, did not abuse the provisions at issue. The appellant chose to move from one taxing regime...
Here's the pluses and minuses,
with its pluses and minuses to another taxing regime with different pluses and minuses. But again, it's not a tick the box.
I know.
It's not you choose to be. It's not a choice like we see in the Act. On the plus side, it avoided the application of Section 123.3. On the minus side, it lost access to the low eligible small business tax rate for its business income. Is there any business income? No.
Yeah.
The refundable dividend tax credit for a portion of its tax paid at the general tax rate on its aggregate investment income and the dividend gross up and credit system. It also lost access to a number of benefits that are only available to CCPCs. Since it chose not to be an incorporation, it lost the benefit of rollover, TAD, amalgamation, and wind-ups. Yeah. Again,
all hypotheticals that it's not engaging in. Yeah. It lost the access to things it's not doing.
And if we can just choose to get in and out,
Yeah.
you just continue in Canada
just
and you
gonna-
can benefit from Section
Right.
85 and whatever.
Exactly.
It
Like,
really
it's a little
is like
strange.
when you benefit from the regime, you get in. When you no longer benefit,
Yeah,
you get
you
out.
get
And
out.
if ever you want to benefit again, you
You just
get back
jump
in.
back in. Yeah.
The avoidance transaction that resulted in the appellant ceasing to be a CCPC did not defeat the underlying rationale of the provisions at issue or circumvent the provisions in a manner that frustrated their object, spirit, or purpose. The object, spirit, and purpose of the definition of CCPC is to provide a dividing line between those corporations that are taxed under a specific regime for CCPCs and those corporations that
gosh.
are not taxed under this regime. Prior to being continued in the British Virgin Islands. The
Why is this,
appellant-
okay, just to be clear, why is this stated here where he's supposedly telling us the positions of the parties? Why is he telling us what the object, spirit, and purpose is in the section that is not about the OSP?
Why is it position of the parties? This is clearly just the decision.
Right.
I mean, I think we are just missing a title somewhere because we are still in positions of the parties.
Right.
Why are position of the parties at the very end?
Okay.
Prior to being continued in the British Virgin Islands, the appellant was on one side of the dividing line, and after it was continued, it was on the other side of the dividing line.
Is
This
this
is
somebody's
exact-
argument, or
This-
is this...
This is exactly what Parliament intended.
I don't understand how this is...
This is
I
a
don't
decision.
understand. Like, he made a mistake here. He needs another heading because
Yeah,
this is
there-
not the position of the parties.
There's a heading missing.
Okay, I think the heading is missing after paragraph 203. Needs a heading.
Yeah.
Judgment.
This is exactly what Parliament intended.
Exactly. Yeah.
Exactly.
Sure, this is what they meant.
As
yeah.
just discussed, Parliament recognized that the corporation could move from one side of the dividing line to the other. It enacted provisions to facilitate this movement. Is it really to facilitate this movement or just to say what happens when you become in a
yeah.
CCPC? I don't see how it facilitates. The avoidance transactions did not defeat the underlying rationale for subsection 123.3 or result in a circumvention of the section in a manner that frustrated its object, spirit, and purpose. The object, spirit, and purpose of section 123.3 is to, together with the refundable dividend tax regime and the dividend gross-up and tax credit scheme, prevent the use of a CCPC to defer taxes that may be payable at a higher rate by the shareholders of the CCPC while maintaining the integration of taxes paid by CCPCs and their shareholders. The appellant chose to be taxed under a different scheme that Parliament established under the Act. The scheme for taxing investment income of corporations that are not CCPCs and not Canadian corporations. Again, this is not the situation where from the outset you're like, I don't want to be a CCPC. This is clearly, I want to be CCPC
until
it's
I
bad.
don't. Yeah. Agreed, yeah.
A scheme that does not include section 123.3, the refundable dividend tax regime, or the dividend gross-up or credit scheme, regardless of the tax imposed or not imposed under the Act. The appellant's choice to be taxed as a non-CCPC did not abuse section 123.3, since Parliament only intended it to apply to a corporation investment income that is taxed under the regime for CCPCs.
It's very formalistic.
Yeah, it's like this investment income thing. It's only when you earn business income, really. But that's not what the law says. I think it's very narrow.
Yeah.
Because 123.3 applies generally for for CCPCs.
How's it going?
Oh,
It's going well. Would you ever like to come down at some
Yeah,
point?
we're almost there. Like
Alright.
10 minutes. Hey, there's a box of instruments.
Oh, there are?
A little TTB instruments.
I think that we have one.
You think you have? Okay, we're almost there.
All right.
Okay.
Section 123.4 also produced the result intended by Parliament. The object, spirit, and purpose of Section 123.4 is to lower the general corporate tax rate, such that the highest non-refundable corporate tax rate levied under the Act is 15%. Levied under the Act is 15%. Once the appellant ceased to be a CCPC, it was no longer eligible to receive a refund of a portion of the Part 1 tax that it paid at the 28% general tax rate under the refundable dividend tax credit rules on the taxable investment income that it realized on the sale of the sobering shares. Since the income was not eligible for any other special tax preferences, Section 120.4, as intended by Parliament, lowered the tax rate to 15%. which Parliament intended to be the highest non-refundable tax rate levied under the Act.
Yeah.
The continuation of the appellant in the British Virgin Islands did not abuse subsection 255.1. The rationale of subsection 255.1 is to equate the place of continuance of a corporation with its place of incorporation in order to ensure that upon the continuation of a corporation in a different jurisdiction, the various provision of the Act that refers to the place of incorporation, such as the residence deeming rule...
Typo. Such as, not at.
I just
Woo!
read as.
Yeah, I know.
Such
yeah.
at the
Yeah.
residence deeming rule in subsection 254 in the subsection 89.1 definition of Canadian incorporation produce the results intended by Parliament with respect to the taxation of the corporation under the Act. Once the appellant was continued in the British Virgin Islands, it was deemed to be incorporated outside of Canada, which allowed numerous other provisions to operate as intended by Parliament. For example, the appellant was no longer deemed to be resident in Canada, no longer considered to be a Canadian corporation, and no longer considered to be a CCPC.
Friends, we're almost there.
Almost.
We're
one
almost
page.
there. Last page. Last page.
The fact that it remained resident in Canada did not frustrate the object, spirit, and purpose of subsection 255.1. This was a result anticipated by the government at the time it was introduced. It introduced subsection 255.1. The 1994 explanatory notes for subsection 255.1 specifically refer to a corporation that is continued abroad that remains a resident of Canada by keeping its central management and control in Canada. For the foregoing reasons, the result of the avoidance transaction did not defeat or frustrate the object, spirit, and purpose of the provisions at issue.
There you go.
The appellant argued that if the guard did apply, the reassessment is statute barred on the basis of the normal reassessment period
There
of
you
the
go.
appellant in respect of the 2016 taxation year expired after 3 years on January 16, 2020. Since I have found the guard does not apply, the issues is now moot.
That's
In
this,
accordance
3 years,
with
4
these
years.
reasons,
Yeah.
in accordance with these reasons for judgment, the appeal with respect to the reassessment made under the Income Tax Act for the appellant's taxation year ending April 30th, 2016 is allowed with costs. The reassessment is referred back to the Minister of National Revenue for consideration and reassessment on the basis that the appellant's transaction, as set out in the reasons for judgment, did not result in abusive tax avoidance for the purposes of subsection 245
Wow.
of the Income Tax Act. Signed at Halifax, Nova Scotia, this 9th day of May 2024, Justice Darcy.
Very well done. Nice reading, Maître Raphael Clément. You have done a service to humanity in reading the case. This has been the Tax Files. We read DAC Investment Holdings versus the King at the tax court level. Next time,
The Federal Court of Appeal.
the Federal Court of Appeal. See you then. Bye.
Bye.